claims. Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Good morning. You're watching India Market Open, and markets still in that kabhi haan kabhi na phase, I would say. Looking for direction, continuing to consolidate. I mean, that last Monday post Operation Sindoor, when the markets jumped up massively, seems like a long time away. They've spent their time consolidating ever since.
Yeah, but for the broader end of the spectrum, we'll talk about the difference in valuations, but just one interesting thing from a global piece, and Tamanna, you should highlight 50 things, I'm sure, but the one that stood out for me, foreign transfers into Harvard or maybe some of the other universities now being banned. I mean, wow. For a lot of people who've studied there or fancied studying in a US university, if this can happen to Harvard, maybe to some others as well. But this is some serious battle between the president of the United States and one of the premier universities.
Yeah. What is happening there politically is just another case. Even this bill, which has now passed
the big beautiful bill, exactly.
Beautiful bill, which has now passed the House of Representatives and makes it to the Senate, is not great for Indians in the United States on all fronts, whether it's medical care, whether it's visas, whether it's remittances into India or in any other country. All external remittances will see an extra 5% tax. So it's bad news for immigrants as a bloc.
And bad news
Indians.
for dollar, bad news for the US dollar. I mean, with the deficits that this bill is expected to get up, we've already seen this 7-8% weakening thus far.
Yeah.
This is not good for the dollar at all.
And the cost of US debt.
But I think we've got the best guy to talk about it. But
All right, quick wrap up before we get to Edward Yardeni, our first speaker this morning. It was a mixed day of trade on Wall Street as rising bond yields have impacted investors. So the Nasdaq was the only index which was up, but you had pretty much flatline on the Dow Jones and the S&P 500. So Trump's budget bill is cleared in the House of Representatives and now heads to the Senate. So bond yields are reflecting that kind of concern. They did end in lower after a massive spike, but lower is relative, right? So the 30-year was at 5.04% after hitting the 5.14% mark. That's the highest since 2023. The 10-year at 4.52% at one point was about 4.6%. Bitcoin, meanwhile, has hit a new record high. So if you're looking at asset classes with good news, cryptocurrencies definitely make the cut. 112,000 is the new level for Bitcoin. Oil prices have fallen after reports of production increase by OPEC+. The Brent was below the $65 mark. Japan's April core inflation has risen 3.5%, highest in 2 years, and higher than estimates of 3.4%. So a bit of pain point there. Look at Asian markets. Asian markets have opened mixed, but in the green currently. Nikkei almost 0.75% up in the green. I'm going to pull up implied for India very quickly before we get to our first speaker this morning. 40 points in the green is what we're seeing as per the GIFT Nifty. All right, Edward Yardeni is with us, president of the Yardeni Research. Mr. Yardeni, thank you so much. Always a pleasure to speak with you here on NDTV Profit. Why don't you start by explaining to us and our viewers why the 30-year Treasury above the 5% mark is such a big deal?
Well, I think we are seeing around the world, there's some protesting going on in the bond markets to the amount of sovereign debt that is out there. In the United States, I think the big, beautiful bill that just passed the House still has to get through the Senate, but it's going to net add to the amount of debt over the next 10 years. And I think that's why you're seeing the 30-year bond over 5%. The 10-year is still fairly calm. It's still right around 4.5%. So we're not at this point looking at a real crisis or panic situation. But we certainly have to be concerned about the pressure that we're seeing in the bond market. The 20-year auction yesterday did not go off very well. And then, of course, the other area where there's concern about sovereign debt is in Japan, where we've seen 20, 30, 40-year bond yields go up rather dramatically in a very short period of time here. And it didn't help when the Prime Minister of Japan suggested that Japan's situation was comparable to Greece. I guess he was comparing it to Greece in 2010. Right now, Greece is doing actually very well compared to Japan, I guess, is the way I see it. But all in all, the U.S. economy remains resilient. Consumer spending looks like it's hanging in there quite well. The jobless claims that came out today suggest the labor market's doing quite well. And I'm not in the camp that thinks the dollar is going to take a dive here. I think the dollar is actually holding up pretty well on a trade-weighted basis. It's relative to the euro that it's been weak.
Okay. Hi, Dr. Yardeni. Thanks so much for joining us this morning.
Sure.
Term premiums going up. I'm just wondering at what point it will dissipate, because we've seen instances like this in the past several years where US debt and the quantum of it has been a talking point, but that has dissipated. So do you see that happening this time as well? And at what point do you see markets going back to normal?
Well, that's a great question, and it's been sort of a question that's I've had to answer on a regular basis in my career. I've been doing this for over 45 years, and for over 45 years, there's been concerns that the debt crisis was imminent, that the sovereign debt would no longer be financeable, and so on and so forth. And that hasn't happened. So I've taken the position that I'll worry about the debt problem when the bond market worries about it. So I was concerned in 2023, we saw the bond yield go from 4 to 5% in a matter of 3 months, but then at 5%, there were plenty of buyers. And then we had on April 8th, in reaction to Trump's Liberation Day, we saw the bond yield jump from 4 to 4.5%, and the bond market got the president's attention, and he postponed the tariffs. So I'm watching. I'm not thinking that there's going to be a debt crisis in the United States, but there may be higher yields ahead here, which could start to threaten the resilience of the U.S. economy.
Dr. Yardeni, good evening to you. And
good evening.
Even if the dollar were not to weaken as much as the doomsday scenarios paint out, but if it does at the margin go down, if this bill sees the light of the day, so on and so forth, at the Senate too, what happens to flows in that regard? Because there's a lot of conversation out here in the emerging market pack, right? That if Japanese yields are moving up, if the US yields are inching higher, what happens to flows which are expected to move incrementally from the developed markets to the emerging market pack?
Yeah, well, look, there is certainly a case for a weaker dollar, and it's really become sort of the consensus view. And my contrarian instincts have kind of come out here. And I point out that the U.S. capital market, particularly our sovereign debt, our treasury bond market, is the largest in the world. Everybody keeps saying how big the bond market is, but people have been buying the bonds. Central banks have been buying the bonds. I don't see that people are panicking out of treasuries. And then whenever we get any sort of crisis in the world, money flows right back into the dollar and then into the bond market. And of course, we're looking at a world where stability is not one of the great factors that we can count on. The instability has been all too clear, and I think on balance that still benefits the U.S. dollar and the bond market. But I think the other point I would like to make is that a lot of people look at the dollar index, the so-called DXY index, and that's really a fixed weight index where 57% of it is the euro. So you're really basically looking at the euro dollar exchange rate. And I think if the euro keeps getting stronger, that's really bad news for Europe. Europe doesn't really need a strong currency right now. The US, if it has a strong dollar, can tolerate it, can put up with it. Our capital market could absorb lots of demand for our securities. So I think we still have that advantage. So I'm really not worried about the dollar taking a drubbing here.
What about emerging markets like India, Dr. Yardeni? In the midst of all of this, watching what's happening to the dollar, bond yields in the United States rising, does it spell bad news for emerging markets and India especially, which is now seeing a reversal of foreign flows after months of none of that happening?
Yeah, well, maybe India needs to file an application with the people who put together these stock market indexes and say, you know, we're different. India's stock market has been on fire. It's been very strong. There's a lot of optimism about the outlook for the Indian economy. The demography is much younger, more entrepreneurial as compared to other emerging markets, particularly compared to China. But also India, you know, other emerging markets like Brazil, Indonesia, they require commodity prices to be strong. That's in India's case, an environment where commodity prices are stable and relatively low, as they are now, benefits India more than most other emerging market economies. So the only problem with India is it's been discovered, and valuation multiples are high, elevated. But I think over time the earnings will justify them.
Okay. Dr. Yardeni, thanks so much for joining us this morning.
Thank
Always
you.
a pleasure speaking with you.
My pleasure.
Okay, let's talk about what happened in trade yesterday, and part of what Dr. Yardeni was talking about. We've seen outflows this week more often than not from foreign institutional investors, and in fact that did take place yesterday as well. 5,000 odd crore rupees on a net basis was sold, and domestic institutions buying to the extent of 3,279 crore rupees. In fact, they have remained positive in May despite those outflows. They have net bought around 10,400 crore of equity in May so far. They've net sold around 13,000 crore rupees of equity just this week though, so bear that in mind. At the end of Thursday, we ended off the day's low, but the Nifty 50 still dropped about 0.8%, recovered about 147 points from the day's low. 42 out of the 50 Nifty 50 stocks declined, with losses led by ONGC as well as Mahindra and Mahindra and a couple of other stocks. The broader markets once again outperformed, and I'm sure Neeraj is going to talk about this, but let's put the numbers on the screen. The Midcap index losing about 0.4%, the Smallcap index ending flat and off the low point of the day, significantly off. Speaking of the low point of the day, the Nifty Bank saw a very sharp recovery intraday on the back of short covering, and it's an interesting derivative setup, and I'm sure we'll talk about that as well over the course of the day. But it gained nearly 330 points in the last hour of trade to end about 0.25% lower. So look at that big run towards the end of the session. It ended at 54,941. Most sectors have lost ground though in trade yesterday, led by FMCG, IT, oil and gas. But defense once again proving to be the bright spot, gaining about 2% in trade yesterday as well. And there was, of course, stock-specific news for it to move up, Neeraj.
Yeah, most certainly. But Alex, you summed it up right. I mean, there's just within this negative bias, it is the broader market outperformance and very, very stock-specific moves that continue. I mean, defense is a classic case in point. Nobody needs us to tell them, but it's just that the stock picking in the mid space is very, very active. Now, you know, look at this performance over the 5-day period and since 9th May, when the first move started, right? And we speak about how the markets have done so well. In the last 5 days, the small cap index is up 0.98%, wherein mid caps and large caps in particularly have suffered. But if you look at it since 9th May, when this whole up move conversation, right, since the conflict eased, the Sensex is up just 1.88%. The real move has happened in the small cap space. 9.7%, and of course it is beaten down quite a bit, but I'm just saying that the street's preference in the last 15 days is entirely in the SMID space. I mean, there was an MK note which spoke about how they like some of the SMID stocks and they gave a new list, a clutch of other people coming out on air and talking about how, I mean, viewers, if you see any guest who comes at 10:10 on Talking Point, they are talking about how this market is a very stock specific mover and therefore they are effectively saying don't go out and buy the Nifty necessarily or an index, bet on specific stocks, and SMID stocks come firmly into focus. If anything, the one thing that is coming out from the large cap perspective is IT services, and brokerage note after brokerage note is talking about how the commentary from IT services businesses, when they go onto the road shows or when they talk to the end clients, that the commentary is not looking weak, and maybe, just maybe, if this pull back into the Indian large cap indices were to continue, IT becomes a place to hide. So maybe that is something we keep an eye out for. Just one last point, guys. We've been talking about valuations, right? I requested Chinmay to just do a basic dipstick of what the 1 year forward and the trailing 12-month valuations look like. The Nifty 1 year forward on an 8.8% assumption of growth, not necessarily 12%, and this is just checked as of this morning, the 1 year forward multiple is 20 times. It is not so expensive. Maybe it was 23 at about 25, 200, 300. At the current multiples, it's at 20 times. Not very bad.
So what Dr. Edward Yardeni is saying about valuations, it's coming off.
It is coming off.
It's coming off. It has come off.
At 20 times, you can't make the case for Indian markets being too expensive. They're okay. Yes, mid stocks are expensive, but the Nifty benchmark, which everybody, foreigners especially, look at, is not very expensive.
So maybe room for growth there. All right, some factors to watch, of course, is the kind of week it has been so far. Nifty for the week is still down about 400 points. It's been the highest weekly losses since April 6th. Despite the sharp fall yesterday, Nifty has managed to defend its crucial zone, which is 24,450 to 24,500. Holding above this level may open the path for a rebound towards the 24,800 to 24,900 range. The index continues to remain above the key moving averages, the 20-day, the 50-day, the 200-day EMAs. All of those are still being defended. Key levels which you should watch out for: support at 24,500, at 24,400, 24,300. Those are the three levels that which you should look out for. Resistance at 24,700 and 24,780. Key levels for the Bank Nifty: resistance at 55,100 and support at 54,700. Over and above this, all I would say is that look very, very, very closely at what companies that you are invested in individually, those stocks, what are they reporting this quarter? Because there is no clear consensus about whether there has been a beat or not as a whole. Whether if I have to zoom out and look at how corporate India has performed, there's no clear consensus there. So you need to go deep dive, you need to go stock by stock specifically and look at the balance sheets of the companies that you have invested in, because that's where all the signs are. But having said that, what is the derivative setup looking like? Puneet is joining us for more.
Well, thank you for that. So that 147-point recovery from the lows of the Nifty yesterday was one of the key ones to watch out for. Although on the bank Nifty, we couldn't sustain the 55,000 level that we've been speaking about for a while. Now there's another, we're looking at the other supports now on the lower level, 54,700, 54,750 become one of the other key levels. While there was expected pressure in the bank Nifty because of IndusInd Bank yesterday, there wasn't much from IndusInd Bank. We saw the PSU banks correct a bit in trade yesterday as well. Currently, it's again expected to start above 55,000, but we'll need a big trigger here to sustain that level going forward as well. But overall, we've seen, the open interest, of course, has fallen for both Nifty as well as the bank Nifty, and because we've seen rollovers as well. So 3% down in terms of open interest, and we've seen rollovers from the May to the June contracts specifically. But we've also seen a build-up of shorts from FIIs across, futures as well as bank futures and index options. We've seen FIIs continues to build their stocks. Even in the long-short ratio, if we can move on to the next graph, it was yesterday at 37% in terms of index longs. It's fallen to 32% now. So essentially, it is indicating that there are shorts being built up in the system by foreign investors. In terms of net OI put to call ratio, it's again very neutral to give a rating in terms of it's bang in line at 1.08% at this point of time. When you move on and look at some of the other key stocks, we've seen an increased interest at 25,000 for the calls. That remains one of the key levels on the call side. For the puts, we've seen that increased interest and major support at 24,000. We've also seen an increased interest at 24,500 levels on the put open interest side. Finally, in terms of some stocks on both gainers as well as losers for open interest, we've seen some short build-ups across stocks like Nestle and Colgate. Colgate, of course, the numbers were largely weak in this particular quarter, and it's reflected in the build-up of shorts. In terms of open interest losers as well, we have seen some stocks seeing some short coverings like Astral, IndusInd. Again, we spoke about yesterday in much detail as well. Astral numbers were largely better in terms of compared to the other peers like Principi, which came out yesterday as well, while the others like Sale as well as Zydus Life has also seen some short covering in trade. So another very interesting day in terms of GIFT Nifty. Let's just pull that up finally, where we are indicating at least an open of just about 29 odd points. But again, key levels again to watch for both on the Nifty and the bank Nifty in trade today going forward as well.
Okay, Nifty implied now 30 points up in the green. Let's talk about the top picks this morning, or what is on our watch list actually. Two big numbers being reported post-market hours, so I'm going to start with those. Sun Pharma first. Thumbs down as per consensus. So the fundamental story is good, but you see that fundamental story perk up in FY27. We're talking about the here and the now based on the numbers. So here's what we're seeing. Weak US generic growth despite strong domestic growth. So domestic growth has been the outperformer, but US generic growth has been weak, and of course, we know that there's more trouble on the horizon as far as the US market is concerned. Guidance of mid to high single-digit growth is what the company has given, but it's lower than its peers, hence the thumbs down. Global specialty sales growth at 8.6% is below expectations of a 12% growth. US formulation sales also saw a decline of 2.5%. US business decline is led by weakness in US generics. Here are the numbers. Revenue up 8% for the quarter year on year, 12,959 crores, less than estimates. That's another problem for Sun Pharma. It's not really lived up to estimates. EBITDA up 22.4% at 3,716 crores. Also a miss on estimates. Margins have improved 25.3% to 28.7%. Net profit is down 19% to 2,154 crores. So there is a one-time expense there. Here's what brokerages are saying. Citi has maintained a buy, hiked the target price, but they're saying soft guidance reflects regulatory uncertainty rather than business reality. FY26 estimated margins may remain flat. We expect sharp expansion in FY27 estimates. So you need to look at Sun Pharma with the thought of what is your horizon for this stock. All the good stuff happens, like I said, after FY27. Macquarie says they've maintained an outperform with a target price of 2,135. They say Q4 results were modest, operating miss. FY26 guidance is below consensus. Management has guided for mid to high single-digit growth versus 11% growth baked in by consensus. Systematics has maintained a buy, retained a target price of 2,206. They're saying adjusted earnings are below expectations owing to weakness in US generics. Strong domestic growth is offset by weakness in US generics, and guidance of mid to high single-digit revenue growth considering global uncertainty. So, which is why an overview of a thumbs down on Sun Pharma. ITC, on the other hand, is a thumbs up. Revenue has beaten estimates. EBITDA and net profit misses, though. Cigarette business has seen steady growth. Agri business has outperformed. High inflationary pressure on FMCG, paper margins under pressure. Here are the results. Standalone revenue up 9.4% to 17,248 crores. EBITDA is up 2.5% to 5,986 crores. Margins at 34.7% versus 37.1%. There's a dip there and below Bloomberg estimates as well. Net profit from continued operations up 0.8% to 4,874 crores. If you see the segmental performance, cigarette revenues have grown 6%, and you're seeing an implied volume growth of 4 to 5%. FMCG business has grown 5%, agri business has grown nearly 18%, and paper business has grown 5.5%. Morgan Stanley is maintaining on overweight. They're saying with a target price of 500 rupees on the stock. They're saying it's an overall beat. Top line was ahead across businesses. Margins were better across businesses except paper. Growth was aided by portfolio and micro market interventions, countering illicit trade and focus on competitive belts. Slower cigarette EBIT growth owing to inflation, partly mitigated by improved mix. Paper impacted by muted domestic demand, Chinese and Indonesian supplies, and surge in wood prices. So that's the overview on ITC. Honasa is also a thumbs up on balance. So revenue is in line, EBITDA and profits have beaten estimates. Double-digit year-on-year growth in key categories has helped. Modern trade has shown a 20% growth as well. In the year-on-year offtake, volume growth at 21.2%. So here are the numbers. Revenue up 13.3% for the quarter to 533 crores. EBITDA is down 17.6% to 27 crores versus 32 crores. So better than Bloomberg estimates, though, which were at 17.6 crores. Margins have also come down from 7 to 5%, but the estimates were 3.4%. So in Honasa's case, it's actually a beat on estimates. Net profit is down 18% to 25 crores versus 30.4 crores. EBITDA is also down due to 20% uptick in other expenses. Here's what Goldman Sachs says. They've maintained a neutral. They've hiked the target price to 275. They're saying encouraging green shoots, sequential growth recovery in Q4. Mamaearth's improving trends are driving the growth recovery. Offline channel revamp showing results now. And Honasa's derma skincare brands continue to post strong growth. EBITDA margins will recover, but likely cross FY24 levels only in FY27. So that's one common thing in both two of the three results that I've taken, that penciling in that kind of a solid recovery only by FY27.
You have to look further down the road.
Yeah.
Okay, so the first stock that I've taken is from the defense pack, but of course, MTAR Tech has other revenues beyond the defense and aerospace area. But let's talk about the numbers. They look really good if you look year on year. They've more or less maintained the trajectory if you look sequentially. But let's talk about the year on year numbers. The revenue is up as much as 28%, stood at 183 crore rupees. The EBITDA has increased as much as 86%. And the margins have expanded quite considerably. If you look at a year-on-year comparison, 18.6% compared with 12.8%. On a sequential basis, it's more or less where it was in the third quarter. The PAT number is considerably higher than the year-ago period at 13.7 crore rupees compared with 4.8 crore rupees or thereabouts. Do remember that this is a stock that has run up along with the defense pack, and also, the order book at the end of March stood at around 980 crore rupees or thereabouts, and that's lower than what the management had guided. They've guided for an order book of about 1,500 crore rupees. So bear that in mind. That could see a reaction in trade today. On balance, a good set of numbers from MTAR Tech. Metro Brands also had a decent set of numbers in the quarter gone by, particularly if you compare it with the expectations. The revenue increased as much as 10%, stood at 643 crore rupees. That was in line with expectations. The EBITDA has increased as much as 24%, come in slightly ahead of expectations at 197 crore rupees or thereabouts. The margins have expanded just a tad bit, 30.7% or thereabouts compared with 27.2%. and the PAT number is down actually 39%. But do bear in mind that there was a tax expense in this quarter of about 31 crore rupees. In the comparable quarter last year, there was a tax credit of 50.8 crore rupees. So that's had a bearing on the bottom line comparison. It is ahead of, or just marginally ahead of consensus estimates. So this should be looked at positively for Metro Brands. And the last two I will talk about are Trent and Bharat Electronics. The announcement has come through from the BSE that in some of its key indices, including the 30 stock Sensex, these are the two stocks that are going to be included on the 23rd of June. The flows will come through on the 20th of June. Both of these are going to be replacing Indocin as well as Nestle India, which will see outflows to that extent. But BEL seen getting inflows of $345 to $354 million, as well as Trent, which is seen getting inflows of $290 to $304 million. Remember that these are passive flows that come through because of inclusion into any index. If you are, for example, invested in an index fund of the Sensex, then the money that you invest will go into these stocks.
I have two small caps and one mid cap, if you will. First one is Centum Electronics. Good results, but the profit after tax was also aided by one-offs, and which is why a very large jump. But revenue is up 28%, and everything in this defense space, etc., is doing well. So Centum too has done well. The margins, such a big beat, 10.5% versus 1.8%. I'm sure Q4 last year was curtailed, but this is actually a good performance, and very likely the stock will see a positive move. Net profit at 21.5 versus a loss of 6.8. Like I said, there were some one-offs to this PAT as well, but the margin picture tells you a story that the profit after tax performance would have been good. So expect a reaction on Centum today. Expect a reaction likely on MTAR as well today, maybe, because revenues were up 28%. At 183 crores, but the margin performance at 18.6 versus 12.8%, very sharp uptick. So keep an eye out for that. And the net profit at 13.7 crores versus 4.8 crores. So very likely this one could see a reaction. And watch out for Ramco Cements. You know, cement stocks have been high. And you know, Monday when Parag Thakkar comes into the studios, we're going to talk to him about Ramco results, Star results, and the reactions on those stocks. But I would reckon that Star anyways had good results, but the stock got punished. Ramco would be punished because the numbers haven't looked that great. Revenues were down 10.5%. Margin at 13.3 versus 15.6. And again, compounded by some one-offs in the previous quarter, but the net profit down 78%. So in normal parlance, it may not have looked as bad as 78%. But looks bad nevertheless because the margin performance has been weak and the revenues have been down. I would be surprised if Ramco doesn't have a negative reaction today. So watch out for these three from my end. And you know, just a clutch of people giving ideas. I just thought I'll pick up and tell you what the MK note of yesterday suggested, that they are betting fully on SMID stocks and they are telling people to add on to these names, which is Bikaji, JK, Sonata, and Motilal Oswal, in addition to staying long on some of the names like Escorts, Metropolis, Paytm, and Stuffcraft. Everybody seems to be looking at a SMID idea.
Yeah, interesting, because Bikaji, for one, had
very bad numbers.
Yeah, very bad numbers. It was astonishingly bad.
There's no better way to put it.
So yeah, that stood out for me. But maybe the worst is over, or one way or the other. All right, Waaree Energies, I just want to quickly highlight before we move on, because that's going to be a big story this morning. Remember, US has passed, the House of Representatives has passed a bill, that's the budget bill, that accelerates a phase out of investment and production tax credits for clean energy. Remember drill, baby, drill? Well, okay, that's what you're seeing in this bill possibly. It looks to tighten FEOC compliance that could meaningfully curtail utility scale/rooftop installations. Bad for Waaree. Waaree's order book, in fact, 57% of that comes from the United States. 45 times manufacturing tax credit is valid till 2031, which is a relief for Waaree's US plant, but the US export opportunity could narrow earlier than anticipated. So watch out for Waaree Energies. We'll try and get them in as soon as we can to ask them also about what the impact is for Buhari. Although having said that, even when the Trump administration came in, this is a question, I think Neeraj, you might have addressed it with them as well, but the question which I have asked Buhari, and their answer was always that no matter what he says, green energy is here to stay. But the fact is, when it goes into the bill and you have tax credits come down, it's going to be a pain point. Here and now, you can see in the future at some point green energy will always be there.
Yeah.
But this president and this administration is not interested in giving it the concessions it was getting before.
And it also impacts Vari's plans of expanding in the US because they were speaking about that as one lever of growth. Now, will they do that?
Yeah.
I think it'll be important. So we'll talk to the management today and get some answers.
Yeah, absolutely. That's going to be a big one. All right, Grasim Industries, more stocks that we're trying to cover this morning for you, so you're well prepared for the day, for the trading day. Grasim Industries had their Q4 earnings with losses narrowing due to the scaling of new business. Mahima joining us to take us through the numbers.
Right, so overall, the performance in terms of Q4 FY25 has been disappointing. EBITDA was a complete miss due to their viscose staple fiber segment as well as the chemical segment where profitability was highly impacted. However, new business has scaled up well and lowered in terms of losses, that is the painting business. Revenues up 32%, EBITDA down 58%, margins down by about 530 basis points, and net loss came at 288 crores versus that of 441 crores. Exceptional loss stood at around 114 crore from this. Now, in terms of how segments have performed, paint division FY25 has logged revenue of almost 2100 to 2200 odd crores. Birla Opus is decorative paints capacity is now almost more than 21% of the total capacity in India. They've scaled to 6,600 odd towns and 176 quality products. Capex stood at almost 93.5 billion, which is almost 94% of their total projected cost for expanding Birla Opus. Now, the VSF segment, that is your viscose staple fiber segment, that was weak this quarter. EBITDA margin saw a significant downtick. Overall segment EBITDA also fell by 36%, and this is due to increased key input costs. VSF revenue was up 8%. This was largely led by domestic volume uptake, but overall volumes remained flat. The VFI volumes grew by 3%, but overall realizations remain weak and they were impacted by low priced dumping from China. In terms of the chemical business, EBITDA was higher by 52%, but this improvement was led by improved realization of caustic soda, and overall specialty chemical volumes saw a growth of 7%. Lastly, in terms of net debt, that was lowered by receipt of money from rights of money. So this is the overall view as to how Q4 has panned out for Grasim.
Okay, Mahima, thanks so much for getting us those details. Grasim, certainly something you should watch out for in trade today. We've got several other stocks to talk about and trading strategies, of course. We'll bring you all of that after this very quick break. Do stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead.
back. You're watching India Market Open. All right, I'm going to pull up the implied very quickly before we introduce our first set of guests this morning. 44 points up in the green. Kush Bora of kushbora.com in our studios, like he is every Friday. Deepan Mehta joining us on the show today of Elixir Equities. Deepan, hi, always a pleasure to speak with you. Kush, what is that? I've not even started speaking to you. Look at the Friday giggles. This is what's happening. He's just so excited.
He's come up with a joke in his head and he's excited to share it, but he's laughing in
All
anticipation.
right. So let's hear the joke, the reason for the Friday giggles, and of course your index levels while we're at it.
So first, oh my God, Alex is bang on. He was absolutely bang on, because I often start these conversations with something light, right?
We like it. You prepare and come with the chutula.
And the fact that we've been having some off-air conversations about how Friday fever hits you, right? Yeah. Hasn't hit the three of you at least for a while now. But I don't want to start this on a very somber note. But tell me this: anyone's dreams crushed because of the Harvard announcement that came out?
I think we're too old to dream of going to Harvard, but okay.
No, I think we decided to settle for success without an expensive hoodie, correct? So yeah, I don't think any one of us is complaining, but that is some big news. And as Neeraj was mentioning, that caught my attention as well. Speaking of overpriced hoodies, markets are not overpriced anymore. They were up until last week. So if you look at the setup for Nifty, Bank Nifty, whilst mildly stretched, I think a lot of overpricing and a lot of overheating was there in this mid segment. While, of course, the dip that we've seen in this week up until yesterday is a little sharp for someone's comfort, at least mine. It's a little healthy, because what happens is that the small and the mid-cap stocks start to cool off, and then you get a good entry point, at least from a trading standpoint, the way I look at things. Let me start with the broad view as to what do you do now on the Nifty. My view right now is that you go long, you create positional long bets at this level. Couple of trading technical parameters for that. First, the Nifty is taking good support at the 20-day moving average. We've rebounded and closed off the day's low yesterday. The PCR is very close to oversold territory, so any further dip will actually hit oversold territories and you'll see a rebound, something like that we saw in the last hour of trade yesterday. But what's more interesting is that even though there was some cooling off in the Nifty, Bank Nifty, there wasn't any sell-off, any major sell-off in this mid segment, and that is suggesting that the fear factor is not so big. In fact, even the wicks yesterday cool off a little despite the Nifty being down. So all in all, as I said in a nutshell, the summary is that you go long for a positional trade with a stop loss around the 24,400 mark for targets of 24,850, 25,000. My concern is actually the Bank Nifty, and I'll tell you why. We've seen the resistance level shift lower from 56 to 5,500 and now to 55,000. As per the options data, right now, 55,000 seems to be the pivotal level, and the key resistance comes in at 55,555. So if that level is taken out, then you could see some momentum picking up. But for now, the index has gone into a consolidation phase with a negative bias, and that's not a healthy sign. So Bank Nifty slightly cautious, but I think time to go long on the Nifty. Still positive on Bank Nifty, but I want some price trigger, price action as well to follow through with the kind of positive view that I have on Bank Nifty.
So, yesterday and the distribution that we're seeing on the Nifty, on the Bank Nifty, you're seeing put writing at 54,000 levels. Can you explain that as well?
Alex, what's very interesting is that, and of course I track this data closely, Bank Nifty's had call writing at 56 and 55,500, right? It's had put writing at 55,000 and 55,400. Day before yesterday, not yesterday, day before yesterday, even when the Bank Nifty slipped below 55,000, the put writing did not wane off.
Sure.
In fact, it added, which means there was some comfort. Yesterday, when you dipped significantly lower, that's when you saw the put basis shift from 55 to 54. But even now, if you see, there is a good amount of call and put writing at 55,000, and hence I say that it remains a pivotal level.
Interesting. Okay, let's talk about your picks today. And are they both buy calls?
Most definitely, I remain very constructive on these markets, and as I said, the dip is also a healthy one. The first pick that I have is Siemens. After the demerger and the negative flows that you've been seeing for some time, for the last month and a half, the stock's seen a very steady, very gentle, but a very nice volume-backed upswing. So I think this is a good positional trade to enter into for targets of 34.20 and 35.40, with 31.80 being your stop loss. The other one is Dhanuka Agritech. we've seen a vertical rise in the last 7 days or so, but the momentum just continues to build on. Volumes also picked up yesterday. So I think from a near-term perspective, 1725, 1770 are your targets, 1630 is your stop loss.
All right, Deepan Mehta joining us this morning of Elixir Equities. Deepan, hi, always great to speak with you. Let me start by getting your view on what you thought about Sun Pharma. Sun Pharma I'm beginning with because, stock in focus. Numbers were okay on the face of it, and brokerages also can't quite seem to make up their mind. They're constructive on the company post FY27. But what do you make of the numbers?
Yeah, Tamanda, good morning and thank you for having me on your show. I think okay set of numbers coming through from Sun Pharma, but I think the more important aspects for the investor is how they progress they're making on their specialty drugs strategy. And I think that's playing out pretty well over there. They are intelligently acquiring new brands, new molecules, new companies, at the same time existing specialty products also doing very well for Sun Pharma. And you cannot really track this company on a quarter-by-quarter basis. There could be a lot of ups and downs, but long-term trajectory is good. And investors who need to have some exposure to pharma, considering its large weightage in Sensex Nifty, can certainly consider Sun Pharma. But it's not going to be like a multi-bagger, but I think it will easily outperform the Sensex and Nifty for the next few years or so, provided that they are steadfast on their strategy for specialty products. And those turn out pretty well for the company. But there's, of course, this entire Trump tariff on pharmaceutical products, and that also needs to be navigated in order to have complete conviction in buying into Sun Pharma at these levels.
Would you buy right now or you'd stay away from Sun Pharma?
See, I think that given that the market is, our preference would be for going in for growth businesses, small mid-cap companies where corrections have taken place. And that's where we would like to increase exposure. So it's just that existing investors like us, we remain invested in Sun Pharma. But from a fresh investment perspective, I think even in the large cap, some of the companies give a good set of numbers. You could focus over there or then try and increase exposure to small mid-cap stocks, which are very difficult to find because of extremely high valuations.
Hi Deepan, morning, Alex here. Speaking of valuations, we were just discussing that there are pockets of relative overvaluation in the broader markets, but at least with regard to the large caps now, and we pulled up an earnings growth of 8.8% for the benchmark Nifty 50. It is at around 20 times FY26. So would you agree, therefore, that valuation comfort is there in a few large caps? And I know that you were saying that you look for pockets of opportunity in the broader markets, but what about the large caps? Where would you look?
See, Alex, I don't look at undervaluation or overvaluation of the market in that respect, where I aggregate the profits and aggregate the market capitalization of a particular segment and come to a conclusion whether it is overvalued or undervalued. The way I look at it is quite different, and companies which we are interested in, which have good growth potential, which are still not past their prime, you look at what those valuations are. See, just by buying a company which is stagnating at a cheap valuation, you will not get good returns, or you will not make money in those stocks. The idea is to find growth companies, be it large cap, small cap, mid cap, but still available at reasonable valuations. And that is not the situation at this point of time, where whether it's large cap, mid cap, small cap, if there's a good business, if there's good growth dynamics, there's good earnings visibility, great returns, decent corporate governance standards, good quality balance sheet. If you have all or most of these criteria, the stocks are really overvalued. And from that point of view, I feel that it's a challenge to find investable ideas. But nonetheless, I think we continue on that pursuit.
And I will circle back to you to find out whether there are a few stocks that you would like to talk about that have ticked, if not all of those check marks, but at least some of them. Let's first talk about IT, because we want to circle back and ask you about that as well. But first, let's talk about what Bernstein is saying about IT. They've turned bullish on the tech sector, and they say that TCS remains, or rather TCS remains a marquee buy. apparently a Macquarie marquee buy idea. So basically, brokerages are turning positive on the IT sector. Let's find out why. Puneet joining in to tell you that. Puneet?
Well, thank you for that. So there are 6 stocks which Bernstein is giving the view on. They have an outperform rating on 5 of those. It's Infosys, TCS, Tech Mahindra, Coforge, as well as KPIT Tech. They maintain the outperformance as well as high target price on all 5 of these companies, and the increased target price is visible on your screen now. They've also mentioned that L&T Tech is one of the key underperform rating stocks. According to them, they've cut the target price to 3,995 versus 4,150 earlier. There are 3 key points they're making in this particular report. They say that the Indian IT services is looking as finally turning a corner going forward. They're also estimating that the demand outlook largely remains stable, with the financial services vector being one of the strongest, and that will be beneficial to a lot of large cap IT players. They're also seeing that the deal activity has started to pick up, so watch out for that on the annual as well going forward. For them, the 2 top picks are Infosys, and that's because of the financial aspect that we just spoke about, and also Coforge because of the high growth of the company in the mid-cap space. So these are some of the key picks for Bernstein, as well as a positive view led by the financial vertical.
Got it. Puneet, thanks so much for that. Coming back to you, Deepan, on what you make of this, and I'm assuming that you heard what Puneet had to say about the IT services space. I don't think that there is any clarity about what will emerge, but there seems to be less pessimism at least. So how are you looking at the space, and what stocks or what companies stand out to you?
See, it's one brokerage report and you can't conclude that it's looking up over there. For us, almost every IT company is an avoid. And especially large cap IT companies where growth rates have stagnated for the past several quarters are a complete avoid. You may not lose money in it. It's a, kind of a defensive play. But look, you won't get growth as well, except for maybe a persistent systems, maybe, Coforge, which have slightly different business models, or something, like a new gen, which is more operating in the Indian geography. So there are a few, 3 or 4 software companies which are different, have a different business model. Those may still thrive, but by and large, across the board, software services companies are in a secular decline when it comes to their growth rates. And what is more disappointing is that the managements in those companies also feel that, okay, if you get a 2-3% type of a quarter-on-quarter growth, it's a great quarter for them. And if they hit kind of a high single-digit type of growth rates, they have done a great job, which is not the case. I've been following software for the last 25, 30 years, actually, since the industry was born. And I'm used to growth rates of 15, 25% thereabout. And that's just not happening within the sector. What a lot of analysts and the managements of these companies are not talking about is the intense competition which they're getting from global capability centers. And slowly and steadily, the moat around Indian IT companies is evaporating because of these GCCs. Also, there's the threat of AI. Maybe a couple of years ago, I thought that AI and large language models was a growth opportunity, but I'm not sure about it right now. And then you have the entire US slowdown, recession challenges or recession chances over there, and how that may impact IT spends. So on the whole, the picture is not looking good at all for software services companies. And I would advise that at every rise or even at these levels, investors need to be extremely underweight software. There could be a few pockets, as I said, on and off, some companies will come up. But by and large, I think it's an avoid.
What are you liking then, Deepan? IT is an avoid. You're not too keen on pharma. You're saying lots of stories in mid-cap. Just tell us what you're liking right now.
See, first of all, this earnings season for us has been a bit disappointing. We are more optimistic about the banks. We are more optimistic about the cement companies as well as the engineering construction companies as well. But by and large, I think banks are disappointed. Cement has been decent, but large cap cement didn't deliver to our expectation. And all the capex related companies, those are kind of okay. So as we exit from this earnings season, we're exiting with fewer ideas than we perhaps entered in. But there are 2, 3, I think, trends which are quite evident. One is that urban consumption is picking up. So a whole host of retail businesses have done well. And those could be in jewelry, They could be in apparels, footwear. They all have done pretty well. Some of the hospitality companies also have done well. And also the same is the case with aviation and healthcare as well. So with the monsoon doing well and tax cuts expected to come in, already have come in, and maybe further lower interest rates, I think that particular investment theme is something which one can be overweight in. And trend we may see slowdown in trend, but a whole host of tier 2 companies, right from Vishal Mega Mart to V-Mart, they did very good set of numbers. All these specialty retail companies, right from Campus Activewear, Metro Brands, Go Fashion, I think all of those also came out decent set of numbers. And then, of course, we were very impressed with the numbers which came from Indigo, that's Interglobe Aviation. As the same case with Indian Hotels, which is the hotel company. So like that, I think in urban consumption, we find that there could be good ideas over there. Now, it's not that these companies are going to give you fabulous returns, but in times like this, I think they will give returns which are matching or higher than the underlying benchmarks or whatever target returns that you have for your portfolio.
So consumption ideas there from Deepan Mehta. All right, the other big story that we're tracking right here on NDTV Profit this morning is the Reserve Bank of India's board meet. They're preparing to transfer a record surplus for FY25, a move that analysts say could ease fiscal deficits and strengthen bond markets. So experts, in fact, from Kotak and ANZ Research expect the payout to provide liquidity support and enhance investor sentiment in the financial sector. But first things first is the RBI board meet, which is taking place today. Vishwanath Nair joining us for more on that.
Right. So later today, you're going to hear from the Reserve Bank of India about this central board meeting and what exactly was decided. Now, the core agenda here is to clear the annual report of the RBI for the year FY25. And as part of that, also determine what exactly is the surplus transfer that the RBI is going to make to the government. Analyst expectations range between 2.5 to 3.5 lakh crore, but irrespective of where that number actually falls, it's still going to be the highest ever surplus transfer that the RBI has made to the government. Remember that last year in FY24, there was a 2.11 lakh crore surplus transfer that was made, which was the highest at that point in time. So irrespective of where the number falls, you'll still see a high surplus transfer. What we understand, however, from sources is that an internal review was being conducted on the economic capital framework. This is a framework that determines what is the proportion of surplus transfer that the RBI will make to the government. It tells you how much provisioning the RBI has to make every year. As of FY24, that provisioning number stood at about 6.5% of the balance sheet size. There are two camps within the internal committee review. One believes that nothing needs to be changed. The 6.5% stays as is, while the other part of that committee believes that there is a lot of geopolitical confusion going on right now. There are tensions around the world, as well as trade disruptions that are happening. So maybe we need to make higher provisions against the amount. So depending on where exactly that final number falls, they're still waiting for clarity from the government. Where that number falls, you will see the amount change accordingly. But we are still watching out for what exactly comes out of the RBI later today.
Okay, so that's a big factor that markets are also going to keep an eye out on. Thank you for that heads up, Vishwanath Nair there. We're taking a very short break. We're going to pull up the implied just before we get into that break. We'll come back with the pre-open session, top ideas, and of course a lot more on this last trading day of the week. Stay tuned.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session. We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of
Back with India Market Open right here on NDTV Profit. Now, a rejig, and there are multiple rejigs that happened, but there is one more in the offing. The BSE Sensex rebalancing takes effect on June 23rd, bringing notable changes to the 30 stock benchmark index. Nestle and IndusInd Bank will be excluded. Well, IndusInd Bank, little surprise. It will make the way for Trent and BEL. For a breakdown, Sumit Johnson. Sumit.
Well, as multiple stocks remain in focus on the back of the rejig that BSE has announced for multiple of its indices. Now, when it comes to the Sensex index, it's Trent and Bharat Electronics, which will be a part of the Sensex 30 now, while Nestle and IndusInd Bank will be moving out of the index. And these four stocks are the most important to watch out for, given the fact that there could be passive inflow and outflow in these companies. Now, this passive inflow and outflow is expected to happen on June 20th, while the changes in the indices will be effective from the June 23rd. Now, for BEL and Trent, analysts are expecting inflows of anywhere between 290 to 354 million US dollars, and which could be nearly 2.5 to 4.5 times the 20-day moving average. While when it comes to Nestle and IndusInd, the outflows are expected to be in the range of around 130 to 220 million US dollars, and which is nearly 1 to 8 times that 20-day moving average. So keep an eye out for these four stocks. Apart from these four stocks, other notable changes are in BSE 100, where Dixon Tech, Coforge and Industars are included, while Bharat Forge, Dabur India and Siemens are removed from the Sensex 100, while in Sensex 50, Indigo and Shriram Finance are now part of that, while Britannia and Hero MotoCorp moves out. While when it comes to BSE BankX index, only one change, IDFC First Bank gets included, while Canara Bank moves out of the BSE Bank index.
Got it. Sumit, thanks for that. Well, some of these changes are a bit of a lag indicator as well. After the stocks have done really well, that's when the changes happen. It helps the index for sure. Dipan Mehta, good morning, Neeraj here. And just before we thank you, I'm glad that I'm asking this to you. I heard you say that you are exiting the earnings season with lesser ideas or fewer ideas than what you started off with. I wonder if the defense pack falls in that realm, or does defense actually become an idea simply because this whole geopolitical stress plus the fact that the order books might fill and proof of concept might mean more export orders. So therefore, does a BEL, late as it may be into the index, does it, for example, become an idea, or any of the other defense names become an idea, because the results have been very good for most of them?
That's right. I think, first of all, good morning, Neeraj. Yes, I think defense has been clearly the absolute outperforming sector in this earnings season. But look at the earnings growth and look at the PE multiple. Nothing over there is cheap. The private sector defense companies, their PE multiples range from trailing 12 months from 50 times to 200 times or so. The PSU defense companies, their PE multiples are trading from anywhere from 30 times to 70, 80 times or so. And I know that a lot of these companies will deliver on their earnings as well. But in my experience, when you've bought such stocks at such expensive valuations, even after 3 to 5 years, even if the results come through and the performance comes through, the returns are not that great. The idea is to buy companies before, at reasonable valuations, and then hope that the growth comes through. But defense at this point of time is like a moving train. Now, I'm certainly not advocating selling defense stocks because, when there is such concentrated buying and there's so much of euphoria, stock prices can go anywhere. P multiples can expand even from these levels. But from a fresh investment perspective, I think you should go for sectors perhaps where there's under ownership or which have been laggards, but there's scope to turn around. And don't ask me what those sectors are. I'm also searching for them. I just know that I don't want to buy into a sector or a stock which is really on the move, which has been a multi-bagger in the past 4 or 5 years or so, and which is trading at very, very expensive P multiples. So on the whole, I think for me, defense also is a hold, wait and watch over there. If and when P multiples do compress, then certainly they'll come into reckoning.
Fair point. Okay, Dipan, point well noted. Thank you so much. Have a fabulous weekend. Thanks for joining in and giving us your thoughts today. Now, we're getting in a very special guest in a moment from now, Pankaj Murarka, and we're going to talk to him about whether there is a strategy shift needed or no. But before we get Pankaj in the conversation, just quickly mark that the pre-open rates are here, and just keep an eye out on the Nifty and the Bank Nifty. We don't have an IndusInd-like accident of the day today. So maybe a lot of individual stocks will mark post 908 because that's when the rates might get known. But the point, Kush Bora, just before we get in Pankaj Murarka in, there are a lot of stocks which flew in trade yesterday and had significant price volume action. A Shipping Corporation of India, a TTML, etc. Do any of this stand out for you? There are 4 or 5 names, and we have a list there, which had some very good price volume action.
So TTML is a clear avoid. I mean, if you have a position, best to book profits and get out. But SCI is something that I like. It's had a good run, good breakout, and a steady up move. Yesterday was a big break, but other than that, it's been a good up move. And then the other one is MCure. So if you're looking at any fresh initiation, then you could look at MCure for targets of about 1235 on the upside and about 1300, and a stop loss near the 1120 mark. As far as SCI goes, that too doing well, coming up at the resistance of 200-day moving average close to 210, but that's still some distance away. So for a target of 210 with a stop loss around the 185 mark, SCI also looks good on the charts. TTML, as I said, is an avoid book profit at the jump that you've got in the last couple of sessions.
Okay, MCure buzzing in the first couple of minutes of trades was Avenue Supermart, BSE making a comeback after the hit yesterday. Astral, decent set of numbers, and that's buzzing in trade as well. Those are some of the very early buzzers. We'll come to more on that. But Pankaj Murarka joining us this morning. He's CIO, Renaissance Investment Managers. Pankaj, always a pleasure to speak with you, and a very good morning to you. I mean, do you see markets breaking out soon out of this consolidation phase? And in terms of valuations, that's a conversation we were having earlier on the show. Do you think valuations for the Indian markets are not as much of a pain point as they were, say, a few months ago?
Morning, Tamanna. Always a pleasure talking to you. I think, let me start from a valuation point and then I'll come to markets. I think we need to concede it's a given that India is the most expensive equity market in the world, and it's nothing new. We've been the most expensive equity market in the world in the last 20 years. Even when China economic miracle was unfolding and China was the fastest growing economy in the world, India was not. Even then, Indian equity markets were the most expensive equity market in the world. Today, clearly we have a situation where obviously India is the fastest growing economy in the world. And I think it will remain the most expensive equity market in the world because India is the only secular growth story out there in the world. You try to look at the world from the top of Eiffel Tower view. Then when global investors, largely US-based investors, they look at outside of their home market, the only country where they can take a secular bet for the next 20 years, which they know will grow year after year for the next 20 years, it's India. So obviously we'll have the amount of money that is chasing India will be far higher than what this market can absorb, and valuations will always remain expensive. If you ask me today, I think the valuations are pretty much in line with last, mean average of 15 years. So to that extent, they are okay. But yes, in absolute terms, India has and will remain expensive. In terms of current context of markets, I think it'll be good if markets can consolidate here around this, spend some more time, because we've had a very sharp rebound in the last 8 weeks from the lows that we've had. But I still hold that view. One, we fundamentally remain structurally in a bull market, which effectively means that annualized returns will be positive on the index. And I still think this year could be a year where index, meaning if you look at Nifty index, we started the year at about 23,600 or so on 1st January. And I think we could be in for about 15% gains for the year in the index, which effectively means we will make new lifetime high, I firmly believe, before the end of this calendar year on the index. So I think fundamentally we remain very much in a bull market, which effectively means any fall is a correction in the bull market and is an opportunity to buy into that bull market.
Got it. Pankaj, hi. Morning, Neeraj here. But just wondering, Pankaj, I mean, we were just doing the math. After this corrective move the last few days, we are probably circa 20 times with an assumption of anywhere between 8 to 12% earnings growth for FY26. At 20 times for a market which is growing, which has the predictability of growth that you spoke about, oil prices lower, RBI cutting rates, inflation stable for so many years now, why should it be considered expensive as well? I mean, it may be the most expensive on numerical terms, but 20 times may not be really very expensive valuations, right?
Yeah, I think that's a new normal or base for India, Neeraj, in that sense. Given historical trends, logically, we are in the midst of a growth slowdown. Last year, we had one of the slowest earnings growth in Nifty index or Nifty 50 earnings in that sense at about 5%. As we, see a cyclical uptick in the economy from the slowdown that we've had in the last 5 quarters, still earnings growth, recovery will be modest. You're absolutely right. I absolutely agree with you. Given that the significant macro shocks that the world has had, let's say in the last few months, given the tariff plan unveiled by US, probably again it came out that India is the only economy which is the most resilient one and is the least impacted by those global macroeconomic shocks. So obviously, India enjoys a valuation premium versus other peer markets. If you look at some of the other regional markets, they're trading at valuations and they've historically traded valuations which are significantly discount or lower than India. But I think probably a 20 times 1 year forward earning is a normalized valuation for India in relative terms, if you look at India's own historical averages. But I still think in relation to the world, it's expensive.
Pankaj, give us a minute. We do want to mark BEL. I have a question that I want to ask about the earnings season so far, but let's talk about BEL because it has been on a tear. The entire pack has been on a tear, and the latest upgrade that has come through has pegged the target price at 450 rupees. To tell you who's saying this and why they are, Anushi is joining in. Anushi, big brokerage call of the day. Tell us why.
Hey, morning Alex. So what we are seeing for Bharat Electronics now, this is one stock which has continued to remain in focus with the last couple of sessions, especially after the con call that it held. Now here, UBS has come out with a note wherein they've upgraded the stock to a buy rating with a revised target price of 450 as compared to 320 earlier, which they had, which implies about an 18% of an upside for the stock. Now, a lot of the emphasis in this note, if we see, is on the order book pipeline. They expect a 2.4 lakh crore of long-term pipeline over the years FY25 to 28. So with this, they see that FY26 to 28 is going to be an inflection point for the business with a 33% of an order intake CAGR growth that they expect. Do note that while they did state that FY25 was a miss in terms of where the guidance was given, it's the future trajectory that is interesting for BL to watch out for. Even in terms of the conference call, 57,000 crore is the expected inflows that are that we'll be seeing in FY26. This is in comparison with the 18,000 crore of inflows that we saw over the last fiscal year. Major platforms like Akash Missile System, ISCC control system have now been combat proven. This is especially after the Operation Sindoor. So reliability on the domestic and the export side of the business is something that we'll be seeing building for this company. They also prefer Bharat Electronics over Hindustan Aeronautics. This is based on better growth and bottom line prospects for the company, while HAL also has a strong order pipeline. We did see that they do expect a conservative guidance of about 8 to 10%. Again, they believe that the long-term pipeline with faster translation to revenue is still underappreciated by the market. So Bharat Electronics still a stock in focus, and that is why we are looking at this upgraded rating.
All right, thanks so much for getting us that update. Pankaj, very good morning to you. I want to ask you about what you've seen in the earnings season and whether that's given you a reason to be a little bit optimistic heading into and looking at FY26 as well. You've spoken about a 15% increase at the index level. I'm just wondering what your base case assumption is for earnings growth as well, and what the drivers of that are going to be, because we've seen a few companies come through, quite a few companies come through, surprising on the bottom line, and that is because of margin expansion that has taken place, and largely because input costs have been benign, and perhaps that is likely to stay the case in the first half as well.
So yeah, overall I remain sanguine and optimist on the market, as I said, directionally, because we fundamentally remain in bull market. And I think, as I said, every dip is an opportunity to buy into this market, given the long-term structural story. talking about the earnings season that we've just, at the fag end of this earnings season, I think the good thing about this earnings season has been, unlike the last two earnings season in September and December quarter, there's been no more incremental downgrades in the earnings. So on aggregate balance, if you see last quarter, earnings growth for, if you take the top 200 companies, has been about 7% in aggregate. Obviously, there are pockets where companies are surprised positively or earnings growth has been high, and there are pockets where earnings growth has been lower than expectation. But in aggregate, I think it's been pretty okay. More importantly, I think markets are always forward looking. So while now the low earnings growth is in the base, probably I think we are set for probably a low double digit, probably about 12% kind of earnings growth at the Nifty 50 or the Nifty 200 companies level going into this year in FY26, which is pretty reasonable, I think, given the fact that we are in a matured stage of this economic cycle. We are in the sixth year of this economic expansion, if I count it from the COVID-driven contraction that we had in 2020. So yes, a lot of earnings lever that exist at the early stages of an economic cycle in terms of capacity utilization or margin expansions to a great extent have been utilized. Obviously, companies have been making incremental investments in enhancing their capacities, and all of that will flow through. But I still think that about a 12% kind of earnings growth probably over the next 2 years is still not bad. And with that kind of earnings growth, I still think that the Nifty 50 index can comfortably do a 12 to 14% kind of returns for investors over the next 2 years, which I still think is very good outcome.
Okay, let's navigate the start. Pankaj, point very well made, and I would like to circle back to you to find out what is going to be driving that 12% as well. But just to navigate the market start, Kush, circling back to you to see what you're spotting at the start. There are quite a few stocks that are reacting to fundamental updates, but what are you looking at that's looking interesting?
Just a quick word on the Nifty. I mean, the start is pretty much in line with what the GIFT Nifty was suggesting. It's a good thing to see that, a lot of stocks, at least on my watch list, are in the green. I think a Dalmia Bharat will perhaps come back in action. It's been doing well for some time now. Dalmia Bharat Limited, not sugar. So that stock's been doing well. Even in the market volatility, it's holding its ground. So I think this is one stock that should continue to remain in your trading portfolios.
Okay, what about something like an HFCL? Of course, we'll talk about it in more detail. It's reacting to earnings and seeing a downtick right now. Would you get out if you have the stock?
Yes, I would, because the volumes on the way down for the last 3 sessions, have been significantly high. There is an immediate support that comes in close to the 80 mark, but once that is broken, I think you're looking at a 75 kind of a drop as well.
Okay, so top pick at this juncture?
AB Capital, this is one stock that we discussed yesterday, held its ground for the most part. So for targets of 225, 229, you could continue to buy or hold with a stop loss around the 218 mark.
Okay, well, we're about 40 seconds away from the market open, and in conversation with Kush Bohra and Pankaj Murarka, and we will talk to Pankaj about the $1 million question as well. Does IT become a place to hide, to invest, or to sell? Because I don't know of too many people who've tracked IT for longer than Pankaj has. Of course, a broad brush, but definitely talk about IT in particular with him and all things tech. But I think today's trade is also marked by whether the small cap space can continue to show outperformance versus the large caps or no. So that is to be kept in mind. And of course, we'll mark a lot of result reactions because a clutch of stocks have either come out with very weak numbers or actually pretty decent numbers too. So I think all of that will be marked. But let's see how we start off today. Do we show some strength on open, or will we buckle down in the first 5 minutes of trade? I think the answers will come in now. Here come the first trades this Friday morning. Well, not bad. It's a flattish start, but good to see green on the screen. Let's see if this lasts. Nifty IT about flat too. Let's see if mid caps and small caps are actually outperforming. 0.13% for the mid caps. The small cap index is the one. No, it's absolutely flat. Well, I doubt I'll have too much luck on the grid, but let's pull up the heat map. A lot of green, very little red. Sun Pharma not reacting very well to its numbers. As Tamanna highlighted, I think a lot of growth triggers for Sun Pharma post FY27. Not all brokerages are sanguine either. A bit of a downtick there. Hindalco, Cipla, ONGC, but those are few and far in between. What about the gainers? Well, Trent, entry into the Sensex, some sentimental uptick. History has shown that an index inclusion doesn't necessarily mean that the stock has a very good run. So bear that in mind. Conversely, even an exclusion doesn't have very bad moves. Grasim on the numbers, the narrowing of the loss. ITC on the numbers as well. BEL on the brokerage notes. I think UBS said that they prefer BEL over HAL. There is Infi, Adani Enterprises, JSW Steel and the rest. So, well, I think the only notable moves is that Sun Pharma on the weaker hand, 4% lower, and Grasim and Trent in particular on the upper side, Tamanna.
I mean, so Sun Pharma, look at it this way. They've guided for a top-line revenue growth of 8 to 9% odd. What the street was penciling in was as high as 12%. So the guidance is a problem. They have tax issues which will continue. The tax credits have come down. There's a whole host of issues as far as Sun Pharma is concerned. That's why that 4% downtick that you're seeing on the stock. But let me pull up the sectoral heat map very quickly, and then we'll get to what the broader markets are specifically doing this Friday morning. FMCG is doing okay. That's the trend impact more than anything else because of the Sensex inclusion, and of course ITC numbers better than expected, so that's why you're seeing that up. Defense continues to stabilize. Nifty IT, two brokerage notes which seem okay, pretty happy with IT services. Maybe you're seeing that impact play out, but otherwise it's a quiet morning with more red than green. Nifty Pharma pulled down largely by Sun Pharma. Nifty Healthcare also seeing that pain point. I want to specifically pull up the mid-cap and small-cap indices to see if the broader markets are holding on. Just not really in the red, not massively, but in the negative territory, definitely mildly in the red at this point. Let's look at India VIX very quickly because this is an important factor to put out in the when markets are middling. You're seeing the India VIX doing decently actually, 17.23. Not too much to worry about. So fundamentally, no big reasons to worry. Street waiting for one directional clue either way. And some of those clues or cues are coming specifically for stocks depending on fundamental reasons. So I'm pulling up some of them. Results impact. I'm starting with a list of howlers. These are bad numbers. Let's see how the street is reacting to them. HFCL, not as bad as the numbers really are. 1% down right now. Premier Energy, another set of weak numbers. Stock about 3% down. Ramco Cements about 2.5% down. So on the other hand, Honasa, MTAR, Centem, let's pull up some of those. Good set of numbers. Honasa, we told you, better set of numbers. Mama Earth is improving, 12% up. They do have a hit on their EBITDA because of higher other expenses, but Street is ignoring that right now. We gave it a thumbs up in our watch list this morning. MTAR was on Alex's watch list as well. Defense is anyway in flavor. Numbers looked good. Centum in Neeraj's watch list about 12.5% up. Defense continues to be in focus, like I said. Garden Reach, look at Garden Reach. Second day of an uptick. Zentech, after sitting on that 5% upper circuit, finally seeing some pullback. BEL after that UBS note not doing half badly. Waaree Energies is one that I want to pull up. We talked about the impact of the US budget bill. They want to cut out some of the incentives that they're giving to makers of rooftop solar panels. That's a big business for Waaree. That's impacting them as well. So the whole push of the Trump administration to move away from green energy is what the big pain point is. We're going to be talking hopefully with Waaree ahead in the show and getting a sense from them on how deep those cuts are. About 6% down on Waaree Energies. So that's one to watch out for. I want to pull up KNR Construction. So there was a collapse on a Kerala highway yesterday, and the central government has come in and said we're going to bar all vendors associated with it. KNR Construction is one of them. So that's why the pain point on KNR Construction this morning. Just Power Mech. Let me pull up Power Mech also on their numbers and see what's happening there. All right, good set of numbers, 11% up right now. So some newsmakers there, but you have to do some stock spotting in this market, Alex. It's not going to be easy peasy.
And normally I would look into the broader markets, but I do want to talk about Sun Pharmaceuticals. You pointed it out, it was on your list, but it's sulking, and how the entire pharma pack as a whole, as a result, is bearing the brunt. It's down 4.6%, 4.7% on the back of the numbers and the outlook going forward. Pankaj, if you have specific comments on Sun Pharma, I'm sure my viewers will appreciate it. If not, what would you say about the triggers in this space? Some people are looking at it positively at this point, and CDMO certainly, based on the earnings that we've looked at, has looked quite good.
Well, yeah, that's true. So overall, I think, talking specifically about Sun Pharma, meaning one caveat before I say that is we are the owners of the stock. I still think the long-term story remains pretty much in place. I think, as Tamanna was highlighting, the guidance that the company has given is somewhat underwhelming. But we also need to keep in mind that Sun Pharma has a track record as a company of under-promising and over-delivering. So as a management, when they guide, they tend to be conservative in terms of the guidance. It's still meaning the largest, it has got a phenomenal business being the largest pharma company domestically and the largest US business and so on and so forth. So I think the medium-term outlook for Sun Pharma, from my point of view, remains very positive. We'll be buyers on the dip. In that sense. Overall, I think the pharma space looks pretty decent. As you rightly said, CDMO is probably somewhere we're getting to an inflection point in that whole space where, given the cost pressures that the US companies are facing, we'll see accelerated outsourcing to India of both manufacturing, development, and research work. And that would mean that over the next, meaning I think it's a decadal story where the whole space will see accelerated growth over the next 10 years. And we've seen stocks in the space have really done well. So any dip is a buy opportunity in CDMO space. Take a medium-term, long-term view. And it's a great opportunity to buy into these companies and stay invested for probably a long term.
Okay. Pankaj, I don't know if too many people who looked at IT as closely and for as long as you have. Now, a lot of notes have come out in the last 1 week which say that the commentary from the end clients as well as the IT companies is now increasingly looking okay, not looking as bad, so on and so forth. There was a note from Macquarie which said that maybe it's a decade of IT service companies versus product companies over the last decade because they will help clients navigate through the AI jungle. I would love to know, how do you think about the Indian IT space, large cap IT services, mid-sized companies, product companies, ER&D? Are you constructive, and if so, what's the first amongst equals?
Oh, Neeraj, I think you just summarized very well. I've been saying this for a long while that AI is the internet moment for entire technology world and for IT services company in India. There have been a lot of concerns that AI will cannibalize and negatively impact IT services company in India. But I don't think so that's going to be the case. I think there will be, resetting of skill sets within the IT companies, and IT companies are pretty agile. They've navigated multiple technology shifts and trends over the last 20 years as the world moved, from ERP or cloud to ERP to cloud to digital and so on and so forth. And I think this is going to be the internet moment of the world, which effectively I mean the tech spends that we over the next 10 years, the surge that we'll see will be very significant. And as you rightly said, IT services company have a very important role to play because now that AI is here, or Chat GPT or whatever other fundamental foundation models are in place, those need to be implemented, and that can only be done and integrated into businesses, and that will mean huge amount of workflow for IT services companies. So I think while the near term got clouded because of the tariff-driven impact or fear of US economy slipping into recession, but incrementally clients in US are realizing, given that we have now withdrawal of tariffs or reversals, the US economy is being able to weather that. So the short-term impact is not so negative. And I think medium term, we have started seeing AI-driven deals, flowing in. So I clearly think that the next 5 or 7 years can be very significant, maybe in terms of growth trajectory for IT companies. And given that the stocks are already down about 15 to 20% from where they were, 3 months back, I certainly think that this is one pocket of the market where I clearly see that there's a gap between the overhang of fear and what the valuations are. So valuations present an attractive opportunity. You look a lot of large cap IT companies. Now they already had 4.5%, 5% earnings yield kind of a thing. And that's where typically we've seen the sector or companies tend to bottom out. So I clearly think this is a good time to buy into some of these companies, take a slightly more medium-term, longer-term view, and the growth trajectory for the sector will certainly accelerate. And obviously, it will give rise to new champions as well. Every cycle in technology has given birth to new companies. Last cycle we saw in the last 5 or 6 years, we see Persistent and Coforge emerge, where they delivered very outlier growth over the last 6-7 years. And from companies which were small in size at about $400-500 million of revenues in 6-7 years, these companies have delivered breakout growth. growth, and all of them are now in $1.5 billion club, aiming for a $2 billion revenue. So I'm very sure that while large caps company will do well, there will be new companies that will emerge riding on the AI wave, and which will deliver breakout growth and probably get into $1 billion, $2 billion kind of a revenue club.
Sorry, do you like any of these businesses? I mean, they may eventually emerge winners. They may be a part of your portfolio. If you are at liberty, do you like any of these businesses or the guys who are pursuing these opportunities?
Well, we're engaging with a lot of these small cap IT companies, management, in terms of understanding their strategy and how they're preparing themselves to capitalize on, the oncoming AI wave and all of that. Obviously, you will appreciate that when you invest, you want to invest in a portfolio of 4 or 5 companies, because it's all about ability of the management to execute, and eventually few of them will emerge as winners. So clearly, we are trying to build a portfolio of a handful of small cap IT companies, I would say, which in the revenue, the sweet spot for buying IT companies, if you want to make exponential returns, is buying these companies when they're about $400-500 million of revenue, and then if they can deliver breakout growth and get to that $1.5 billion kind of a revenue. So that's the point, where you make significant outlier returns in IT companies. That have happened in the last 5 or 6 years, if you see, with Persistent and Coforge. So the point is, which are those companies at this point of time, which are in that $300-500 million of revenue bucket, and which over the next 5-7 years riding the AI wave can change their orbit. So obviously it's a portfolio approach that we're taking with about 4 or 5 companies that we're playing in. In large caps, I still think that some of the larger companies that we own are Tech Mahindra and Infosys that we own. And incrementally, we're getting constructive on Wipro as well, and we have ownership there as well, because we think probably after a long time, Wipro has got an insider as a CEO, and he's setting in a lot of things right in terms of the long-term business trajectory. Obviously, given the size and scale, these kind of transformational changes does take time. We need to give it 6 to 8 quarters. The new CEO is already in the role in 3 quarters now, but we think that's one company where probably it can catch up with industry. It has been an industry laggard for now 5 years. If it can catch up with industry growth within the large caps, probably Wipro can deliver the highest possible return amongst the 5 large cap IT companies in India.
Just what you said, I found it very interesting, Pankaj, and I'm wondering if you're extending that to other ideas as well. Watch out for those that could be the winners of tomorrow and who are in that sweet spot. What are, the other spaces where you see that potential?
Well, as growth investors, Tamanna, we're always looking for outlier growth or breakout growth.
Are you seeing enough candidates right now, and in which space?
Trust me, more than enough. India is such an exciting place. There's so much of energy. There's so much of entrepreneurship. There's so much of risk-taking ability. I've always had, in my 28 years of career, more ideas than the money I've had to invest. So talking about spaces, internet continues to excite me. There's so many of these things happening. I still think well-run internet companies can keep growing, whether they're fintech, whether they're consumer tech, or across other different segments. They can still keep growing at 25-30% for the next 10 years because there's so much growth out there. Of late, I've started liking consumer as a space. Just to give you a context, India's total consumption is about $2.6 trillion. If it was economy, it would have been the 8th largest economy in the world, and that is growing at 10-11%. Much higher, probably much higher than a lot of other economies are growing. Within that consumer space, companies which are doing innovative things, which are making strategic bets in their businesses, can deliver much higher growth and create significant amount of shareholder wealth over the next 10 years. So we are clearly looking for companies either by their business or through management actions, which are probably can deliver breakout growth over the next 5 or 10 years, and whereby the companies can change their orbit, which is where you make the outlier returns. Because as I said, let's understand, the markets are priced to perfection. Then how do you make outlier returns is by finding companies, going deep down, finding companies which are executing strategic business plan to deliver outlier growth. And I think there are significant opportunities there. Every day I look at few companies and I feel very excited about these companies. One has to be careful in terms of stock selection, but there's no dearth of opportunities, I must concede.
Pankaj Murarka, lovely talking to you today. Thank you so much for taking the time out and being with us. Kush Bora, we'll have to leave it at that because we need to slip into a break, but thanks to you as well. And have a great Friday, Kush, or a happy weekending, if you will. We take a break on that, and on the other side, Rishi Sanghvi, MD of Sanghvi Movers Johnson, to talk about the quarter gone by and the outlook ahead.
गोल्ड क्लास ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers
Back with India Market Open. Sanghvi Movers is a company in focus, and we wanted to talk to Sanghvi Movers for their business as well as what is it that their belief is around what could happen to wind energy installations for FY26 and slightly beyond. The stock is down 4% today after the 6% downtick yesterday. It had rallied, of course, ahead of the numbers as well. Rishi Sanghvi, MD of the company Johnson, right now to talk about the numbers and the outlook ahead. Rishi, good having you. Thanks so much for taking the time out. We didn't quite get the YOY comparisons because I think due to the EPC business shift, you had not, we didn't have the Q4 comparisons, but quarter on quarter, your numbers looked good, showed a bit of an uptick on most counts, including margins. The street seems to be a bit disappointed. Is it because of the call yesterday and the cautious optimism that you laid out, or is it something else?
Good morning and thanks for having me. You know, I never comment on market movement and speculation. All I can talk about is our performance.
Let's do that. Let's do that. So how do you sum up the quarter? Yeah.
Yeah, I think we had our best quarter for the financial year when we ended with a profit after tax of 53.72 crores. Our capacity utilization was around 79%. And our yield, our blended average yield was around 2%. So I think things are moving largely in the right direction, especially if we factor into the account that there was a general election in the last year, as well as there was significant slowdown in government spending, as well as a prolonged monsoon in last year. But the last quarter's performance is indicative that things are moving in the right direction and that the economy will continue to fire on all cylinders in the coming financial year.
Okay, let me try and pick up a few things that analysts have pointed out. Our own colleague Varsha spoke about as well after attending your con call, that you are optimistic about improving the capacity utilization levels for FY26, but the cranes business, yeah, which is the higher margin business, there the growth rates did you guide to maybe 10-15%, part one? And is there higher competition coming in, Rishi, out there for you?
So, you know, if you look at our base year, which was FY23-24, it was an exceptional year where we were able to hit a 63% EBITDA, 84% capacity utilization, and a 2.2% yield. This was an outlier year. So this year, we have ended at a 73% capacity utilization and a yield of about 2.05%. Going forward, we see that our capacity utilization will land anywhere between 75 to 80% at a 2% average blended yield. And we do expect the top line to grow anywhere between 10 to 15%. Now, you know, I'm wary of giving forward guidance because if we overcommit and underdeliver, it's an issue. And if we underpromise and overdeliver, it's always an issue. So, you know, by way of abundant, prudent caution, I think we're giving a realistic growth in the crane business of 15%. Bear in mind, the overall revenue will grow between 25 to 30%. And we have a significant order book to back that.
Rishi, hi, good morning. Tamanna here. I would say between the two, not that you're asking me, but between the two, it's always better to under-promise and over-deliver, I suppose. But, having said that, explain to us the strategy about moving to wind EPC, which is a relatively lower margin business, if I'm not mistaken. Can you explain that thought process to us and what the margins will look like? Because that's what's impacted margin numbers this quarter as well, isn't it?
Yes, so, our push get into the wind EPC is basically to deliver turnkey EPC services where we are involved in the renewable energy wind farm construction from conceptualization to commission. Now, our customers are asking us to do this. We have a track record of erecting more than 15 gigawatts in the country. And all the IPPs are looking for a credible partner to help them build their wind farms. So we are tracking towards this wind EPC business where we are giving a turnkey solution from conceptualization to commission. The revenue last year was around 240 crores and we had an EBITDA of about 17%. Now the business is still in its incubation stage, and as we scale up, we believe that the revenue for next year will double. And as we scale up, we believe that the EBITDA, again, on a abundantly cautious guidance would be anywhere between 10 to 12%. So that's where we believe that the EPC business will double in revenue next year and it will continue to grow year on year.
But having said that, if I compare it to your core business of cranes, what is the margin comparison?
There is no margin comparison. And frankly, I don't know any other business that can give you an EBITDA of 63%. That is a capital intensive business.
So no, which is what the concern, and I know you're not going to respond on the stock and you should not, but then I'm just voicing that concern that you're moving to a business which is relatively low margin, and how much of an upside do you see there?
So if you believe in the renewable growth story of India and if you believe in what's happening on the renewable space, then the headroom for growth is infinite. Having said that, we are not moving away from the crane business. We continue to invest in the crane business at a 75 to 80% capacity utilization with a 2% yield. We are still projected to do another 240 crores of capex in the crane business, of which 215 is in cranes. We have also internationalized our crane business and we are moving towards Saudi Arabia. And it's too early to comment, but that is going to become a significant portion of our business going forward as well. So I think holistically, if you look at it with an overall lens, there's a couple of things that the group is doing. And I believe that this will create tremendous shareholder value going forward.
Rishi, what is the macro looking like? Would wind energy installations exceed the 5 gigawatts? Did you talk about that in a con call? Please tell us. And does the macro look set for that to continue and therefore for growth for your business as well to continue?
Yeah. So, we're coming off the first Q1 calendar quarter of Jan, Feb, March, where we've had historical capacity addition of 1.8 gigawatts. Year on year, that's a growth from 1.15 to 1.8 gigawatts. So the country is adding significant amount of capacity addition. Now, will the country cross, I believe the capacity addition for the financial year gone by is anywhere between 4.3 to 4.5 gigawatts. Next year, we are projected to do, in my opinion, anywhere between 4.5 to 5 gigawatts. However, there are a lot of issues related to on-ground offtake and project delay execution. Now, these issues are related to things like substation connectivity, PPA signing, creation of the infrastructure at site, which is the land aggregation, the evacuation infrastructure, dealing with the local issues at site at the grassroots levels. There are turbine supply delays as well. So all of these factors may impact the capacity addition in the coming financial year. But safe to say anywhere between 4.5 to 5 gigawatts in this coming financial year.
Okay. And we've done, I think, 1 gigawatts in the month of April. So maybe crossing 5 in the remaining 11, as you're saying, may not be as difficult per se. Okay. What about, Rishi, what about FY27? Is there a 2-year plan that you have in mind? Because as you said, you're expanding globally. There is the new business that you ventured into, the wind EPC, which might take better wings in the current year. What about the following year? Is there a 2-year, 3-year plan?
Yes, definitely we have a strategic plan. In fact, we have a plan till 2030. But I would like to say that next year we have, in terms, I would again like to give guidance for next year and not the following year. But next year we're looking at an overall top line growth of 25 to 30%. We're looking at a 10 to 15% growth in the crane business. We're looking to double our revenue for the wind EPC business, ending with an EBITDA of between 10 to 12%. The project EPC business is also looking to double with an 8 to 10% EBITDA. So overall, we are forecasting a 25 to 30% growth on the top line. And I think this is going to be significant. If you look at us about a year ago or 2 years ago, we are doubling revenue. Of course, the blended EBITDA will take a hit, but directionally, I think we're heading in the right direction, along with our international expansion in Saudi Arabia, which will definitely add to margins and top line in subsequent quarters.
I want to know more about that, if that's all right. Saudi Arabia, and I think you have a subsidiary in Vietnam as well. What is the growth prospect there? Do you see those two businesses or those two subsidiaries as a big driver for FY26?
So to clarify, we have wound up our operations in Vietnam, but we are extremely bullish on the Saudi Arabia growth story. There's a number of massive infrastructure projects that is happening in Saudi Arabia, from the World Cup, World Expo, Asian Games, to all the giga projects, the PIF projects, and all the construction activity that is happening in Saudi Arabia. We believe that we will develop significant traction in Saudi Arabia, being the 4th largest crane rental company in the world. And we definitely believe that the market is sizable for us to replicate our scale and size in India, in Saudi Arabia. So going forward, we see that there will be significant traction coming from Saudi Arabia. You know, we're not early to the market. A significant amount of L&T's revenue, KEC, all of AFCONs, all of these Indian EPC players are already present in Saudi.
All right, thank you so much, Rishi, for speaking with us. Rishi Sanghvi, MD of Sanghvi Movers, talking about the quarter gone by, plans ahead. They're focusing on wind EPC. Revenues are expected to grow, but then it is a relatively lower margin business. That's why perhaps you're seeing that pain point in the stock down about 6.5% now. The other stock that I think we should talk about, Neeraj, and really focus on is Waaree Energies. We talked about this in the morning. We highlighted this for you, about 8% down now. So the US House of Representatives has passed a bill that accelerates a phase out of investments and production tax credits for clean energy. They want to tighten something called an FEOC compliance that could curtail utility scale as well as rooftop installations. And that's 57% of Waaree's order book.
Yeah, it's significant, and this probably also impacts, or definitely impacts, the expansion plans that they had in US, which the management spoke about. They have a facility in US already. They were looking to expand it. Now, if the overall, one is that the duties, and to counter the duties, you set up plants in the US. But 2 is if the overall system installations are coming off, then even the US plant won't benefit you as much. And I think which is why this 7.5% downtake for Waaree. No surprise there. It's no longer a cheap stock. Was at 2100 maybe.
Yeah.
At 2900 wasn't cheap exactly.
No, but a fundamental shake-up like this will be a pain point. We're looking forward to hearing from the management ahead on the show. We will be talking to them, so stay tuned for that. Very short break, but we're coming back with a conversation with Metro Brands. We're telling you all the top stocks of this morning, corporate conversations, stock focus, all of that after this break.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use math to predict human behavior?
The 2007 split was a tough one, wasn't it?
I look back, maybe I wanted to take charge of it too quickly. My ego came in the way. Net, a year later, the 3 people who selected me as a CEO said, we don't want any CEO.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock.
Welcome back. You're watching India Market Open. All right, we're talking about Metro Brands this morning. The revenue and EBITDA has grown for the quarter, but profits did see a decline on account of one-time tax expenses. We'll speak to Nissan Joseph, CEO of Metro Brands, in just a moment. But Mahima joining us first to set up that conversation and tell us about the numbers.
Right, so in terms of Metro Brands, the sales growth momentum has been good, and this is on account of festive season as well as wedding season gone by. E-commerce sales has almost grown by 45% this particular quarter, and overall 74% of their revenue is now from their in-house brands at multi-brand stores. And overall second half of FY25 has witnessed recovery as compared to first half of FY25. In terms of numbers, revenue was up 10%, EBITDA up 24%. Margins came at 30.7%. So the question really here is that whether the margin at almost 31% are sustainable or not. And net profits was down at 39%, and this was because of a one-off where in the current quarter there was a tax expense of 31 crore versus that of a tax credit in Q4 FY24 of almost 51 odd crores. Now what has led to the margin beat? Better cost control, reduction in losses of FILA segment, plus restructuring of FILA's royalty with FILA Global has also taken place, and this alignment of royalty expenses will be expected expected to see a revenue growth over the next 2 to 3 years. In terms of stores, they added around 18 odd stores this particular quarter and closed around 5 stores. Total count of stores as of FY25 stands at 908. In terms of the BIS implementation update, the stock that is there till 31st of July 2024 needs to be cleared till 31st July 2026. In terms of new tie-up, they tied up with New Era. Launch of Foot Locker has also taken place, and in terms of FILA, liquidation of old inventory of FILA has been completed in Q3 FY25. So this is with respect to where Metro Brand stands as of Q4 and how FY25 is fair for them.
All right, Nissan Joseph joining us, CEO of Metro Brands. Always great to talk to you, Mr. Joseph. Tamanna here, and I hope you're having a good morning. All right, let's go through your numbers. Margins have improved. Now just explain to us that this tax expense versus tax credit, is this a one-time thing, or are we expecting to see this on your balance sheet going forward as well?
No, good morning, Taman, and thanks for having me. It is a one-time thing. So last year, with the demerger of Fila, we were able to get some relief on the tax side of it. And on this year, we had an expense on it. But it's a one-time thing. Both of them are one-offs for the quarters. We don't anticipate seeing anything else come up. But what's important really is if you look at our EBITDA growth for the quarter, it far outpaced our sales growth, continuing to show that there are lots of economies of scale and lots of cost controls and leveraging that happens as we grow our business.
Okay, so just coming to that EBITDA growth that you're obviously rightly pleased with, revenues as well. Is this getting pushed by better demand coming in, better footfalls at stores, e-commerce? Where is that boost coming from?
The short answer is yes, but the longer answer is, it's coming from a few places. One of them is, better margins that come from better margin controls and less discounting that happens. As you know, last quarter is the clearance quarter that we have typically in the Indian retail cycle. We have two of those. And Q4 is when we used to liquidate a lot of end of season sale goods. So that despite that, we were able to control our margins, which is a reflection that we didn't have as much go on sale. That's one. There's a lot of cost controls that we put in place on our expenses that also plays a factor. We also have finally got through the Fila cleanups that was dampening our EBITDA. And that's great news that we're now done with the liquidation of Fila old product. Now we start to focus on the repositioning of the brand in our stores and in the country. So that's the other factor that's helping us too. So, and overall, when you have revenue growth of almost 10%, that definitely flows through to the bottom line.
Mr. Joseph, good morning, Neeraj here. So I presume you've also aligned the royalty expenses for Fila with the expected revenue growth for the next 2-3 years. So suffice to say that will not be a bugbear on the operational metrics for at least the next 3 years.
Correct. No, and I think we just wanted to restructure it because the liquidation took a little bit longer. But now that we're past that liquidation, we should be right back on track.
Now, a lot of talk around the consumer and the economy itself, and divergent views there. I would love to know how you think about it, and therefore what would it do to store additions and same-store sales growth? Because I see that you added about 18 stores, you closed about 5 during Q4. How do you think about this piece?
Yeah, so there's a number of moving parts to that question, right? So first and foremost, let's just talk about the consumer. There's a lot of lumpiness in when you go against last year's sales, right? Because last year you may have wedding dates, you may have had heat waves, you may have had elections. You have those kind of lumpiness that come in through. Not to talk about the fact that in last quarter, we also had a leap year day last year that we didn't have this year, right? So there's always those kind of fluctuations that happen. What's important for us to see is that all our banners are starting to see growth, which means that consumer at that premium level is coming back on a more regular basis. We've always talked about the turbulence post-COVID, right? The up and down, the lumpiness that comes with it. Now we're starting to see it get on a more stable business pattern. So, that's one part of it. The other part of it is through the last couple of years, retail rents have been rising significantly because a lot of people have decided to open a lot of stores from the euphoria of COVID, post-COVID sales. We're starting to see that slow down a little bit too. So we should see our new store expansion get back on track. The bottom line is, Neeraj, we're not trying to hit a number when it comes to store openings. What we're really trying to do is open profitable stores. And, as you know, we have substantial capital that we can deploy to opening stores. So it's just a matter of finding the right locations at the right prices, because these are 9-year leases, right? So we're not going to be short-sighted about those things.
Mr. Joseph, your e-commerce sales are up 45% as well year on year. And just taking on from what you just said, is the focus going to be more on brick and mortar retail, or are you doubling down on e-commerce?
Yeah. So e-commerce is one of those businesses that you can drive, but unfortunately you drive it through discounting. What we are starting to see is that our investments into the omni-channel structure that we have in place, the infrastructure that we have to support an omni-channel business, which is full price, the investments we're making into our .com sites that are owned and operated by us are starting to pay off. So it is not a question of walking away from our brick and mortar stores. Fortunately, we've seen the consumer likes to shop in our stores and has continued to. We always thought that post-COVID that we would see it flip the other way, and the e-commerce would fall off and brick and mortar would rise. Good news is both happened. So which means that there's a rising demand among the consumers in India.
What is the revenue split right now for offline and online, or e-commerce and brick and mortar?
Total digital commerce sales is a little north of 10%.
Are you seeing that growing? But you're saying that's discounted, so you wouldn't want to push it that way.
Well, a part of it is, Taman. Not all of it is. The part that's not, we would like to double down on. The part that is, we want to control it, because don't forget, e-commerce does give you eyeballs across the country, across pin codes that you don't have stores in. So it's important to have the presence on e-commerce. It's not something you can walk away from. And more importantly, most of our customers also are digitally savvy and start their journey on the digital space first. So you have to be present, you have to be active, you have to be leading that space with content and whatever it takes to be a standout in it.
Mr. Joseph, just as we wrap up very quickly, the guidance for FY26, is this for are you giving I know you don't give necessarily a formal guidance, but some color there, and could it be present continuous in that it might well continue into FY27 as well?
Yeah, so you've seen us have 2 quarters worth of double-digit growth, right? And what we've guided to at a long-term basis is somewhere between a 12 and 15% CAGR, right? And we're not going to jump right back up to that overnight, but I think the indications are that we are headed that way. So that's a positive for us, that we should be getting back on that track. Overall, we feel good about the consumer sentiment that we're seeing out there, the way they've taken to some of our new ranges, our new collections. Overall, it's been an upbeat experience.
Okay, Mr. Joseph, all the best for the quarters ahead. The stock is bumping up as the management is speaking to us, by the way. So keep that in mind. But thanks, Mr. Joseph, for joining in and giving us your thoughts.
Thanks, Neeraj.
4% higher for Metro Brands. 1, 2, 3, 4. Interesting. We slip into a break, come back, and get in a conversation with Ritesh Tiwari, the CFO of HUL, and then Amit Paithankar, the CEO and whole-time director of Wari Energies. Stay tuned.
That's huge. That is a biggie. It's out of it.
Gold Plus Clear Glass. Par ho ya near, sab kuch dikhe clear.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people, or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use math to predict human behavior?
The 2007 split was a tough one, wasn't it?
I look back, maybe I wanted to take charge of it too quickly. My ego came in the way. Net, a year later, the 3 people who selected me as a CEO said, we don't want any CEO.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Hello and welcome. You're watching NDTV Profit. I am Mahima Vajrajani, and with me today in an exclusive conversation is Ritesh Tiwari, who's the CFO of Hindustan Unilever. Ritesh, thank you so much for speaking with
My
us.
Pleasure,
My understanding right now, if through this conversation is we want to try and understand as to what's happening in the entire sector, and of course how HUL, being the bellwether of FMCG, can convey to people as to what's happening in the space. My first question to you is that FMCG as a sector has been under pressure in the past 1.5, 2 years because there is demand which is weak, there is volumes which are elusive right now. There is also inflationary pressure playing its role, competition playing its role. I want to understand as to what is the kind of strategy in place for you right now in terms of what could be the next line of growth for HUL, and what are the discounting strategies especially in place when it comes to competition?
So two things are changing, Mahima, overall. First of all, the overall macro conditions in FMCG are improving. So when you look at good agriculture outcome we had both for Kharif and Rabi crop with a good monsoon, overall food inflation, which has been very stubborn for some time, has come down in the country. The monetary easing that government has done, the amount of tax relief that people have got as per the budget latest. If I add all those elements put together and then I look at headline commodities, large commodities, like crude oil, crude palm oil, they also have come off from their peaks. So all put together, overall macro conditions which supports demand is improving. There has been in the past year a purge in overall disposable income and the real inflation which has happened. So all put together, the consumption, as you mentioned, has been not as good. But the way we see going forward, the conditions are improving. Equally, what we have done as Hindustan Unilever, we have done a lot of work on our portfolio, especially in categories like beauty and well-being. And so that is one reason why we do believe that going forward, the trading atmosphere will be better than what we had in the past. Second, channels are changing and getting disrupted at a very high pace. Organized trade is growing much faster than general trade. We have also pivoted our portfolio and our investments towards organized trade. So put together, when I look at both internal factors and external factors, we do see overall trading conditions improving, demand outlook improving, and hence also our own performance we expect. Let me say the first half of financial year 25-26 should be better than second half of financial year 24-25 which just went by.
Right. You mentioned that, right now your modern trade is doing better than your general trade, and quick commerce has been a disruptor when it comes to, how trade happens right now. It's a structural change that we're observing. Just wanted to get your sense there because now quick commerce is really picking up, you might have to change your inventory model. How has that impacted your working capital? Has that, already taken place, or is it still impacting your working capital? And do you think that overall your distribution strategy that is there right now in place will change going forward as well?
See, overall, if I take a step back, the construct of the business from channel perspective is still 70% general trade, 20% modern trade, roughly 7% e-commerce, and then 2-3% other channels. Quick commerce within that for our business is roughly 2%. It's small this point in time, but growing very rapidly. And hence we are also growing very rapidly in quick commerce. Portfolio, we are expanding. So as consumers are adopting quick commerce as a channel, we are also increasing our assortment in quick commerce. We are increasing and improving our customer service. The way number of times you end up serving a place has also further increased. Investments in channels of the future, be it modern trade, be it e-commerce, overall across all the ports has also got dialed up. So ultimately for us, we are in the business for selling soaps, shampoos, our various products, and hence we are very consumer focused. Now, wherever consumer journey of shopping is changing, we have to respond to that and ensure that we are fully present wherever consumer journey takes them to shop. And hence today, organized trade is doing much better than general trade in terms of consumer shopping experience and journey. We are doubling down on this point in time on organized trade. So investments are going up, customer collaborations are increasing to ensure that we are present with full-on portfolio in organized trade.
Right. And in terms of price points there then, because right now, both in e-commerce as well as quick commerce, what I'm seeing is that there are a lot of players in the unorganized space, especially startups, which have really come out and done well in terms of your ice cream business or your beauty and wellness products. How are you viewing that as competition, one thing, and then how are you, placing discounts and prices in place to compete with them?
Yeah. See, India, when you look at overall competition, there's every kind of competition in the country. We have large multinationals in the country, almost all of them operating in India. We have large Indian conglomerates into FMCG. We have amazing listed companies doing business in FMCG. We have very good regional and local brands across the country which does business. And then exactly to your point, the entire D2C industry, which is also playing. It is pretty comprehensive competitive landscape. Working with this competitive landscape, in last 4 years, we've added more than 200 BPS corporate market share. As HUL, we have a portfolio which straddles across all the price pyramid, from premium to mass. And that portfolio completeness helps us to compete across channels and across all the competition.
Okay. So then in your premium portfolio, what you're also doing is you're making smaller packs of those premium portfolios and selling in the rural markets, because rural markets are right now doing better than urban markets, right? So just wanted to understand as to how sustainable demand is for those premium products in the rural markets, considering this rise. I mean, are they willing to pay at this price point? And secondly, in terms of your volume and value growth, do you think that the next leg for FMCG will be more of a value-led growth rather than a volume-led growth because of the kind of structural change that we are seeing in terms of demand?
Yeah. So the rural consumption habits are dramatically changing. No longer, let me say, take an example of beauty. No longer a moisturizer like Glow & Lovely and talcum powder is the beauty quotient for women in rural area.
Correct.
Even a rural consumer who wants to use beauty products ends up using 3 to 4 different products on the face to complete the beauty regime. And which is why it is very important for us that we are able to make all formats of beauty products accessible. And for that matter, many more premium products accessible to rural consumers. It typically happens by making small pack of a premium product. And this is how we end up penetrating into rural areas. And we have seen that success across. So Dove Bar, for example, it's a premium soap bar. It gets sold in cities. It gets equally sold in a smaller pack size in rural areas. And we have developed such access packs for all premium products for multiple categories to cater to rural consumers as well.
Right. And beauty and wellness is one of those segments that's doing well for you. So just wanted to get a sense there as to, in terms of growing this particular segment, what's the plan in place? Do you think it will be done via acquisitions, or there are new products that you'll be launching? What's the next course of action there?
So there are 2 big actions that we're doing for our own portfolio within beauty well-being. First of all, massive amount of portfolio transformation. And we deploy all the 4 strategies for portfolio transformation. We take our large brands and then we enter into more demand spaces. So for example, take Vaseline. Vaseline has entered into sun care space. So that's one strategy that we do. We've taken Pond's. Pond's has entered into multiple demand spaces of sun care, light moisturizers, serum as a format. So you take large brands and get into more demand spaces. That is strategy number 1, to expand the portfolio. Strategy number 2 is to see if at all there's a demand space, you don't have a brand, then we want to launch a brand in that space. So Novology is a classic example where we saw space in masstige premium skincare. We wanted to have a product and range. We used our global technology and we launched Novology as a brand in that space. So that's the second strategy to improve portfolio in beauty well-being. Third then is to look at the brands that we have in stable of Unilever and what is relevant for us to bring in the country. So for hair, for example, we just recently brought Nexus from the global portfolio. We launched in hydration space Liquid IV. Sometime back we bought Simple Love Beauty Planet from stable of Unilever. So we do bring brands from the stable of Unilever which are relevant in the country to expand the portfolio. And where we can't do the job from these 3 strategies, then the 4th strategy always is then to go for bolt-on acquisition. So we acquired, for example, Oziva a couple of years back in health and well-being space. Recently we acquired Minimalist in masstige, actives, science-led space. So all these 4 strategies will keep deploying because beauty market in India, it is fragmenting. And typically when you have a per capita consumption which is low, which is where India is today at $50 per capita, as market keeps improving with overall rising income levels in the country, we have always experienced in multiple countries in the world, skin care takes off. The market fragments, penetration improves, consumption levels also increase.
Understood. And since you mentioned that you will be making investments, in growing your segments, just wanted to get a sense. As of FY25, when I was seeing your balance sheet, cash and cash equivalents was roughly 7,500 crores, right? And HUL is known for its dividend payout ratio as well. Just wanted to get your sense as to what is going to be the cash distribution policy like, because right now shareholders might be expecting something from you in terms of returns. What is there in place in terms of dividend payout, as well as is there a buyback on cards? How do you plan to pay back to your shareholders?
So the way we look at overall capital allocation a little more broadly, and there are three components to that. Component number one, when we generate cash, first port of call is to deploy cash to grow the business. So in terms of investing for capital, investing behind brands, innovation and capability. So that's where we do our first deployment of capital. Second, we deploy capital to drive bolt-on acquisitions. So Oziva, Minimalist, a classic example where we have a need to deploy capital to further improve the overall portfolio that we have. And third, we always believe in maintaining high dividend payout. We always have more than 90% dividend payout ratio. We have done for the last several years. Once in a while, when we do believe there's a little more cash that we want to give back to shareholders, we then go and do special dividend, which is what we did last financial year. So those are the strategies that we end up using to ensure that we end up giving healthy dividend back to shareholders. Ultimately, we have to ensure that shareholders get a very healthy return on capital, be it ROCE, which we always have maintained more than 100%, or for that matter, a very healthy ROE, return on equity. In last 4 years, we have done almost 400 BPS improvement in our ROE.
So that brings me to my next question. What are the ROC and ROE targets that you have for the next, let's say, 2 years down the line? What is the internal targets that you're aiming at right now?
So the ROC, we want to maintain above 100%. And when it comes to ROE, return on equity, as I mentioned today, we are at roughly 21.2%. We've improved last financial year by 120 BPS. We will want to keep making progress by improving 100 to 200 BPS going forward as well.
Okay, and in terms of acquisitions that you mentioned, will that be only in beauty and personal care segment? Because foods is something that's a segment that's remained under pressure. Do you think that segment plus your home care segment, will you be going ahead and making acquisitions there, or will you be adopting a strategy of introducing new categories or introducing new products there?
Yeah. As I mentioned a little while ago, for us to improve portfolio, we will do all 4 strategies across all the categories. Be it expanding our big branch into more demand spaces, even home care, for example. We've taken Vim, our very large brand, which is in dishwash, and we launched Vim Floor. We have now, second item I mentioned to you earlier, that the second strategy always is to launch new brands where we don't have in a demand space a brand. So we now launched Sun within home care as a dishwash brand for tier 2. And equally, let me say example of foods, where we brought Hellmann's from the stable of Unilever. And coming to bolt-on acquisitions, both beauty and foods are our 2 priorities for bolt-on acquisitions. We do believe that our portfolio today in home care is complete, and where we had space, we have launched Rin Liquid. As far as tier 2 liquid is concerned for laundry, we launched Sun in dishwash. So we do believe we have a complete portfolio in home care, which straddles across the entire price pyramid. That is similar case in personal care as well. But foods and beauty are the 2 places where we have to continue to do more work in terms of transforming portfolio.
Right. So
that's the NDTV Profit exclusive, and you will hear the whole show through the day today as well. And of course, on all our digital media platforms, the entire conversation. But I think the stock of the day today has to be Waaree Energies, because the US has passed a bill today that accelerates the phasing out of investment production tax credits for clean energy. The IRA, as all of us knew about and were aware of. Now for Waaree, this becomes important because, as a lot of brokerages have written, it derives around 57% of the order book, with total order book of about 47,000 crores coming in from the US. They were targeting about 20% sales from the US in FY26 as well. So how does this change the landscape? Amit Paithankar, CEO and whole-time director of Waaree Energies, joins us right now on the show. Amit, good having you. Thanks so much for taking the time out. This certainly puts a spanner in the wheels, doesn't it, Amit?
Well, first of all, thanks a lot for having us here. Yes, an important bill overall that was passed yesterday by the US House of Representatives. It needs to then go to the Senate, where it will need to go through the threshold of simple majority before it is actually implemented. So it's still early days. We will see in what manner does it cross the threshold and passes. But honestly, Neeraj, from our perspective, actually from the perspective of India, this is a pretty, I would say, good set of information or that is coming out of the US for now. Because if you see, what has happened is the IRA has not been repealed. The manufacturing IRA, which is under 45X, is changed, but it is not repealed. And we can continue to enjoy the IRA with conditions of FEOC, which is that's the new condition that is now come in, which is foreign entity of concern. And India is not on the list of foreign entity of concern. So in fact, it is a positive for us. We should look at it from the perspective of how can we be a part of the overall ecosystem, which excludes the FEOC countries.
Okay.
And therefore, Neeraj, I think it's an opportunity.
But Amit, okay, let me try and get this clarity. What our understanding here is that there are two things that will happen as a result of this. Even if India doesn't get impacted as a nation from this. One, that the federal tax credit for taxpayers who install solar rooftop systems, this will impact those incentives, and therefore the overall demand in the US for solar might come down. Two, for manufacturers as well, right? This whole, the production-based tax credit that rewarded companies for manufacturing clean energy components in the US or outside the US now, those incentives come down, it impacts the working capital availability, so on and so forth. Surely it can't be a positive, both of these things.
Okay, so let's first look at the Section 25D ITC benefits that were available for residential solar. They will definitely be going out, as you rightly pointed out, correct? Now, the important aspect there is solar energy is still the lowest cost energy available. So even if you start reducing the overall incentives for that particular segment, we may see a bit of a temporary slowdown, but just because of the fact that it is the cheapest form of power available, you will find over a period of time, it kind of reshapes itself into a different market at a different price point, but it will still be a price point. The other aspect, and which is more important from our perspective, from a Wari perspective, what is more important is the manufacturing credit. And that manufacturing credit is not repealed. What does it mean, right? There are two or three things that we need to understand here. The credit will be phased out a little early. Okay, that is number one change that has happened. And the second change that has happened is you need to comply to FEOC guidelines to ensure that you continue to enjoy the 45X tariff exemptions. Not tariff, manufacturing credit that is applicable to you. So if you are complying to that, we are not going to be in any way, shape or form affected by it. We just need to make sure that we comply to FEOC requirements. And from a US overall supply chain perspective, we have already been gearing.
Just further clarity on those 2 points, please, if it's all right. Tamanna here joining in the conversation and great to speak with you. Just on the point of the FEOC compliance, that's there. I understand that. But the tax credit, which was till 2031, still phases out earlier. How earlier? And what kind of a hit is that? Let's keep aside the FEOC to one go. But when you say no impact in any shape or form, the fact is that a tax credit which you were getting till 2031 now ends earlier.
So it was actually till 2032. Now it ends in 2031.
Okay.
That is the meaning of early phasing. So in the short run, right, we are sitting in 2025 at this point in time. And so in the next 2 to 3 years' time, we are not going to see a major noticeable change because of that.
First leg of that phasing out, you're saying, starts in the next 2 or 3 years. So after 2028, 2027,
That's
2028.
correct.
And to what extent?
That's the same. The phasing out, it's just been advanced by 1 year. Okay. But that is still 3 years away. We are still in 2025. So in the short run, nothing really changes.
Okay.
In fact, it is a positive. The FEOC piece is actually a positive for us.
No, FEOC piece notwithstanding, you'll still see this 2032 move to 2031. So that still happens, isn't it?
That's correct.
Okay. And on the second bit, where you said that even without the incentives for consumers, solar is still cheaper than others. Having said that, how much will costs go up for those wanting to install rooftop solar installations after these tax credits are withdrawn from the consumer end?
Tamanna, my apologies. There was a bit of a sound error here. Can you please repeat your question?
Let me repeat my question. The first part of it is incentives which consumers in the US were getting for installation of solar panels have now come down. You've made the argument that even after those incentives are gone, solar energy is still cheaper than everything else. So you'll see a temporary dip. But to what extent will it get more expensive for consumers in the US to install these panels as a result of the withdrawal of these incentives?
I think overall, what we need to understand is how much is the solar rooftop residential segment a market, as compared to the larger pie, which is utilities. Utility scale is where most of our customers are, and that has not going to be, greatly impacted by what we have at this point in time here.
Just one bit on the other end, because now we're talking about everything only in the context of the US bill. But there are components from China that you also need to import, right? Where even as the US-China deal and the details of it are awaited and worked out, could that be impacted as well? Are you seeing any signs there?
Well, I think we'll have to wait till the time that the actual deal is announced. We'll also have to wait till the India and the US bilateral trade agreement deal is announced. And so a lot of the stuff is in the works. I would love to talk to you no sooner we have a little more clarity on all of these aspects.
Okay, Amit, a couple of clarifications. So one of the things is, I'm moving track back to the US, but you were probably eligible for 7 cents incentive for every module manufactured in the US and 4 cents incentive for every cell manufactured in the US. Now, the belief is that under this tax bill that has been introduced by the current US administration, it removes the ability to transfer the 45X credits, which means that manufacturers can no longer sell these credits for cash, which could significantly reduce liquidity for clean energy manufacturers. Will this happen? Is that a big concern? If not, why so?
So again, Neeraj, a very important and a good question. Let's understand from my perspective, what I understand is this is going to be applicable only from 2027, 2028 onwards. So we really need to look at the fine print. If you are not able to trade tax credits and you do not have that higher tax liability, then it will be difficult for you to obviously use those credits, right? Because then you don't have much taxes you pay yourself, and so it really is in that scenario that you will have a problem. But we really need to wait till the fine prints come out. From my perspective, I think, as I understand, it is going to be 2027 onwards or 2028 onwards.
Okay.
Which is again 2 years away from now.
Okay, let's wait for the fine print. But if it were to come in the current shape and form, then liquidity issues come in for FY 27-28. Depending on the fine print. Point well noted.
Depending on your tax bill. So if your tax bill is big enough for you to take all the credits, it doesn't matter to you anyways.
Okay. The other point is your plans in the US, right? You were planning to expand. Now, if indeed this, I know you said that there is a temporary dip, but one doesn't know how temporary it might be, Amit. Would you, if the bill in the current shape and form, in the worst possible outcome takes shape, would you alter your US investment plans?
Again, phenomenal question. And that's the question that obviously we will need to look at internally as well. However, I'll tell you a few things which are invariant in these conversations that we are having. Number one, USA is a very, very large market. USA is concentrating on artificial intelligence development, and a large portion of that is power. And power that needs to be deployed at scale and at speed. And solar energy is a form of power which can be deployed at scale and at the speed at which it is required. So the demand for solar energy, therefore, will continue to be unabated in the United States. And because of that, we continue to be bullish on that market. And in terms of investments, we already are at 1.6 gigawatt, Neeraj, as we were talking about. We will continue to, we are committed to double that to 3.2 gigawatts, which we will go ahead and do. Over and above that, we will keep watching how the market evolves. But long-term perspective, continue to be bullish on the US market.
Interesting. Okay. Amit Patankar, all the best for this and more. Thanks so much for joining us and giving us your perspective.
Pleasure. Thank you for having me.
No, pleasure is ours. And Tamanna, I think what will be imperative when we talk to Amit again in July, because by then they would have analyzed the fine print, the bill might have seen the light of the day, because as you said, in the Senate as well, they have the majority to pull this through, right?
So but the interesting thing here and where the grey area is that even in the Senate or even in the HOR, it was Republicans who were opposing parts of the bill. So the system works quite differently in the United States. It's not necessarily that you toe the party line. So they might have to pull back on some things even as the bill makes its way through the Senate. This may not be one of them.
This may not be one of them,
yeah,
exactly.
So this is not a priority for any lawmaker in the United States to fix right now.
Especially when the debt issue is the bigger
they
culprit for them right now.
larger fish to fry. So this might just pass through. That's what we need to see.
And therefore, in July, when they talk to us to understand whether they are, like now he said that they are continuing the US investments, will they still do that if the bill is in its harshest form? Is the key question.
Will PLI come and rescue? Otherwise, then, let's push rooftop installations here. Anyway, more on that bill, because we're talking so much about it, and it's not just Wari which could get impacted. That one big, beautiful bill, as Trump is calling it, has got the US House nod. This now has to go into the Senate. But what is the impact of what they're proposing for Indian companies? Somi joins in with more.
Well, yes, multiple sectors could get impacted. Power is the major sector that could get impacted. Apart from that, it's auto ancillaries and IT as well. Now, if you talk about the power sector here, the renewable energy, they're looking to accelerate phase out of investment and the tax credits that they had given for production of clean energy. But the 45x manufacturing tax credit, that will remain valid till 2021. They're also looking to tighten the compliances for foreign entities, and this could meaningfully curtail utility scale and rooftop installation as per multiple analysts, and this could also mean reduced competition coming in from China and Russia for the for US's domestic companies. Now, if you look at the companies that could get impacted in India, firstly it's Wari Energies, because the US bill will definitely impact this company. They have around 57% of their order book comes from the US market, so big exposure that they have to the US market. But because of the 45x tax credit that remains valid till 2031, at least their plant in US that they're setting up will not get impacted because of this. But the future outlook or the future order books or the future order wins that the company could get could narrow down for Wari Energies from here on. Apart from that, Premier Energies also is one company. Now there will be limited impact given the fact that they have just 3% of their revenue coming from exports, but they had plans to set up a 1.2 gigawatt capacity in US. Now that might get shelved for the company, so that is something that we need to watch out for. When it comes to the auto sector, relief on tax for car loan interest, now that could stimulate US car market, which will be beneficial for many companies that have exposure, like Tata Motor has a direct exposure through JLR. Apart from that, some auto ancillary companies like Bharat Forge, Motherson Sumi, Balkrishna Industries, RK Forging, these companies could also get benefit. But on the negative side, Sona BLW is one company that we need to watch out for, given the fact that the tax credits towards EV is going down, and Sona BLW has a large exposure towards electric vehicle market in US, so that could get impacted in some or the other way. So we need to watch out for that company as well. And lastly, when it comes to IT sector, positive sentimental impact given the fact that extension of corporate tax could stimulate US economic activity. This could also increase IT spend. So IT companies could stand to benefit, but it's a sentimental impact. We cannot at this moment give the financial benefit or financial impact of what could come in for the IT sector from this, but sentimentally it could be positive for the IT sector.
So, okay, sentimentally positive for the IT sector. So much could work out. We have to wait and see what that bill looks like. More clarity perhaps by Monday or Tuesday as we see how that bill really processes. But for now, that's a wrap on India Market Open. We're leaving the markets in good spirits, which is great. You've seen an uptick on the Nifty. It's going to be an interesting day to watch as well. So stay tuned. A lot more action coming up on NDTV Profit. Ask Profit up next.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math, getting 98.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit, and my name is Alex Matthew. Happy Friday to you. And it looks like the markets are in a good mood at the end of the trading week. Let's see if that mood sustains through to closing, because you've seen quite a bit of action towards the end of the session. And yesterday, of course, you came off the low point of the day. I wonder whether the strength will continue towards the end of the session as well. For now, we have gains of about 160 odd points for the Nifty 50 and about 0.7% higher. The broader market's looking sanguine as well, but to a certain extent underperforming the benchmark Nifty 50. It's something that hasn't taken place over the past few sessions where you've seen an outperformance of the broader markets. Today, it's the other way around. The Bank Nifty is something that you should track closely. It made quite the comeback in the last hour of trade yesterday. It's looking a little soft today, up about 0.2%, but watch the upside. 55,000 is a key level to watch. If it managed to sustain above that level, then quite a few of those ranges might just shift higher. IT is another sector that it's up and about in trade today, and it's moving higher, 1.5% or so. In fact, let's look at the contributors on the Nifty IT, the constituents rather on the Nifty IT, to see what is moving the needle. In fact, all stocks in the green. Even a Wipro, that is the relative worst performer, is up about 1% or thereabouts. Oracle, Coforge, both gaining over 2% at this point and looking good in trade. Persistent, very close behind, gaining about 2% or so. We spoke with Pankaj Murarka earlier in the day, and he was talking about IT being something to watch out for. And Wipro is something that he likes from the large cap space. He says that he's venturing further into the broader markets to try and pick stocks that have a trajectory or that is going to take them into the realm of $1 billion of revenue. And so it'll be interesting to find out what stocks exist there that have that kind of a potential. But let's take a look at the contributors on the Nifty 50 just to see what is moving the needle and what is losing ground. Sun Pharma, of course, on the back of the earnings and on the back of the outlook going forward, is an underperformer. Once again, Pankaj Murarka saying that his firm has Sun Pharma in their portfolio and they would be buyers on dips. I wonder whether our experts today have a similar view. Infi, ITC, Reliance Industries, HDFC Bank, quite a few of the heavyweights pulling their weight today. We've got Jatin Gedia, who's a tech research analyst at Mirai Asset by Sharekhan by Mirai Asset, I should say, and Avinash Gorakshakar, who is Director Research at Profit Mart Securities. Gentlemen, thanks so much as always for taking the time, and good morning to you. We've got the first caller that is already through. And by the way, if you are tuning in for the first time, the number that you see on the top of your screen is where you can call us. That's a landline number that Manav has used to call us. And there's also the WhatsApp number that you can use to send us messages. Manav, very good morning to you. How can we help you today?
Yeah, hi. Good morning, everyone. Yeah, actually, I have a query regarding Britannia Industries Limited. I have 20 odd shares of Britannia at the rate 5,300 per share.
Okay.
So I want a fundamental view, like I have plans to hold it on for another like 18 to 24 months.
Okay.
I can hold it on a little longer also. So it's been like more than a year I've been holding on to it.
Okay.
So I want a fundamental view for like another 18 to 24 months.
Got it. All right. Avinash, that's my cue to go to you on Britannia. What do you make of the trajectory for earnings? And it is within that consumption play. Do you see it picking up? What are the trends in the space? And would you hold on to Britannia for 18 months?
Yeah, good morning, Alex. I think Britannia is definitely a very large performer in the FMCG consumption kind of category. But I think fourth quarter numbers which came out were not very exciting. I think volume growth was almost flat, and numbers in terms of revenue, in terms of profit, was also not all that great. So my sense is that if the investor is now looking at the next 18 to 24 months, he could definitely hold on, because our sense is that hopefully the rural market demand grows. We have a good monsoon, and most of the companies which operate in the FMCG basket, volume growth is a very important variable. So I think hopefully we get a volume growth of 7-8%, which would obviously drive earnings going forward. So my sense is that yes, they have been introducing new product categories. They have been eating into the market share of other smaller comparable peers. But I think to get a bigger re-rating from this company, you'll have to wait till maybe the September quarter numbers. Until which we will probably see the benefits of rate cuts, the benefit of the budget announcements, and plus overall the monsoon also would have kicked in. So I think post September, I think you could see some traction in the numbers. So I would say that the investors should hold on. It's a blue chip name, but considering the large base and the kind of volume trajectory which was not so great last year, the stock has been moving in a very sideways way. So continue to hold for the next 12 to 18 months.
Continue to hold is the view on Britannia. We've got our next question on WhatsApp, and we've got Parimal Kumar Parik, who's writing in from Jabalpur, who's got Texmo Pipe and Products. It is a stock that has a market cap of just about 180 crore rupees. Just a pointer to our viewers, we may not be able to get you views on stocks that have a market capitalization of less than 1,000 crore. We'll try. No doubt. Jatin, I'm wondering if you have anything that you can say on this based on the stock price action on the technical levels. He has bought at levels of 78 rupees, and he's wondering whether to hold.
Yeah, see, in the case of Texmaco pipes,
it's Texmo pipe. It's not Texmaco. It's Texmo.
The price is currently quoting at 62, I suppose.
Yeah, that's right.
Yeah, so in the case of Texmo pipes, we believe that the overall price structure is suggesting a range-bound price action between 54 rupees and 72 rupees. So overall, it has been more or less in this range-bound kind of a consolidation. So I believe the range is likely to the range-bound price action is likely to continue. If he is already holding it, then 54 rupees is the trailing stop loss with which he can continue to hold for targets of 72 to 75 in the short term.
All right, so those are the levels that you would want to watch out for. Hold is a view from Jatin. Santosh is calling us from Hyderabad. Good morning, Santosh. How can we help you today?
Yeah, I just want to make a fresh entry into CDSL for 50 shares. Is it the right time to enter? I just want your
Okay, and you're looking for a long-term view on the stock?
Yeah, I'm looking for at least 1.5 years.
Okay. All right. So, Avinash, quite a few of these plays have come back into focus with the markets recovering from the low point of the last couple of months. February is when you saw that big drawdown, and then we've recovered over the last few months. CDSL, would you buy right now for the long term?
Yeah, I think, Alex, CDSL definitely categorizes as a good medium-term bet, because, see, I think if you see the structure of the market, there are 15 crore demat accounts. I think hopefully we would be having NSE listing next year. And I think CDSL makes its revenue from every trade. Whenever you buy or sell a share, they make revenue on every transaction. And most importantly, if you look at the market structure, there are only two depositories in the country, CDSL and NSDL. NSDL is also planning to go very public very soon. But in terms of the market share, I think CDSL controls around 77% of the demat market. And I think the markets are going to grow very rapidly. In fact, the government has now told all private limited companies also should demat their holdings. Universities or typically insurance companies should also go for a paperless kind of, demat structure. So I think the opportunity to scale up in the next, say, 3 to 4 years is quite significant and solid. And this is a solid annuity-based business, a very asset-light business. CDSL already holds about 1,000 crores plus of cash. So, if the investor has a 12 to 18-month time frame, he could do a SIP. a small SIP, starting at the current level, and on every dip, he should accumulate for a reasonably good risk reward over the next 12 to 18 months.
Just a quick follow-up on that. If I look at the trailing PE, it's at 57 times or thereabouts, so not cheap by any stretch of the imagination, despite the kind of fall that you've seen from the higher levels. And so from that perspective, what according to you is the good price to really accumulate this stock?
No, I think, Alex, the Q4 number was not good. At that time, the stock corrected. So I think, if you could probably look at prices of, say, around 1200 or maybe 1250 or 1300, that could be a good level because, these are monopoly companies. So, my answer to your question about the valuations is that these companies will continue to enjoy a significant premium in the market because of scarcity premium. Currently, CDSL is the only listed entity in the demat space. So my sense is, unlike looking at the P multiple, I think one should look at the cash flows and should look at the operating EBITDA earned by the company, and then that variable can be used to value the business. So P multiple could likely be a misnomer in this business. It could not give you the right picture as to the kind of opportunity you could make in the next, say, 2 to 3 years.
Yeah, that's a very fair point that you're making. It's and ultimately, if you miss the bus on some of these opportunities, unfortunately, you don't get the price at all. Which is why Avinash is suggesting an SIP-like approach and deploy when you get the opportunities on dips. We've got the next question on Ola Electric, and a lot of people piled into this counter when the IPO came through, and they've unfortunately been disappointed. We've got Jerin Matthew Koshi, who's writing in from Kerala and asking about Ola Electric, which he's bought at levels of 70 rupees. And he's looking for the long-term view. Avinash, I'm coming back to you. This is a company that is looking to raise funds right now. Soon after its IPO, it's still sitting on some of the proceeds that it raised from the IPO. So I'm wondering why it's planning to raise additional debt. What do you make of the company? Would you hold for the long term?
No, I think, Alex, this is a classic case of a company which has been driven largely by the narrative. Fundamental numbers still continue to be extremely disappointing. I think, they're still incurring heavy losses. And I think there have been a lot of product-related issues also. So my sense is that, the investors should not be watchful. I think further dilution at this point of time, either on the equity side or maybe on the debt side, will definitely be more detrimental for the company because the capital structure of the business is already extremely weak. And I think unless they get a significant jump in their volumes, they reduce their losses, any meaningful re-rating in the stock, at least in the short term, is ruled out. So only over the next couple of years, things can improve. So I think, the investor in question should actually take a longer term view because in the near term, I don't think there's going to be any re-rating trigger here.
No re-rating trigger. So would you rather, from your perspective, Avinash, take money off the table, book a loss and move to the other various opportunities in the Indian equity markets?
No, I think, clearly an exit call would be better. But in the case the investor doesn't want to book out at a loss, then he can hold on. But I think at these levels also, if he can get out, I would suggest that it's better to take the capital, off the table and put it in some company where earnings are going to grow by at least 15-20% because there are many opportunities now which are available. And I think the investor should prudently allocate his capital accordingly.
Point. ITC is a stock in focus on account of earnings. It's moving in trade today. Let's pull it up, the intraday chart for ITC. It's up about 2.4% or thereabouts. And we've got a viewer. Look, guys, please help me out. Tell me your name. Tell me where you're tuning in from because that will help you identify when your question is being taken. I don't know who's asked this question on WhatsApp, but we're taking it anyway. ITC is the name of the counter. 105 shares held at a price of 426 rupees per share. It's Anup. All right, Anup is written in. I'm just being told. Would you buy more at this point? Would you accumulate for a period of 2 years? Jatin is the question.
See, overall, the price structure of ITC is pretty bullish. So we believe that even if he wants to hold for a period of 1 to 2 years, then buying at current levels is advisable. The price structure is bullish. It's holding on to its crucial support levels. And today, post the consolidation, it is providing a breakout on the daily chart. So even in the short term, things are looking positive. Structure is positive for an immediate upside till 458. However, from a medium-term perspective, we are expecting 525 levels from a medium-term perspective. On the downside, the support should be placed at 420 from a short-term perspective, and from a medium-term perspective, 390 is the stop loss level.
Okay, all right. So that's the view on ITC. It's up and about on the back of earnings. Mahesh is calling us from Mysuru. Mahesh, Shubhodaya. Good morning. Thanks so much for calling us today. How can we help you today?
Hi, sir. Good morning, sir.
Please go
Hello.
ahead. Yeah, I can hear you.
Sir, KPI Technology shares 320, average price 1,320, and profit in 5,000. Seller holds are in technical analysis, sir.
That you have, how long would you like to hold this for?
A short term, 9 months.
Okay, all right. Jatin, coming to you on this one, bought very close to the current market price. 1320 is the acquisition price. It's currently trading at 1340 or thereabouts. Would you hold for a period of 9 months or thereabouts?
Yeah, definitely, because the price structure is suggesting an uptrend, and we expect this rally or the current up move to continue towards 1463 to 1475 on the upside. So he should continue to hold. I would suggest to him to keep a stop loss of 1280 on his trade and continue to hold onto the long positions.
Okay. All right. So the next question we're taking is from WhatsApp, and we've got Richie who's writing in from Kerala and is asking about Ashok Leyland. By the way, the results are today, so watch out for that. And he's looking at parking as much as 2 lakh rupees, which he's holding in this particular company. But he's talking from the perspective of the dividend and the bonus issue or the bonus share issue. It's likely to consider a bonus share issue in its meeting today. It's not yet been announced. So in that context, Avinash, I guess the determining factor is going to be whether or not the earnings look good. What is your opinion?
No, I think, Alex, my guess is that earnings are not going to be great. They could be at best be moderate to steady or even flattish in the fourth quarter. And I think, see, the overall market is really cautious about Hinduja Group companies after the IndusInd Bank fiasco. So I would suggest that, let the core numbers come out, let the management commentary come out. The bonus is just a book entry. So I think, investors should realize that they should not buy stocks only for the bonus. Obviously, bonus is definitely an attractive option. But I would say that if the numbers are attractive, if there's a real sense of optimism in the management's commentary, considering that this year we'll have a good monsoon and the April to June quarter is equally strong, because I think Ashok Leyland is also a large player in the defense market. So I think it's better to wait for the quarter four numbers and then take a call. But yes, I think definitely from a longer term perspective, with the investor has a 12 to 18 month view, he can stay invested here. But I would suggest invest after the results are out.
For the results is the call, Richie. Hopefully and by the way, you can catch a management interview as well that is lined up. I believe that it will play out on Monday, but we'll update you on that. Snigdha is calling us from Hyderabad. Hi Snigdha, good morning. How can we help you today?
Hey, hi. So I just want to know, I have taken Sanghvi Hotels 1250 shares at 197.5.
Okay.
So I just want to, today's high is 203.
Right.
So I just want to know if I will get a profit for one month or not.
Okay, so you got a short-term outlook. Jatin, on the charts, Sanghvi Hotels is part of an entire basket of stocks that have been quite active in the recent past. Would you hold for higher levels, and what levels would they be? Where would you place your stop loss?
See, in the case of Sanghvi Hotels, the crucial support level is placed at 181 rupees, which is the 20-day average. So that would be my stop loss for the long positions. On the upside, I am expecting levels of 205 to even 210 in this stock. So continue to hold with the 181 rupees stop loss.
Okay, continue to hold. Did you mention a level to watch out for on the upside?
205 and 210.
Okay, 205, 210. All right. Hopefully that answers your question, Snigdha. Nina's writing to us from Kerala. Nina Johnson asking about Apollo Microsystems, which she's wondering whether to buy at the current level, which is around the 146 level. It's down in trade today for a period of 3 years, or should she wait to buy on dips? It's an interesting play, Avinash, and based on what you've seen of both this company and the space, would you say that this is the best option to consider?
See, I think clearly Apollo Micro is definitely a very, medium to small defense kind of player. And I think it enjoys a strong order book. My sense is that, in most of these defense companies, unless you got a 2 year plus kind of time frame, it's very difficult to now generate a very large alpha year. So I would say that, even in case of Apollo Micro, if the investor can keep at 2 years plus time frame, he can definitely think of buying in small lots. The company should do well FY26, considering the kind of order book they enjoy and the kind of new initiatives the company has announced. So I think net, I think buy at the current level, but keep on buying in a SIP way, which can actually minimize your cost.
Okay, yeah. So cost averaging is what is being suggested for Apollo Micro as well. Remember that why don't we pull up the 1 month chart for this company just to see whether it's kept pace with the defense pack as a whole, which has been up and about in the recent past. And there you go, it's up about 24%. All of the companies that have an orientation towards defense in some way or the other have moved up very dramatically. Bear that in mind. All right, Ravi is calling us from Hyderabad and is asking about Piramal Pharma. Ravi, thanks so much for calling us. How can we help you today?
Yeah, very good morning, Alex.
Please go ahead.
My query is on Piramal Pharma.
Okay.
So is it a good stock to pick, or can you suggest any other stocks in pharma which gives good returns in next 1 to 2 years?
1 to 2 years. Okay, so you're thinking of buying it based on the earnings, is it?
Yeah.
On the earnings. Okay. Avinash, it's an interesting question because we're speaking on a day when Sun Pharmaceuticals has posted its numbers and the outlook for growth is not terrific. But we were speaking with Pankaj Murarka earlier on today, and what he was saying is that, first of all, he gave a disclaimer that he's holding it. And he said that the management has a tendency to under-promise and over-deliver. And from that perspective, he would be a buyer on dips. In the pharmaceutical space, in your opinion, is Piramal Pharma a good stock to hold? What are the prospects? And if not that, which would you pick for the long term?
I think Piramal Pharma, Alex, is definitely a promising bet, considering that they are a large player in the CDMO space. And I think numbers which came out were quite reassuring. So my sense is that, yes, if the investor has at least a 2 year view, then I think he can definitely expect to make a decent risk reward here. Within the larger cap, I think pharma names, we are positive on Lupin, we are positive on, Sun Pharma. But I think, clearly the CDMO is a very promising opportunity. And I think there, Piramal Pharma, other players like Glenmark are definitely, growing by very rapid kind of top line, percentages. So Piramal Pharma, he could definitely look at. It's not a very pricey stock. At the same time, this company was a demerged entity of the parent entity. And now I think numbers have started coming in. So I think hopefully 26 should be much better. So yes, you can buy it, but keeping a 2 year time frame.
Okay, buy with a 2 year time frame is the view on Piramal Pharma. The stock is down about 0.8% today. Hopefully that answers your question, Ravi. We've got a question from Shri, who's writing in from Calcutta. Oh, I should say Kolkata. And he's recently added Hindustan Zinc at a price of 415 rupees per share. He's wondering whether to hold or sell. He's got 300 shares. And the entire metal pack has done reasonably well because you've had developments from China that suggest that administration and the central bank there is looking to support the economy, and anything that does well for the Chinese economy bodes well for the metal pack as a whole as well. So the question is whether you would place your bet on Hindustan Zinc or another stock in the metal pack. And Jatin, on the charts, what is the opinion here?
No, see, in the case of Hindustan Zinc, definitely it's a good level to accumulate or even hold on, because the recent high in the stock was around 800 and now it's currently trading at 440. So already it's had a decent amount of correction, and as far as the price structure is suggesting that it is forming a base formation, and I am expecting a breakout above 455 to 460 levels in the immediate short term. So definitely you should hold on for his trade, and I suggest to keep a stop loss of 420 for his long position.
All right, so that's the view on Hind Zinc as well as the metal space as a whole. We've got the next question from Jaipur. Dilawar is writing and asking about SW Solar, and he's looking for a target price for the next 6 months to 1 year. He's already acquired the stock at a price of 291 rupees, which is not too far away from the current market price. Remember, this is a stock that has seen a significant amount of value erosion over the period of the last 6 months to a year. Let's pull up the 1-year chart and give you a sense of what I'm talking about. There you go. So about 64% down compared with where it was a year ago. The question is, has a base formed, and what are the prospects for the next 6 months to a year? Of course, some part of this will depend on the earnings, but on the charts, Jatin, what are the levels that you would watch on the upside?
Yeah, see, in the case of SW Solar, the price structure that has been forming post a recent decline is not very encouraging as of now. It's only a consolidation phase that is going on and not any signs of a trend reversal on the weekly chart. So I think the recent price structure is indicating that it will slip down towards 230 to even 220 on the downside. So that's a decent amount of downside even from current levels. So I suggest to, if he's holding, then exit at current levels in this investment that he has made.
So exit is a call on Sterling and Wilson Solar on the basis of the technicals, and quite a few of the fundamental experts that we've spoken to as well over the last weeks have suggested something similar. Avinash, I just want to know whether you have the same opinion. Would you say exit is a right call in SW Solar right now?
Yeah, I think, see, my guess is that, even at these valuations, Alex, the stock doesn't appear to be cheap. And now what has happened recently, like yesterday, US Donald Trump has said that some changes could be announced in the tax bill, which actually cuts down, the benefits which users get for putting out solar rooftops. So I think if that happens, then the global market, especially the US market, is now going to be extremely volatile and choppy for Indian players. I would suggest that it's better to exit and get into some other companies, specifically the capital goods or maybe the public sector bank, category stocks, where I think growth is more evident and where the valuations are also attractive.
Got it. All right. Rahul is calling us from Chandigarh and asking about a stock in focus today. If I'm not mistaken, Container Corp is losing ground. Yeah, 2.5% lower because the results weren't great. Rahul, very good morning to you. How can we help you?
Good morning, Alan, and good morning, sir. Yeah, I was going through the market trend today, and CCI, the console is down 3%. So I was thinking if this is the right opportunity to enter this.
Okay. The idea as to how long you'd like to hold this, what is the thesis behind it? Is it purely based on the price action that you intend to buy?
No, I intend to hold this for long term, 1 to 2 years.
Okay.
And I was going through the fundamentals. The P2E looks decent. Their market cap is fairly large, around 45K, 45,000 crores. So that's, and adding to that, the price went down, so that's why.
Yeah. Okay, so I get it. All right. I will take it across to Avinash. I just want to very quickly point you to the markets though. I've been looking at individual stocks, and so I've missed it while we've been speaking about it. We are at the high point of the day, 290 points on the Nifty 50. Look at that spurt over the course of the last 15 minutes or so. And you also pull up IT, because this is a pack that was up about 1.5% when we started this program. It's up about 2% or so, and there's an interesting up move in the banking space as well. So if we pull up the Nifty Bank, it was up just about 0.2%, but it's moved up very substantially. So you see a similar move for the benchmark Nifty 50. Let's pull up the contributors on the benchmark Nifty 50 just to give you a sense of what is moving the needle for it right now. And you will see names like Infosys, RIL, ITC, HDFC Bank as well. I think if we can pull up the heat map on the Nifty 50 or the snapshot of all of the constituents, there's one stock in the red at this point, and that is Sun Pharmaceuticals. But everything else is doing particularly well in trade. Eternal, by the way, is making a comeback. ITC is looking good. Infosys is doing quite well for itself in trade today. So very good look, and the market breadth as well. I would hazard a guess to say that it's improved quite dramatically. Let's pull that up as well, just to give you a sense. There you go. It's widening a tad bit. Whether or not that reflects in the broader markets is the question, because at this juncture, it's not. You have the Midcap index that's just about 0.4% or 1/3% higher, and you have the Smallcap index that's about 1/3% higher right now. Let me go to Jatin very quickly to see if this up move is sustainable through the course of the day, and whether this has anything to do with the derivative positions that have been in play. Of course, yesterday was expiry, and we're heading into the monthly expiry as well. So what do you need to bear in mind, Jatin?
Yeah, see, in the previous trading session, one important thing happened is that the fall held down to this 20-day moving average, which was in the range of 24,500. And thereafter, during the last hour of the trading session, we saw a decent amount of recovery from the intraday lows. And today we are seeing follow-up buying interest on the upside. Now, 24,800 was the immediate resistance, and the Nifty is sustaining above that. So I think now the Nifty is poised to continue its up move towards 25,300 on the upside. I think the mean reversion that happened in yesterday's trading session is now done and dusted, and we are likely to witness 25,300 in the next week, I suppose. So continue to hold longs. If someone is planning to go long even at current levels, then 24,700 should be kept as a stop loss.
All right, so there's a view on the markets. Rahul, sorry to keep you waiting. I mean, understandably, right? Because I got distracted by the move in the market right now. But let me get your view on Container Corporation of India. The numbers weren't great, Avinash. I looked at the Q4 numbers and they were a little soft. So is this the right opportunity to buy? Will things improve?
No, I think my sense is that, it's better to wait for some time because numbers have been very disappointing. As you rightly pointed out, Alex, both the revenue and the EBITDA and the bottom line growth has been virtually stagnant. And, the bonus has also not been very attractive. They've given a 1:4 bonus. So, I would suggest that, let the stock become X bonus after the split. And after that, one could take a fresh review. I think, they have a very strong positioning in the domestic rail logistic market. But I think numbers don't inspire confidence. So I think it's better to wait for the management call, the commentary to come from the management, and let the stock go X bonus. At that point of time, it could be a better opportunity. And I think if the investor is already holding on, I think he's got to take a long-term view because, these kind of infra bets normally take a long time to get re-rated. And unless numbers are very solid, at least in the very near term, there are not going to be many triggers to rate the stock. So net is long-term positive, but short-term, I think it's going to be very sideways movement.
Okay, all right. Rahul, hopefully that answers your question. Jatin, I understand you have to leave us. Thank you so much for joining us today and for answering all the questions you did, and wish you a happy weekend. All right, Avinash, do stay with us. We'll be back on the other side of this very quick break to take more questions. Viewers, we'll be back before you know it. Do stay tuned.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use
Welcome back. You're watching Ask Profit. This is a show that gets you answers to all of your stock-related questions, and we've been answering quite a few interesting ones. By the way, the numbers that you see on your screen, the landline number at the bottom of the screen is where you can call us, and the number on the top of the screen is where you can send us messages. Do remember to send us your name as well as the location that you're tuning in from. Murli from Bengaluru is calling us. Murli, thanks so much for waiting by, and I really appreciate your patience. How can we help you today?
Thank you, Mr. Alex. Good morning. And my query is, I bought Page Industries, 10 shares after the results at 47,780.
Okay.
Should I hold, considering the good prospects of textile industry in the coming year?
Yeah.
Or should I switch to my MGL? Well, dividend yields are also good, and it is also on a downward trajectory now.
Okay.
MGL, I mean Maharashtra Gas.
Yes. Murli, I know that you call us often, and I'm hopeful that the advice that you get on the show is beneficial to you. I just want to understand Page Industries, the acquisition that you made. You've spent about 4,77,000 rupees or thereabouts. This is not a very substantial portion of your portfolio, right? This is
Right. This only 10 shares I hold.
Got it. Okay, got it. So let me get you a view from Avinash. And the second stock that you wanted to know about was?
Page Industry, whether I should hold, or if you feel it will wait, it will better return will be in MGL, which is a good dividend yield also. Good dividend yield also.
Got it. Avinash, what's for a 1 year view? For a 1 year view. Okay. Avinash, Page Industries. Now, I think there are a lot. Osho, hi. Osho Krishan is joining us right now. Osho, thanks so much for joining in. Avinash, a lot's been said about Page Industries, right? And the question marks about whether or not alternatives are being found by the Indian buyer, whether the valuations are justified and all of that. Would you hold at this point for a year?
Yeah, I think, I think if the investor can hold in for a slightly longer period, because one important aspect is that innerwear companies are now again bouncing back. There was a period of a lull phase where margins were under pressure. But I think if you look at all the companies in the innerwear space, I think definitely Page Industries is the leader. Their brand Jockey is one of the premium brands. And I think over the next 12 to 15 months, one could expect better days. The domestic market has again stabilized, prices have started going up, and most importantly, raw material prices are now well within control. So I think, if the investor can hold on for the next 12 to 15 months, he could definitely expect a decent risk reward, despite the fact that it's not a cheap share. It's a fairly expensive share, but I think an upside of at least 13-14% over the next 12-15% is definitely comfortably possible.
Got it. All right. So that's a view on Page Industries. So hold is a view, but try to broaden your time horizon, Murli, is the advice that Avinash has for you. We've got a next question on IREDA, IREDA, and this is a question from Guru, who's writing in from Mysuru in Karnataka. He's holding 1,000 shares at a price of 154 rupees, so he's in the green, and he's wondering whether to hold or sell. He bought it on the 9th of May, not too long back. So, Osho, on the charts, what are the prospects? And good morning to you.
Very good morning, Alex. Firstly, thank you for inviting me at the show. It's been a long time that we are in touch at the show. So now coming to the technical perspective of IREDA, then this counter has seen some kind of consolidation in the recent period. But the positive development that is being set up in this counter in the last 2 months is that there has been formation of higher lows on the daily time frame chart. So on the higher end, I'm expecting that 180, 182 is a very crucial zone for this counter. Any breakthrough above 182 can provide very strong momentum in the coming period, and one can definitely expect a target of 220 from short to medium term perspective. While on the lower end, the support has upshifted towards the buying price of the buyer, approximately around the zone of 154 to 155 is a very strong support. So I will advise to hold in the investments for IREDA. Any breakthrough above 180 can trigger 40 points of upside movement from short-term time horizon.
All right, so that's a view on IREDA. We've got a next caller from Kerala. Krishna is calling us. Very good morning, Krishna. Where in Kerala are you calling us from, and what would you like to know?
I'm calling from Trivandrum, man. Hi.
Okay.
Yeah, I would love to know, I actually bought ONGC shares yesterday for 240 rupees, almost 12,300 quantity. I would love to know the short-term perspective for 3 to 6 months.
Okay. All right. Yeah, I suppose people from Kerala are allowed to call it Trivandrum and not Thiruvananthapuram, right? But having said that, Krishna, why ONGC though? And you bought it yesterday, you said, after the results?
Yeah, after the results, I mean, I was expecting it to come down a bit, and it came down, I think, 3%, 3.5%. So, yeah, I just wanted to get it. It is for a very short time. It's not based on any fundamental analytics. I just want to buy it and sell it in a bigger profit.
Okay, and what is the time frame that you have? You're already making quite the gain. Yeah.
Sorry? Yeah, I bought it yesterday.
No, I'm saying, what is the time frame that you'd like to hold it for?
Oh, 3 to 6 months max. And yeah, I mean, the stock is consolidating a bit. I've been checking it for some time. So yeah, I would love to sell it at a good price.
Okay, and have you thought of the price that you would like to sell it at?
Not really.
Not really, okay. Okay, so Osho, the question therefore is, what is the potential upside? He's deployed a very significant portion of capital. And he's bought 12,300 shares. And so he's already made quite a bit of a gain just in one day. He seems to have deployed at the low point of yesterday. Would you hold, and what level would you hold for over the next three to 6 months?
See, overall, this counter has been hovering below the 200-day simple moving average, which on technical chart is around the zone of 250, 252 kind of a zone. So breakout should be prudent in this counter above 252 for a upside potential momentum in this counter. But overall, at present, the counter is into a very strong consolidation, and I'm expecting that in the short-term time period, 235 to 40 is a very strong support zone for the counter, and any breakthrough above 252 can provide approximately 20 point of upside movement in a very short-term time horizon. So 270 will be the target that I can advise in the short-term duration, while on the lower end, 235 to 232 should be kept as a stop loss for ONGC for short-term time horizon.
I know that it's only a short term, but I do want to very quickly get a view. Avinash, a quick answer on this one. ONGC numbers were not the best, were a little disappointing, and that's understandable considering that crude has been under a little bit of pressure, right? It's hovering around $65 per barrel, and I don't think that anybody last year would have estimated that crude would be around this level right now. So from that perspective, earnings are likely to be soft in the foreseeable future?
Yeah, I think, Alex, you're absolutely right. I think numbers were not all that great, very disappointing, almost flattish numbers. And I think going forward, if crude prices don't go up significantly, because the profitability for ONGC is directly related to the crude price increase. So my sense is that at best it could be a market performer. I think they've paid a very good dividend, so the dividend yield could be reasonably good. But in terms of the growth quotient, I think the next 6 months, I think unlike the oil marketing companies, which would benefit significantly, from the oil price cut, that could actually boost their GRMs. But in case of ONGC, I think the profitability could remain muted. So I think no great prospects expected, at least in the next 6 to 12 months.
Okay, all right. On the fundamentals, of course, that's the view on ONGC. Let's talk about the next question. It's an interesting one coming in from Venkat, who's writing in from Chennai, and he's asking, between Exide and Amara Raja batteries, which is the better counter to look at purely from the perspective of valuations and I guess also earnings trajectory? Avinash, what is your opinion?
Yeah, I think both the companies have their positives and negatives, but I think I would bet on Amara Raja because clearly, in terms of their capital structure, in terms of their market positioning, they have been now present not only in the automotive segment, but even in the industrial segment. Plus, now they are getting into, lithium batteries. I think the market is an oligopoly market, so I think there's enough growth for both the peers. But I think if one were to look at the next couple of years, then I think Amara Raja could definitely be a tad better, considering that they have a very large exposure to the OEM as well as the replacement market and the telecom market. So I think my sense is Amara Raja would be better from a longer term perspective.
Okay, all right. I just want to point out, viewers, if you've sent a message and there are so many that I'm unable to respond to, it's not like we don't want to, and we'll try and get as many as possible. The next question is from Shiva Kumar, who's writing in from Hyderabad. Kotla Shiva Kumar, he says, and he has got SBI quantity of 130, but he's not given us his buy price. He's looking at whether or not to sell SBI right now. Should he wait? Osho, on the charts, I'm not sure what his buy price is, but if he bought it on the 1st of May, it can't be too different from the current market price. I have not looked at the trajectory. But would you hold?
Yes, on technical front, the counter has given a breakout in the month of April in the last week, and from there onwards, it has even retested the neckline of breakout and again has retested the neckline as of now. But I am expecting that in the coming period, there is a high potential for the counter to test the zone of 850 in the short to medium term time horizon. So definitely a hold from medium term perspective. On the lower end, the support lies around the zone of 765. While on the higher end, any breakthrough above the zone of 820 can provide very strong momentum in the medium term perspective. But again, being a large cap company, the price movement will be gradual. It won't be very significant in a very short term perspective. So one should keep a time horizon of medium term, and the target would be near about 840 to 850. Followed by, we need to review that whether it will be having some further potential or it can enter into a profit booking phase.
Okay. We've got a next caller from Vijayawada, and Raju is calling us. Good morning, Raju. How can we help you today?
Yeah, good morning to all of you. I want to buy NHPC for short term.
Okay. And how do you define that short term?
I mean, keeping 3 to 6 months.
Okay.
Keeping the Q4 results in view, I think it's the Q4 numbers are good, and with a target of approximately 100. So is it possible, shall I enter that counter?
Okay. So if you're asking on the earnings front, then perhaps we'll have to broaden the time horizon. But if you're asking for the next 3 to 6 months, let me get your view on the technicals, because you're asking specifically whether it can hit 100 rupees. And Osho, therefore the question is for you, 3 to 6 month time frame, a 14 rupee upside from this point, is it possible?
There is very high potential for the counter to test the zone of 100 in the medium term time frame. But yes, currently the counter can see some kind of further profit booking or correction towards the zone of nearly 84 to 82 kind of a zone, where one can even deploy the full capital if one wants to have a very strong positioning in NHPC. But as of now, one can start accumulating in a staggered manner. I'm expecting that in the short term period, it might test the zone of 82. And once it tests the zone of 82, then one can even go aggressive in the counter for buying perspective. The immediate target is of 92. And once it crosses the zone of 92, then obviously the counter can see the zone of 3-digit in the medium term time period.
Okay. All right. So that's a view on NHPC. We've got the next question that I want to take on IRCTC, and this is from Balamurli, who's writing in from Chennai, and he's bought 7,200 shares of IRCTC at a price of 410 rupees, and he's making quite the gains. In fact, it's practically a doubler for him. He's doing particularly well. He's a long-term investor, he points out, and he wants to know about the prospects for the next 5 years and whether to hold. He's held despite the kind of drawdowns that you've seen in the last 6 months or so, and he's held through that period of uncertainty, seemingly. I'm just wondering, what are the prospects on the earnings, Avinash? Would you hold? Would you add more at this point?
Yeah, I think my guess is, Alex, IRCT is one of those companies, which has underperformed despite being a platform-based company. See, my sense is unless the investor has got at least a couple of years in mind, this is a business which is going to grow quite rapidly because they are the only quasi-monopoly player as far as the railway ticketing platform is concerned. They've also been investing a lot of money on budget hotels. Plus, I think clearly, if you look at the capital structure of the business, it's a debt-free business. Most importantly, I think if somebody has the patience and the conviction, one could definitely make a decent amount of money in this company, provided, they invest a little bit of time. Very well managed, but I think unfortunately the market has not recognized its true potential. So I think longer term we are positive, but yes, in the short term it will continue to be, in a sideways zone.
Got it. All right. So that's a view on IRCTC. Let's talk about Paradeep Phosphate. We've got Jitendra who's calling us from Hyderabad. Very good morning, Jitendra. How can we help you today?
Yeah, good morning to all members, sir. I'm holding 1700 shares of Paradeep Phosphate 107 range, and it's looking very strong for me. And I would like to hold for December. Correct me if I'm wrong about that. Tell me how long I have to hold for this. And fundamentals and technicals also.
You want both. Okay, so Jitendra, how long to hold is up to you, and it depends on whether or not you want to take money off the table, but I get your question. Let me go to Avinash on this one. Paradeep Phosphates, He's bought at levels of 107, which has turned out to be quite the attractive buy price. Would you hold for a period of... I know that he's talked about December, but he's talked about fundamentals, and so therefore I would assume that you would want him to expand his time horizon as well.
No, I think he can continue to hold. My sense is that, hopefully we have a good monsoon, we have a good rural kind of demand coming in, then I think company should do well. The numbers for FY25 have also been reasonably good. And I think, the company has been a slow mover, but I think if you look at the numbers, my sense is over the next 12 to 15 months, you could expect a decent risk reward. So I think continue to hold.
Hold Paradeep Phosphates is a view on the fundamentals. The stock is up as much as 7% this week itself. Radhika is calling us from Telangana. Very good morning, Radhika. How can we help you today? Okay, I understand that we've lost Radhika. We might just get her back and then we'll take her question. We've got the next question from Raj, who's writing in from Goa, asking about BSE. The stock has seen quite a bit of chop and churn in the recent past. He's looking for whether or not this is a good entry point to buy BSE for a period of 1 year. I suppose the question is on what happens with the expiry day, Avinash, because that's really the latest update and the reason why the stock moved so dramatically yesterday and has bounced back a little bit today. I think a lot of people have pointed out if the NSE does what it is intending to do and shift its expiry to Tuesday, there's nothing stopping BSE from shifting it to Thursday, but in the interim, it might actually lose out in the form of earnings in some form. So what's your reading of the situation? Would you buy at this point?
No, see, I think today, Alex, the stock has gone ex-bonus. It's the first day. So I think I would say that let the stock settle down. And I think the company that is BSE has given a very liberal 2:1 bonus. So there's a lot of liquidity which is going to come in. And there have been a lot of investors who have purchased this stock some time back. So I think, you're going to see a small sell-off from those shareholders who have actually decided to sell their original shares. So my sense is that, as you mentioned rightly, when NSE changes the expiry date to Tuesday, that could definitely impact BSE in the very near term. So I would say it's better to wait for at least some time before the stock settles down and then take a conscious call. So I think there's no hurry to buy it today. Probably wait for maybe a couple of weeks or a month. And I think one could decide. But yes, longer term prospects are definitely solid. But in the very near term, there could be a lot of liquidity flows which could push down the stock to lower levels.
That's a good point. People might look to exit, and that will provide you several opportunities down the road as well. Geeta has got the next question, asking about Hindustan Construction Company, HCC, which he's bought at levels of 44 rupees, and she's wondering whether to hold or sell at this point because she's lost ground. Also, the stock is trading just below 30 rupees per share. Should she hold?
See, overall, this counter has been into a very strong corrective phase and is hovering way below its long-term moving average. So the near-term aspects is again very dicey on the short-term perspective. But looking at the recent development, the counter have seen some kind of vertical rally from the zone of 23 odd levels towards 29-30 kind of a zone as of now. So I will advise to keep this counter with a strict stop loss that is advisable at the rate of 26 rupees. If it falls below 26, then there is a higher possibility for this counter to test the zone of 22 to 23 in the short-term period. So hold it with a stop loss of 26. If there will be any kind of buying momentum, which on the technical front as of now is not looking in the near period, but if there will be in future, then we can see some kind of positive traction to get better exit from the current levels. So hold it with a stop loss of 26 from short-term perspective.
All right. So that's a view on HCC. Abhirami is calling us from Chennai. Good morning, and you're calling us after a while, Abhirami. How are you?
Good morning, sir. Thank you, sir. How are you, sir? Fine,
Very well.
sir. Thank you so much. Sir, I hold the Tamil Nadu Petro for 100 shares.
Okay.
I buy my price is 80 rupees. Can I hold, what is the target of Tamil Nadu Petro?
Okay, and what's the time frame that you have in mind, Abhirami?
5 months, sir, because I have only 5 months or 3 months.
Okay, 5 months or 3 months, all right. So bought very close to the current market price. 80 rupees is the current is the price which he's bought at. Osho on the charts, 3 to 5 months. What are the potential upside and what level would you place the stop loss at?
See, this counter have seen a very strong traction after a very elongated duration of corrective phase. So I'm expecting that there is a possibility of momentum to continue in this counter. Although in the short-term perspective, there can be some kind of consolidation around the zone of 78 to 80 kind of a zone. But on a medium-term time horizon, there is a higher possibility that this counter can test the zone of 92 to 94. So one should definitely stay invested in this counter for an immediate target of 94. And once it reaches the zone of 94, then we again need to review that whether the potential for higher momentum is still pertaining in this counter or not.
Okay. Ajit is writing in asking about Wari Energies and the stock in focus today on account of earnings. He's bought at levels of 3,200, wondering whether to hold because the stock is down about 6% or so, recovered from the low point of the day. Okay, I understand we have to go across to Gautam Adani, the chairman of the Adani Group, speaking at the Rising Northeast Investor Summit. Listen in.
His Excellency Governor of Manipur, Honorable Union Minister Sri Sindhya ji, Captains of Industry and esteemed guests. Namaskar. It is an honor to be speaking at the Rising Northeast Investor Summit. Over the past decade, in the hills and valleys of the Northeast, a new chapter in India's growth story is unfolding. A story rooted in diversity, resilience, and untapped potential. This region is now a source of our cultural pride, economic promise, and a strategic directions. And behind this rise is the vision of one leader who recognizes no borders, only beginnings. Honorable Prime Minister, when you said, act east, act fast, act first, you gave the Northeast is a wake-up call. 65 personal visits, 6.2 lakhs crores of investment since 2014, doubling the road network to 16,000 kilometers, doubling the number of airports to 18. This is not just a policy. It is your hallmark of a big thinking. It is the hallmark of your belief systems. It is the hallmark of your convictions in a Sabka Saath, Sabka Vikas. 3 months ago, in Assam, we pledged an investment of rupees 50,000 crores. Today, once again, humble and inspired by your leaderships, I announce that Adani Group will invest additional 50,000 crores across the Northeast over the next 10 years. Our focus will span green energy, including smart meters, hydro, pump storage, power transmission, roads and highways, digital infrastructure, logistics, as well as capacity building through skilling and vocational training centers. But more than infrastructures, we will invest in people. Every initiative will prioritize local jobs, local entrepreneurships, and a community engagement. This is what Viksit Bharat 2047 is all about. Honorable Prime Minister, we will walk in step with your vision. Honorable Chief Ministers, we will hold hands with your people. Honorable Minister of Northeast, we will echo your mission. And to our brothers and sisters of Northeast, we at Adani will stand beside your dreams, your dignity, and your destiny. Thank you. Jai Hind.
That's huge. That is a biggie. It's out.
Gold Plus Clear Glass. पार हो या नियर, सब कुछ दिखे clear.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use math to predict human behavior?
The 2007 split was a tough one, wasn't it?
I look back, maybe I wanted to take charge of it too quickly. My ego came in the way. Net, a year later, the 3 people who selected me as a CEO said, we don't want any CEO.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome to KYC. I'm Harsh Saita, and I've been wanting to speak to hospitality companies. Why is that so? Because there seems to be a multi-year tailwind with regard to how hospitality as a business is playing out in India. What's causing this? Well, one, there's a strong upcycle. There's very, very strong demand that we are seeing. Occupancies are at their highest. You have room rates also which are inching upwards, and most importantly, demand is outpacing supply at this point. So you're seeing all of those factors play out, and therefore you have a hospitals play today that we're going to talk about, Ventive Hospitality. Why are we going to talk about it? Because one, it is the most recently listed hospitality player. That's one reason. The other one is that it operates around 11 hotels and has a very high concentration to 2 geographies. They're diversifying quickly, and therefore the business is moving along very, very quickly. There are a few notes which also caught my eye, which were interesting, and therefore I found this one particularly interesting in terms of the way in which the business is evolving. But let's talk about what I want to know. The first one is the diversification strategy. there's too much reliance currently on some of their assets, especially asset-wise and geography-wise. Geography-wise, two geographies, Maldives and Pune, account for 80% of the top line. They want to diversify, they've spoken about it, they're doing it as well. But it's going to take them some bit of time to diversify, and how much will that contribute both to top line and bottom line, and how quickly will really therefore be the question. What's the diversification strategy, and is there too much reliance on some of their top assets? Why is occupancy lower than others? Now this is the other reason, and we've seen that at least in the last couple of years, margins have also come off. Occupancy, especially in Maldives, whenever it suffers, you will see an impact on the numbers, and therefore are occupancy levels lower than others, and therefore can we call this a slightly differentiated business and not compare it to some of the others? That's what I'll look to try and break down. Now in terms of cost structure improvements and the margin outlook going forward, this is fairly straightforward. They have a large fixed cost base. If that fixed cost base were to improve, you could well see strong operational efficiency play out, which could improve and impact both margins as well as profitability. My last point is with regard to stake dilution by promoters. Promoters, which is Blackstone and Panchsheel Group, they own 88% of this listed company. There's around an 8% odd pledge, but they are not looking to sell. They are likely looking to dilute. How are they going to dilute, and how quickly? Will that create an overhang for the existing investors? And if you were to consider this as an investment, this would be one of the key reasons which might hold you back. We'll talk about all of this and more over the next 20 minutes or so, and we'll try and question management as well on how they see all of these factors playing out. But first off, let's talk about the metrics we look at in today's KYC. We'll start off with the income statement. Thereafter, we look at the balance sheet, the cash flow. We don't have strong quantifiable return ratios, and therefore what we will do instead, and because the business is evolving so quickly, we'll straight away go to shareholding, street cred, street coverage, we look at valuations, and we will look at guidance and outlook. Really, essentially, that's what I'll be looking to understand, and thereafter we will speak with management as well, and we'll try and get a better understanding of all that is playing out. Let's start off with the income statement now, or rather with what you want to know about the company. Let me first start off with about the company. First one, with regard to how it was started, Panchsheel Group started this, part of their hospitality business. They started with just about 80 odd rooms, and now of course 2017 you had Blackstone join Panchsheel Group in this venture as a partnership. Currently, jointly through this partnership, they operate around 2,000 odd rooms. Listed in December of 2024, they currently operate 11 hotels, 2,036 keys across India and Maldives. As I did say, a large part of what they do is currently focused in Pune and Maldives. They cater to the luxury segment. There is a premium with regard to average room rate, which is ARR, versus peers, because they operate in that luxury segment. In terms of annuity assets, and I did say that they have two sets of assets. One is hospitality, the other one is annuity. Annuity is a rental business, like for example malls and office spaces. Now in terms of malls and office spaces, they have a 95% occupancy, right? So that kind of allows them the flexibility and the recurring cash flow to keep coming in. And then you have, of course, the hospitality business, which they operate through 4 brands, or they've taken 4 brands on board: Marriott, Hilton, Minor International, and Atmosphere Core. So all of those are what they operate. The Ritz-Carlton in Pune and the JW Marriott at Pune are just 2 of the examples of the hotels that are operated by a Ventive. Conrad and Anantara are the other 2 which are operated by Ventive, and then there is Raya, of course, even within the Maldives by Atmosphere, again operated by Ventive. Now, when you're looking at the business breakup, 76% of the top line comes from hospitality and 24% from annuity. So don't write off the annuity business in any mean way, but they are more focused here and they will continue to be more focused here. That's what it currently looks like. This is broadly the split in terms of how the hospitality business top line comes from. 56% of it comes from room rentals, and a massive 35% comes from food and beverages, and there's 9% which is miscellaneous. But that's how the breakup of the hospitality business sits. 35% from food and beverages, that's a large chunk, and mind you, that's a high margin chunk as well. That's broadly the number of keys and each hotel that they have. Look at the JW Marriott, 415 keys that it commands. The Pune JW Marriott is what they operate within that luxury segment. And mind you, you have to contextualize this. 2,036 rooms is what they operate, or keys is what they operate. 415 comes from JW in Pune. Then you have the Ritz, you have the Marriott Suite, you have the DT by Hilton, and you have the Oakwood. Those are just some of the other names. And this is on the annuity side of things. They operate just about 1.8 million square feet in Business Bay, and a total of around 3 million odd square feet is what they operate within all of these locations. Pune, Maldives, Bengaluru are currently focused markets. They're also looking at Varanasi as the other market to possibly open up in the future. The annuity share is expected to drop to 20% by FY28. Just to kind of give you a quick refresh, 24% is what the annuity business currently commands. It is expected to drop to 20% in the next 3 years. So the focus will be more with regard to where hospitality is concerned. Hotels is where they want to be. Now, in terms of, let's start off with the metrics, and we did speak about the 8 metrics that we'll be looking for with regard to this one. I want to first start off with the income statement. And see, while the last couple of years we've not seen profit growth, or we've not seen expansion in profitability in a significant fashion, but what we have seen is over the last 3 years or so, a decentish growth in profitability. When you're looking at the numbers, they do stand out. 90% growth on the top line, EBITDA up 82%, and profit up 79%. That kind of underlines the tailwind that we're seeing with regard to a growing business in a very, very strong space. So you have a strong macro environment, and you have a strong growth lever in terms of demand. And the other piece is also with regard to hotel additions. So both of those are contributing to that growth. You're looking at a 3-year CAGR, 91%, 83%, and 79%. But look at margins, they've come off a wee bit versus FY24, where margins peaked. Also, you had new hotels which will come through, and as the new hotels come in, you will see margins dilute before they go back up, because new hotels are always margin dilutive, and therefore that's one key piece to understand about the hotels business. The average daily rate in the hotels business is up roughly 4% and these are some of the key metrics that you ought to know with regard to how the numbers are shaping up. You'll see revenue per available room is up just about 12% and has been consistently going up. The total revenue per available room is up around 14% at 23,000 rupees. So surely there is enough tailwind with regard to all of these metrics which are supporting the industry as well as this particular business. But that's with regard to the income statement. Let's quickly zoom in on the balance sheet. Now, when you're looking at the balance sheet, equity plus reserves have gone up substantially in FY25, and that is purely and purely because of the equity raise that they've done. When you're looking at the borrowing number as well, even that has gone up. Your cash and bank balances have also increased because of all the fresh money that's coming in. So you have a decentish kind of balance sheet, you have decent size, and your borrowing of around 2,000 crore is not as large for an 18,000 crore market cap. But when you're looking at equity plus reserves, it's around a 1:2 ratio on a debt to equity, which also doesn't look bad. And therefore, we've given this one a thumbs up as well. Let's now quickly zoom into the cash flow. And again, the cash flow also looks equally strong. You're seeing a decent growth clip with regard to cash flow. I also want to quickly mark out profitability. And what I'm trying to underline here is that your profits have also grown largely in line, but your cash flow is growing faster than your profitability. That's one thing to keep in mind. And therefore, the cash is starting to trickle through, and which is again a positive. You look at the net cash flows, slightly distorted figure with regard to FY25 because of that 1,600 crore fundraise that they've done. But outside of that, look at FY22, 23, a reasonable amount of net cash flow as well that the company is clocking. Now I want to look at shareholding, and this is where it starts to get really interesting. You have an 89% holding by promoters. 8% of that approximately is pledged. We will quiz them as to what the plans with regard to this promoter holding is, because they need to dilute, and they need to dilute towards 75%, of course, as per SEBI. How will they do that? Will they sell? Will they dilute through fresh issue? Is really going to be one of the key questions and one of the key overhangs as well. But in terms of street cred, the stock price has done very well for itself. It's up around 18% odd from the issue price, but from the listing price, it's not given any substantial return. So if you were an IPO holder in this share, it was okay. What we're going to do is we're going to cut across Prime Minister Narendra Modi speaking at the Rising Northeast Investor Summit taking place in Delhi.
असम के मुख्यमंत्री हेमंता बिश्व शर्मा जी, अरुणाचल प्रदेश के मुख्यमंत्री पेमा खांडू जी, त्रिपुरा के मुख्यमंत्री माणिक साहा जी, मेघालय के मुख्यमंत्री कोनराड संगमा जी, सिक्किम के मुख्यमंत्री प्रेमसिंह तमांग जी, नागालैंड के मुख्यमंत्री नोफ्यो रियो जी, मिजोरम के मुख्यमंत्री लाल दोहाम जी, सभी इंडस्ट्री लीडर्स, इन्वेस्टर्स, देवी और सज्जनों, आज जब मैं राइजिंग नॉर्थ ईस्ट के इस भव्य मंच पर हूं, तो मन में गर्व है, आत्मीयता है, अपनापन है, और सबसे बड़ी बात है भविष्य को लेकर अपार विश्वास है। अभी कुछ ही महीने पहले यहां भारत मंडपम मैम ने अष्टलक्ष्मी महोत्सव मनाया था। आज हम यहां नॉर्थ ईस्ट में इन्वेस्टमेंट का उत्सव मना रहे हैं। यहां इतनी बड़ी संख्या में इंडस्ट्री लीडर्स आए हैं। ये दिखाता है कि नॉर्थ ईस्ट को लेकर सभी में उत्साह है, उमंग है और नए नए सपने हैं। मैं सभी मंत्रालयों और सभी राज्यों की सरकारों को इस काम के लिए बहुत बहुत बधाई देता हूं। आपके प्रयासों से वहां इन्वेस्टमेंट के लिए एक शानदार माहौल बना है। नॉर्थ ईस्ट राइजिंग समिट, इसकी सफलता के लिए मेरी तरफ से, भारत सरकार की तरफ से आपको बहुत बहुत शुभकामनाएं देता हूं। साथियों, भारत को दुनिया का सबसे डाइवर्स नेशन कहा जाता है और हमारा नॉर्थ ईस्ट इस डाइवर्स नेशन का सबसे डाइवर्स हिस्सा है। ट्रेड से ट्रेडिशन तक, टेक्सटाइल से टूरिज्म तक, नॉर्थ ईस्ट की डाइवर्सिटी ये उसकी बहुत बड़ी स्ट्रेंथ है। नॉर्थ ईस्ट यानी बायो इकोनॉमी और बाम्बू, नॉर्थ ईस्ट यानी टी प्रोडक्शन एंड पेट्रोलियम, नॉर्थ ईस्ट यानी स्पोर्ट्स एंड स्किल, नॉर्थ ईस्ट यानी इको टूरिज्म का इमर्जिंग हब, नॉर्थ ईस्ट यानी ऑर्गेनिक प्रोडक्ट की नई दुनिया, नॉर्थ ईस्ट यानी एनर्जी का पावर हाउस। इसलिए नॉर्थ ईस्ट हमारे लिए अष्टलक्ष्मी है। अष्टलक्ष्मी के इस आशीर्वाद से नॉर्थ ईस्ट का हर राज्य कह रहा है हम निवेश के लिए तैयार हैं, हम नेतृत्व के लिए तैयार हैं। साथियों, विकसित भारत के निर्माण के लिए पूर्वी भारत का विकसित होना बहुत जरूरी है और नॉर्थ ईस्ट पूर्वी भारत का सबसे अहम अंग है। हमारे लिए ईस्ट का मतलब सिर्फ एक दिशा नहीं है, हमारे लिए ईस्ट का मतलब है एम्पावर, एक्ट, स्ट्रेंथन एंड ट्रांसफॉर्म। पूर्वी भारत के लिए यही हमारी सरकार की नीति है। यही पॉलिसी, यही प्रायोरिटी आज पूर्वी भारत को, हमारे नॉर्थ ईस्ट को ग्रोथ के सेंटर स्टेज पर लेकर आई है। साथियों, पिछले 11 वर्षों में जो परिवर्तन नॉर्थ ईस्ट में आया है वो केवल आंकड़ों की बात नहीं है, इस जमीन पर महसूस होने वाला बदलाव है। हमने नॉर्थ ईस्ट के साथ केवल योजनाओं के माध्यम से रिश्ता नहीं जोड़ा, हमने दिल से रिश्ता बनाया है। ये आंकड़ा जो मैं बता रहा हूं ना, सुनकर के हंसते रहोगा। 700 टाइम, 700 से ज्यादा बार हमारे केंद्र सरकार के मंत्री नॉर्थ ईस्ट गए हैं और मेरा नियम जाकर के आने वाला नहीं था, नाइट स्टे करना कंपलसरी था। उन्होंने उस मिट्टी को महसूस किया, लोगों की आंखों में उम्मीद देखी और उस भरोसे को विकास की नीति में बदला। हमने इंफ्रास्ट्रक्चर को सिर्फ ईंट और सीमेंट से नहीं देखा, हमने उसे इमोशनल कनेक्ट का माध्यम बनाया है। हम लुक ईस्ट से आगे बढ़कर एक्ट ईस्ट के मंत्र पर चले और इसी का परिणाम आज हम देख रहे हैं। एक समय था जब नॉर्थ ईस्ट को सिर्फ फ्रंटियर रीजन कहा जाता था, आज ये ग्रोथ का फ्रंट रनर बन रहा है। साथियों, अच्छा इंफ्रास्ट्रक्चर टूरिज्म को अट्रैक्टिव बनाता है। जहां इंफ्रास्ट्रक्चर अच्छा होता है वहां इन्वेस्टर्स को भी एक अलग कॉन्फिडेंस आता है। बेहतर रोड्स, अच्छा पावर इंफ्रास्ट्रक्चर, और लॉजिस्टिक नेटवर्क किसी भी इंडस्ट्री की बैकबोन है। ट्रेड भी वहीं ग्रो करता है जहां सीमलेस कनेक्टिविटी हो, यानी बेहतर इंफ्रास्ट्रक्चर हर डेवलपमेंट की पहली शर्त है, उसका फाउंडेशन है। इसलिए हमने नॉर्थ ईस्ट में इंफ्रास्ट्रक्चर रिवॉल्यूशन शुरू किया है। लंबे समय तक नॉर्थ ईस्ट अभाव में रहा, लेकिन अब नॉर्थ ईस्ट लैंड ऑफ अपॉर्चुनिटीज बन रहा है। हमने नॉर्थ ईस्ट में कनेक्टिविटी इंफ्रास्ट्रक्चर पर लाखों करोड़ रुपए खर्च किए हैं। आप अरुणाचल जाएंगे तो सेला टनल जैसे इंफ्रास्ट्रक्चर आपको मिलेगा। आप असम जाएंगे तो भूपेन हजारिका ब्रिज जैसे कई मेगा प्रोजेक्ट दिखेंगे। सिर्फ एक दशक में नॉर्थ ईस्ट में 11,000 किलोमीटर के नए हाईवे बनाए गए हैं। सैकड़ों किलोमीटर की नई रेल लाइनें बिछाई गई है। नॉर्थ ईस्ट में एयरपोर्ट की संख्या दोगुनी हो चुकी है। ब्रह्मपुत्र और बराग नदियों पर वाटरवेज बन रहे हैं। सैकड़ों की संख्या में मोबाइल टावर्स लगाए गए हैं। और इतना ही नहीं, 1600 किलोमीटर लंबी पाइपलाइन का नॉर्थ ईस्ट गैस ग्रिड भी बनाया गया है। ये इंडस्ट्री को जरूरी गैस सप्लाई का भरोसा देता है। यानी हाईवेज, रेलवेज, वाटरवेज, हाईवेज, हर प्रकार से नॉर्थ ईस्ट की कनेक्टिविटी सशक्त हो रही है। नॉर्थ ईस्ट में जमीन तैयार हो चुकी है। हमारी इंडस्ट्रीज को आगे बढ़कर इस अवसर का पूरा लाभ उठाना चाहिए। आपको फर्स्ट मूवर एडवांटेज से चूकना नहीं है। साथियों, आने वाले दशक में नॉर्थ ईस्ट का ट्रेड पोटेंशियल कई गुना बढ़ने वाला है। आज भारत और आसियान के बीच का ट्रेड वॉल्यूम लगभग $125 बिलियन है। आने वाले वर्षों में ये $200 बिलियन को पार कर जाएगा। नॉर्थ ईस्ट इस ट्रेड का एक मजबूत ब्रिज बनेगा, आसियान के लिए ट्रेड का गेटवे बनेगा। और इसके लिए भी हम जरूरी इंफ्रास्ट्रक्चर पर तेजी से काम कर रहे हैं। भारत, म्यांमार, थाईलैंड ट्राइलेटरल हाईवे से म्यांमार होते हुए थाईलैंड तक सीधा संपर्क होगा। इससे भारत की कनेक्टिविटी थाईलैंड, वियतनाम, लाओस जैसे देशों से और आसान हो जाएगी। हमारी सरकार कलादान मल्टी मॉडल ट्रांजिट प्रोजेक्ट को तेजी से पूरा करने में जुटी है। ये प्रोजेक्ट कोलकाता पोर्ट को म्यांमार के सितवे पोर्ट से जोड़ेगा और मिजोरम होते हुए बाकी नॉर्थ ईस्ट को कनेक्ट करेगा। इससे पश्चिम बंगाल और मिजोरम की दूरी बहुत कम हो जाएगी। ये इंडस्ट्री के लिए, ट्रेड के लिए भी बहुत बड़ा वरदान साबित होगा। साथियों, आज गुवाहाटी, इम्फाल, अगरतला ऐसे शहरों को मल्टी मॉडल लॉजिस्टिक हब के रूप में भी विकसित किया जा रहा है। मेघालय और मिजोरम में लैंड कस्टम स्टेशंस अब इंटरनेशनल ट्रेड को नया विस्तार दे रहे हैं। इन सारे प्रयासों से नॉर्थ ईस्ट इंडो पैसिफिक देशों में ट्रेड का नया नाम बनने जा रहा है। यानी आपके लिए नॉर्थ ईस्ट में संभावनाओं का नया आकाश खुलने जा रहा है। साथियों, आज हम भारत को एक ग्लोबल हेल्थ एंड वेलनेस सॉल्यूशन प्रोवाइडर के रूप में स्थापित कर रहे हैं। हील इन इंडिया, हील इन इंडिया का मंत्र ग्लोबल मंत्र बने, ये हमारा प्रयास है। नॉर्थ ईस्ट में नेचर भी है और ऑर्गेनिक लाइफस्टाइल के लिए एक परफेक्ट डेस्टिनेशन भी है। वहां की बायोडायवर्सिटी, वहां का मौसम वेलनेस के लिए मेडिसिन की तरह है। इसलिए हील इन इंडिया के मिशन में इन्वेस्ट करने के मैं समझता हूं उसके लिए आप नॉर्थ ईस्ट को जरूर एक्सप्लोर करें। साथियों, नॉर्थ ईस्ट के तो कल्चर में ही म्यूजिक है, डांस है, सेलिब्रेशन है। इसलिए ग्लोबल कॉन्फ्रेंसेस हो, कॉन्सेंट हो या फिर डेस्टिनेशन वेडिंग्स, इसके लिए भी नॉर्थ ईस्ट बेहतरीन जगह है। एक तरह से नॉर्थ ईस्ट टूरिज्म के लिए एक कंप्लीट पैकेज है। आप नॉर्थ ईस्ट में विकास का लाभ कोने कोने तक पहुंच रहा है, तो इसका भी पॉजिटिव असर टूरिज्म पर पड़ रहा है। वहां पर्यटकों की संख्या दोगुनी हुई है और ये सिर्फ आंकड़े नहीं है, इससे गांव-गांव में होम स्टे बन रहे हैं। गाइड्स के रूप में नौजवानों को नए मौके मिल रहे हैं। टूर एंड ट्रैवल का पूरा इकोसिस्टम डेवलप हो रहा है। अब हमें इसे और ऊंचाई तक ले जाना है। इको टूरिज्म में, कल्चरल टूरिज्म में आप सभी के लिए निवेश के बहुत सारे नए मौके हैं। साथियों, किसी भी क्षेत्र के विकास के लिए सबसे जरूरी है शांति और कानून व्यवस्था। आतंकवाद हो या अशांति फैलाने वाले माओवादी, हमारी सरकार जीरो टॉलरेंस की नीति पर चलती है। एक समय था जब नॉर्थ ईस्ट के साथ बम, बंदूक और ब्लॉकेड का नाम जुड़ा हुआ था। नॉर्थ ईस्ट कहते ही बम, बंदूक और ब्लॉकेड यही याद आता था। इसका बहुत बड़ा नुकसान वहां के युवाओं को उठाना पड़ा। उनके हाथों से अनगिनत मौके निकल गए। हमारा फोकस नॉर्थ ईस्ट के युवाओं के भविष्य पर है। इसलिए हमने एक के बाद एक शांति समझौते किए, युवाओं को विकास की मुख्य धारा में आने का अवसर दिया। पिछले 10-11 साल में 10,000 से ज्यादा युवाओं ने हथियार छोड़कर शांति का रास्ता चुना है। 10,000 नौजवानों ने। आज नॉर्थ ईस्ट के युवाओं को अपने ही क्षेत्र में रोजगार के लिए, स्वरोजगार के लिए नए मौके मिल रहे हैं। मुद्रा योजना ने नॉर्थ ईस्ट के लाखों युवाओं को हजारों करोड़ रुपए की मदद दी है। एजुकेशन इंस्टीट्यूट्स की बढ़ती संख्या नॉर्थ ईस्ट के युवाओं को स्किल बढ़ाने में मदद कर रही है। आज हमारे नॉर्थ ईस्ट के युवा अब सिर्फ इंटरनेट यूजर नहीं, डिजिटल इनोवेटर बन रहे हैं। 13,000 किलोमीटर से ज्यादा ऑप्टिकल फाइबर, 4G, 5G कवरेज, टेक्नोलॉजी में उभरती संभावनाएं। नॉर्थ ईस्ट का युवा अब अपने शहर में ही बड़े बड़े स्टार्टअप शुरू कर रहा है।
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use
Hello and welcome to Markets at 12. I'm your host Anushri Vakharia. Now the management currently in focus is Sun Pharma. They yesterday announced their fourth quarter earnings with revenue growth of about 8% and which was affected by the US generics weakness. My colleague Varsha spoke to CS Muralidharan, Group Chief Financial Officer at Sun Pharma. Listen into that conversation.
Well, Sun Pharma is in focus. Now, this is on the back of Q4 FY25 numbers. Now, if you see, there was a strong domestic growth that the company has seen, but this was offset by weakness in the US generics. India formulation sales grew 14%. Global specialty sales, if you see, was up almost 8.6%. And US formulation sales saw slight decline of 2.5%. But, you know, to speak about the numbers and how was the quarter and what's the growth outlook ahead, I'm here joined by Mr. Muralidharan, who's the Group CFO of Sun Pharma. Hello and welcome to the show, sir. A pleasure to have you. My first question is on the global specialty sales. If you see, this is after many quarters we have seen this single-digit top-line growth in this business, and so what's the outlook there? Why there was only single-digit growth versus expectation was that specialty business will grow at 10 to 12%.
See, global specialty sales for Q4 was about $295 million, growing about 8.6%. However, it's important to look at the global specialty sales for the full year FY25, which was about $1.216 billion, which is a growth of 17.1%. More important, the share of specialty business to the consolidated revenues in FY25 moved up to 19.7% as against 18% in FY24. If you look at the last couple of fiscal years, we have continuously increased the share of global specialty business to the overall consolidated revenues of the company.
So my question was, in Q4 we have seen this single-digit top-line growth. So any reason? Because over the years we have seen double-digit growth when it comes to specialty business. So any reason why this single-digit growth, and what's the outlook ahead?
So that's why I mentioned that it's sometimes important to look at the full year numbers also instead of one specific quarter. On a full year in FY25, the specialty business grew at 17.1%. All our key specialty products, Ilumya, Cequa, Odomzone, Winlevi, are well positioned to grow, and we expect the growth trajectory to be maintained in the future years.
Understood. And also on the US business, especially the generics business, which has seen a decline, what's the outlook there? So can you see, how do you see this business when it comes to FY26 over FY25?
The US generic pricing environment continues to remain competitive. As we stated earlier, it's also more product specific. The government is also trying to control drug prices through actions like Inflation Reduction Act and PBM reforms. However, said that we expect the pricing pressures in US to continue in the future.
Also on the India business, fantastic growth this year when it comes to India business. Now, should the growth momentum that we've seen in this quarter continue over the next quarters as well?
See, India formulation business, our growth is broad-based and all our therapies are doing well. Our objective has always been to grow in line or faster than the market. While our performance in terms higher than the market, will also important to note that the growth is predominantly led by volumes and new product launches.
Got it. Also on Leqselvi, now the launch seems to have delayed by few quarters because of the litigation and all. So does anything change from this delay? I mean, let's say your expectation when it comes to the competitive dynamics, and also does any unit economics change over here?
So as we stated in the call yesterday, post the favorable judgment, we plan to launch Leqselvi in the second quarter of fiscal FY26. On account of delay, we expect only the timelines have moved. Other than that, we are factored in terms of our launch in our revenue guidance.
Okay. And on the checkpoint asset, what is the timeline? So if I were to talk about the perspective when it comes to timeline, when you are expecting the launch of this product, obviously the deal needs to be completed, but any kind of timelines that you have in mind when it comes to launching the product?
The transaction in process, we expect first to close the transaction and then we will be able to assess and give timelines, exact timelines for the launch of this product in FY26.
Okay, and sir, so you've given a guidance when it comes to FY26 sales growth guidance of mid-single digit to high single digit. Now, are you being more conservative when it comes to guidance, or there are some global uncertainties that you have considered this while giving a guidance?
See, we shared in our earnings call yesterday that on account of various regulatory uncertainties, predominantly in the United States, we have given this conscious wide range of guidance from mid to high single digit growth in FY26.
And any update when it comes to two of your plants, that is Mohali and Halol, as far as FDA issues are concerned, have supplies from Mohali completely normal when it comes to at this point of time?
As far as Halol is concerned, we have informed the agency for an audit. As far as Mohali is concerned, we are working on the remediation procedures. As and when completed, we'll inform the agency. The supplies in Mohali has been resumed gradually.
Okay. And sir, so just trying to understand, we all know the current topic when it comes to pharma sector is tariffs, and of course the Trump's executive order where he wants to reduce the prices of drugs when it comes to prescription drugs. Now, trying to understand the impact of most favored nation when it comes to Sun Pharma as a whole, especially when it comes to your specialty business.
So in respect of both tariffs and MFN, it's important that we await for further clarification from the agency, and then we will be able to assess in terms of how the interpretation and the consequent impact.
So, but any views that you have when it comes to your specialty portfolio? Because I believe, please correct me if I'm wrong, the generic business won't be impacted, but maybe the specialty business would be impacted. So, any view that you have on this?
See, even the latest notification or clarification which came does not give the requisite clarity for us to assess. So it's important that we get more clarity on this matter from the government before we make any assessment whether it's impacting generics or specialty or both. It's too early to comment and interpret unless we have more clarity on the overall notification from the government.
Well, that was the management of Sun Pharma. The stock currently under pressure, seeing cuts of around more than 2% in trade today. But before we head across the markets, how they are panning out, let's go to an NDTV Profit exclusive. SEBI is likely to hold its next board meeting on June 18 with a key focus on improving ease of doing business for market participants. Charu joins us with more details on this.
Hi, so the market regulator, Securities and Exchange Board of India, is likely to hold its next upcoming, board meeting on June 18th, as per 4 sources that spoke to NDTV Profit. Now, the focus is on ease of doing business for market participants. That includes both investors and the companies and intermediaries. The regulator wants to focus on not stifling the market growth and does not want to indulge in any sort of over-regulation. Apart from this, the regulator has also been in the recent past been in touch with several associations, for example, FICCI or Research Analyst Association, and has had the conversations about easing the compliance and other regulatory burden on the participants. Apart from this, there is also a possibility that there could finally be some sort of a finality on the independence of clearing corporations, as well as a mechanism to settle for the brokers who had earlier received a notice for being associated with algorithm platforms. Apart from this, several other consultation papers or proposals that have reached their finality could also be tabled and discussed in the upcoming board meeting.
But let's shift focus back to the monsoon season. And one sector in focus is the FMCG space, which stocks will be benefiting from the rain gods as it pours. Mahima joins us with all the details on this.
Well, how does monsoon affect consumption and what are the stocks to watch out for? Let us find out. The IMD this time has predicted that we are expecting early above monsoons and possibly the earliest in the past 6 years. What this means for consumption is that this could help improve kharif sowing and this could lead to uptick in rural demand. Now, how Nifty FMCG and Nifty consumption has performed over the years when it comes to different types of years having different types of monsoons. In 2024, we had above normal monsoons. Nifty FMCG saw a degrowth of around 0.3%, but this was also due to a lot of other factors. Nifty consumption saw a growth of around 18.6%. In terms of normal monsoons in 2023, we saw a growth of around 29% for Nifty FMCG, and Nifty consumption saw a growth of around 26.8%. Now, when it comes to excess of rains in 2019, we saw excess of rains when Nifty FMCG was down around 1.3% and Nifty consumption was down by about 2.3%. So this means that excess rains definitely not does not paint a good picture for Nifty FMCG as well as Nifty consumption. But in terms of normal rains also, the kind of growth in Nifty FMCG was seen at 2.8% and Nifty consumption saw a growth of around 8%. In terms of deficient rains, Nifty FMCG saw a growth of just about 0.3%. Now, in terms of what this means for the entire space, that is FMCG, good monsoon to support rural demand. Good monsoon means good sowing of crops and good output as well. This means more money in the hands of rural people, and this could lead to a rural demand uptick for staples as well as consumer discretionary. FMCG companies will see a demand uptick on the back of this. Now, few stocks to watch out for in that space. In the staple space, HUL, Nestle, Tata Consumer, Godrej Consumer as well as ITC and Imami are well penetrated in the rural market, so they could see a significant recovery in the rural demand overall. Now, in terms of the other consumption space where consumer durable comes into picture, this could see a downtick because sale of ACs, coolers as well as fans might see a demand slowdown because of early monsoons. That means summer period for them has been curtailed. On the back of this, Dixon has already seen a degrowth of around 23% in consumer electronics in Q4 itself, which provides these ACs and fans and coolers to companies like Blue Star and Voltas. Now, in terms of what stocks to watch out for, well, EMS stocks like Dixon, PG Electroplast and Amber could see a downtick in terms of their sales when it comes to ACs as well as coolers, and Voltas, Blue Star and Symphony in the retail space might see a downtick in terms of their sales. In terms of auto sales, well, because of the rural demand uptick, we might see an overall uptick in two-wheeler sales as well when it comes to autos, and we might also see an uptick in tractor sales because of a better crop output. Now, a few stocks to watch out for in the auto space. In the two-wheeler space, you can watch out for stocks like Bajaj Auto, Hero MotoCorp as well as TVS, and in the tractor space, you can keep an eye on stocks like Eicher Motors as well as VST Tillers. So this is the overall view as to what stocks you can keep in mind when it comes to early monsoons that IMD has predicted this time.
Okay, thank you, Mahima, for that detailed breakdown on what are some of these stocks in radar. But to discuss more on the FMCG and consumption basket as a whole, we're joined by Priyam Tolia, Senior Research Analyst covering FMCG of Axis Securities. Hi, Priyam. Thank you for joining in. Firstly, my question to you is about the prediction that is being made, the IMD that above average monsoon is something that we should be watching out for. Considering that the overall sentiment for the rural side is expected to be positive, just want to get your assessment on what is the kind of predictions that you are seeing in terms of where the demand revival is for some of these and how some of these companies could benefit.
Yeah, so definitely, if you see from the overall perception in terms of the overall FMCG performance going ahead, IMD earlier reported that the rainfall this time around would be the normal, and now the report has been saying that the rainfall will be above normal. If you see from a overall perspective of the FMCG on the demand front, right? So rural continues to perform well. Even this time around, rural has been outperformer compared to the urban markets. So definitely the companies such as both rural focused companies are likely to perform better in the second half. And of course, the agri output as well as the agri sowing is also likely to be, it's a good sign in terms of the overall output from your reports.
So considering that this rural demand uptick that we are seeing, which are some of the stocks in your radar that are expected to benefit out of this? What is the kind of growth picture that you have for the sector as a whole? If you can give us more details. And also on consumer durables, Mahima spoke about how these could be affected on the other side. Can you give us a picture on both the good and the bad?
Okay, so if you see from the rural perspective, we continue to like in FMCG, Varun Beverages, Jyoti Labs, Colgate, right? And of course, the HUL, but HUL would not be that great, but Varun Beverages, Jyoti Labs, Colgate, we continues to like on the overall FMCG space and in terms of the overall demand revival environment, right? So if you see why Varun Beverages is basically the levers for Varun Beverages are, of course, the domestic market as well as the Africa market. So they continue to show the resilient performance in both the side. In terms of the Jyoti Labs, they are expanding their geography into the more rural, and also they are expanding their geography towards the northern and the western side of the region. So they are into distribution expansion. And Colgate, of course, this time around, the Q4 numbers were not that great, but Colgate, we believe that given the stock has corrected so much, and given that the initiatives which are likely to play out in the coming quarters, the company have taken several initiatives. So we believe that the Colgate is also likely to perform better in the second half. We don't like, as of now, the companies which has higher contribution from the urban side, right? For example, it's in Nestle. So we continue to remain not that positive on the Nestle front.
Okay, so now that with ITC's Q4 numbers out, the overall trends of FMCG, what is the key expectations now entering into FY26? What is your assessment in terms of where the revenue growth is? Is it going to be volume led? Is it going to be value led? If you can give us more perspective on that.
Yeah, so if you see particularly from the ITC perspective, the main key driver is basically the sustained performance in the cigarettes portfolio, right? So this time around, they have reported a 5% volume growth, which is commendable, which is ahead of our estimates. If you see from their FMCG portfolio perspective, though they have done better compared to the competition, but still we expect a much higher growth in the coming quarters. And we believe that ITC, of course, is a good play in terms of the overall sustained revenue, which company has been reporting since last quarters.
Okay.
So their cigarette revenue sustained volume growth is the key thing to watch out for.
Okay, so while that's the view for ITC that we are seeing in terms of where the valuations are headed now, there is some bit of a comfort that we are seeing as compared to earlier. Anything that particularly to you looks interesting? I know you spoke about Varun Beverages, which is there, but anything other than that which stands out?
So yeah, valuation perspective, though many have corrected, though many have been in the near to the 5 years or 10 years average price to earning ratio. So we believe that the further downside for the sector at this current environment, right, we expect that it's limited for the overall FMCG perspective. However, we have to see how the company performs in the coming quarters in terms of driving the overall top line growth, and also the key thing is basically the volatility in the raw material prices. Though the palm and crude oil prices have been corrected slightly, but we have to see how the overall raw material prices perform. Versus if you see from the companies which are heavily dependent on the food raw material prices, right? So let's say take the example of Nestle. The coffee and the chocolate prices are continued to at the all-time high, so multi-decadal high, right? So there the challenge remained in terms of the overall margin performance. Rest, we believe that gradually there would be improvement in terms of the overall volume growth as well as the overall margin performance for most of the FMCG companies in the coming quarters. And so yeah.
And even one bracket which has been interesting this quarter is the Alcobev companies. Now they've reported a great set of numbers. What's your outlook in this space?
So we don't cover Alcobev companies, so we won't be able to give the view on that.
Okay, that's fair. Any of the challenges which you still see persisting in FY26 in terms of where the demand is concerned? You've spoken about rural on one side, while urban is a lagging factor over here. So if you can emphasize on that.
Yeah. So if you see from the urban perspective, we still are not seeing meaningful recovery in that front, right? But given the tax relief, also the overall inflation has remained on a comfortable level. So we believe that could be, there will be some kind of a flow through in the second half of FY26, led by the overall festive season. So, so the urban demand revival would be a key thing to watch out for.
And when can we expect that?
So we expect the major recovery is likely to happen only in second half of this year, led by the festive and the wedding season.
Okay. Thank you so much, Priya, for joining us and sharing that perspective on the FMCG companies as a basket as a whole and what could be the way ahead. But Adani Group Chairman Gautam Adani has pledged an additional 50,000 crore rupees investment in the northeastern states. He spoke earlier today at the Northeast Rising Summit in Delhi. Listen in what he had to say.
3 months ago, in Assam, we pledged an investment of rupees 50,000 crores. Today, once again, humble and inspired by your leaderships, I announce that Adani Group will invest additional 50,000 crores across the Northeast over the next 10 years.
Well, that's all the time that we had on this show. Stay tuned to NDTV Profit. Lots more coming on the other side.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use math to predict human behavior?
The 2007 split was a tough one, wasn't it?
I look back, maybe I wanted to take charge of it too quickly. My ego came in the way. Net, a year later, the 3 people who selected me as a CEO said, we don't want any CEO.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims?
Hello and welcome to NDTV Profit. A very good afternoon to all the viewers here watching Profit Buzzers. I'm Hiral Datia and with me is Varsha. Varsha, good afternoon. An interesting day of trade where markets are off the day's highs. If you can quickly pull up Nifty 50 on the screen, as well as if you look at Bank Nifty as well, that will give you the trends right now. Again, we hit a high of 24,900. We've come off from there by around 40 points. But it's an interesting move that we're seeing with gains of 1% coming in on Nifty 50. Let's put up Bank Nifty on the screens and then we'll see the sectoral heat map as well to understand what the trends are indicating so far. If you see in terms of Bank Nifty as well, near the day's highest levels right now with gains of around 0.8% coming in there. In terms of the sectoral heat map, overall consumption is seeing an interesting play today, 1.7% up move, and that has been one of the themes that NDTV Profit has been looking at as to how monsoons and consumption as a play tie up together. We did have an exclusive conversation with the CFO at HUL as well, and you had ITC which has reported numbers. IT also is seeing a good day of trade, and that probably is taking an impact of the US bill that has been passed as well. Media again is seeing some bit of gains today after the last couple of trading sessions which have been a downer. Infra, private banks, oil and gas, all up and about. What's ruling under pressure is a Nifty Pharma. The reason why you're seeing pressure on a Nifty Pharma today is mainly on the back of Sun Pharma, which is pulling Nifty Pharma lower, and the healthcare index, which is seeing cuts today. Let's pull up the heat map in terms of Nifty 50 to understand the kind of sectoral stock-specific trends that you are looking at. So Eternal, the consumption pack is up at play. 4% up move, ITC, Geo Financial, Power Grid, SBI Life and Trent. These are a few of the top gainers today, and it's only a Sun Pharma which is again under pressure. So the breadth in terms of Nifty 50 absolutely in favor of the bulls. The bears apparently are now taking a breather right now. If you talk about the advance decline ratio as well, 700 declines to the number of advances. So the advances are almost more than double of the declines in trade. Interesting moves that is happening in terms of the broader markets as well, because that's where the action is, which is absolutely stock specific, Varsha.
Yes, absolutely. And as you rightly said, so broader markets are actually mirroring benchmarks. So if I were to talk about Nifty Midcap 150, let's see what that counter is doing, is up almost 0.58%. Now, on the gainer side, you have New India Assurance, you have Endurance Tech, Max Financials, and Tata Chemicals is also gaining when it comes to Nifty Midcap 150. On the loser side, though, you have Concor, you have KPR Mill, GMR Airport, and RVNL, which are losing when it comes to Nifty Midcap 150. On the let's see what small cap 250 is doing. Nifty small cap 250, if you can pull up that chart, it's up almost 0.67%, mirroring benchmark index. While on the gainer side, you have Honasa Consumer, of course, buzzing on the back of earnings, good growth there, and Clean Science. You have TVS Supply, you have Affle India, who are buzzing when it comes to Nifty Small Cap 250. On the losers side, though, you have Mahindra Life, you have Raymond and Deepak Fertilizers. Yesterday, in fact, Deepak Fertilizers came out with its earnings. Lower tax actually, gave higher profit to the company. So yes, cereal. So overall, if you see, broader markets are actually buzzing on the back of earnings.
Absolutely, it's an earnings day that you are focusing on as we speak. But let's first welcome in our guest Sharmila Joshi as well. Sharmila, good afternoon and welcome to the show, and a pleasure to speak to you as always. Let me first start with not what's happening in the markets, but overall, one of the top gainers in Nifty 50 is a Zomato, that's Eternal. Strong moves coming in on this counter, and if you pull up a long-term chart as well, it's interesting to see how Zomato has moved in the last 1 month. What would you advise investors to do, because the volumes are strong today? A 4% up move, if we can just have a 1 month chart as well in terms of Zomato, because that will tell you the kind of gyrations that have happened as well. There you go. It's an absolutely flat stock. a good buy at current levels, or would you say still avoid?
Well, I think it would largely depend on what kind of horizon you have. Because, if you buy at this level, one thing is for sure, I don't think the stock is going up in a hurry. Because I think the valuations are sort of fair and a lot of the positives are now in the price. So, when we had that beaten down price and things looked a little iffy, from there we've seen a good strong recovery, decent numbers. We have the vertical which does faster delivery, doing better, etc. So I think, given our landscape and given seeing how both Swiggy as well as Zomato are sort of panning out their business going ahead, I'm in a sense very optimistic about their business models for the metros and the tier 2, tier 3 cities and the kind of spread that we are seeing there. But from a valuation perspective, perhaps you need to be a little meaning, I think the returns won't be as much as what we got when it bounced off its lows. But that said, from this level, there are definitely good returns to be made. Only thing is that you will have to temper down your expectations and be invested in it with a sort of a slightly longer, like a 12-month horizon at least.
Thank you so much for that view, Sharmila. Well, on that note, FMCG giant ITC saw its revenue surge in Q4, but margins faltered under inflation. We have my colleague Mahima joining us with more on the company's Q4 earnings.
So it's a decent quarter for ITC where Q4 FY25 stands. Revenue was a beat, but EBITDA and net profit was a miss in terms of estimates. Cigarette business saw a steady growth and agri business saw an outperformance. There was high inflationary pressure on the FMCG business where margins got impacted. Margins also got impacted due to the cigarette business due to inflation in tobacco leaf, and paper business was under pressure. In terms of numbers, revenue was up 9.4%, EBITDA up 2.5%. Margins fell to 34.7%, and the expectation was that the margins will come at 35.4%, so a disappointing number there. But net profit from continued operation was up 0.8%. In terms of segmental performance, cigarette revenue grew by 6%. The implied volume growth that the brokerages are right now penciling in is roughly between 4 to 5%. FMCG business grew 5%. Agri business saw a growth of almost 18%, and paper business saw a growth of 5.5%. Now, what our brokerage is penciling in, Morgan Stanley has maintained overweight with a target price of 500. They're saying overall it's a beat. Top line was ahead across businesses. Margins were better across business except paper. Growth was aided by portfolio and micro market interventions countering illicit trade as well as focus on competitive belts. Slow cigarette EBIT growth owing to inflation partially mitigated by improved mix. And lastly, paper impacted by muted domestic demand and Chinese and Indonesian supplies have kind of seen a surge in terms of wood prices as well. So this is the overall view as to how Q4 has panned out for ITC.
Right. Thank you so much for that view, Mahima. Well, Sharmila, let me come to you on that view. But before that, HUL will now focus on driving double-digit EPS growth, says the company CFO Ritesh Tiwari in an exclusive conversation with NDTV Profit. Listen in as he talks about the company's growth guidance going forward.
Medium to long-term intention is to ensure we are able to drive double-digit EPS growth. If you look at the last decade, our double-digit EPS growth was driven by top line and bottom line improvement. Going forward, the way we see, it will be a double-digit EPS growth, but driven by top line growth and modest margin improvement. The latest guidance that we gave of our EBITDA, which will be more now trading into 22 to 23% zone, that's for next few quarters.
Yeah.
But if I look at medium to long term, we will keep making modest margin improvement. But growth of EPS will be top line driven. India has seen 7 to 8% in the past, typically market growth, and this 7 to 8% market growth has come roughly half from volumes and half has come from price. As we speak today, overall climate and overall where commodity levels are, we don't see high levels of pricing. We see more modest pricing. And our own outlook is low single digit pricing outlook. But we do believe compared to last decade, FMCG industry will grow faster compared to what it has grown in the last decade. The sheer amount of consumption headroom that we have in the country, the entire India growth story, the demographic dividend of the country, we do expect all of that will augur well for FMCG. So I do expect FMCG industry to grow faster in the next decade compared to the previous decade.
That's a strong point coming in terms of the EPS growth that the HUL CFO is expecting. But moving on, as the monsoon season is approaching, let's understand how the sector reacts, which stocks benefit, because the monsoon is coming in earlier. It is expected to be better than normal. Mahima is back with us with all the data crunching that she has done over the last 5 to 10 years. Mahima, over to you.
Well, how does monsoon affect consumption and what are the stocks to watch out for? Let us find out. The IMD this time has predicted that we are expecting early above monsoons and possibly the earliest in the past 6 years. What this means for consumption is that this could help improve kharif sowing and this could lead to uptick in rural demand. Now, how Nifty FMCG and Nifty consumption has performed over the years when it comes to different types of years having different types of monsoons. In 2024, we had above normal monsoons. Nifty FMCG saw a degrowth of around 0.3%, but this was also due to a lot of other factors. Nifty consumption saw a growth of around 18.6%. In terms of normal monsoons in 2023, we saw a growth of around 29% for Nifty FMCG and Nifty consumption saw a growth of around 26.8%. Now, when it comes to excess of rains in 2019, we saw excess of rains when Nifty FMCG was down around 1.3% and Nifty consumption was down by about 2.3%. So this means that excess rains definitely not does not paint a good picture for Nifty FMCG as well as Nifty consumption. But in terms of normal rains also, the kind of growth in Nifty FMCG was seen at 2.8% and Nifty consumption saw a growth of around 8%. In terms of deficient rains, Nifty FMCG saw a growth of just about 0.3%. Now, in terms of what this means for the entire space, that is FMCG, good monsoon to support rural demand. Good monsoon means good sowing of crops and good output as well. This means more money in the hands of rural people, and this could lead to a rural demand uptick for staples as well as consumer discretionary. FMCG companies will see a demand uptick on the back of this. Now, few stocks to watch out for in that space. In the staple space, HUL, Nestle, Tata Consumer, Godrej Consumer as well as ITC and Imami are well penetrated in the rural market, so they could see a significant recovery in the rural demand overall. Now, in terms of the other consumption space where consumer durable comes into picture, this could see a downtick because sale of ACs, coolers as well as fans might see a demand slowdown because of early monsoons. That means summer period for them has been curtailed. On the back of this, Dixon has already seen a degrowth of around 23% in consumer electronics in Q4 itself, which provides these ACs and fans and coolers to companies like Blue Star and Voltas. Now, in terms of what stocks to watch out for, well, EMS stocks like Dixon, PG Electroplast and Amber could see a downtick in terms of their sales when it comes to ACs as well as coolers, and Voltas, Blue Star and Symphony in the retail space might see a downtick in terms of their sales. In terms of auto sales, well, because of the rural demand uptick, we might see an overall uptick in two-wheeler sales as well when it comes to autos, and we might also see an uptick in tractor sales because of a better crop output. Now, a few stocks to watch out for in the auto space. In the two-wheeler space, you can watch out for stocks like Bajaj Auto, Hero MotoCorp as well as TVS, and in the tractor space, you can keep an eye on stocks like Eicher Motors as well as VST Tillers. So this is the overall view as to what stocks you can keep in mind when it comes to early monsoons that IMD has predicted this time.
Right. Thank you so much, Mahima, for all the details. Sharmila, let me ask you on the FMCG sector, your view on the whole FMCG sector, considering the early expected monsoon, which will be benefited for the sector, and also the ITC result that has come.
Well, overall, I would say the view is positive. Of course, one of the reasons is that if we have a normal monsoon, that is a good sign for FMCG. And I also want to link it to the fact that FMCG has been a bit of a laggard sector over this last year. And some of the reasons are not really just monsoon, but they are also related to a whole host of other factors. And one is expecting that you should see volume demand pick up as we go ahead. Also, let's not forget that we've seen an interest rate cut, and that is also likely to continue. So not only will the rural demand be better, but overall there would be more money to spend, and you would see a positive impact of that on some of the FMCG companies like HUL or ITC and so on and so forth. So overall, I'm expecting a good good response from FMCG because of monsoons, and I think that will get reflected in the prices. Just as a disclosure, I own both HUL and ITC for the longest time, and I'm not in any hurry to sell. Because I think, when we speak specifically of ITC, since you asked the question, in a sense, cigarette businesses, if you look globally, they are dated. But I think if you look at our data, the kind of growth that the cigarette business have shown both for Godfrey Phillips as well as ITC, it's been good. And in spite of all the budgets going against them and the taxes and etc., their numbers stay strong, and that is still the biggest revenue contributor to ITC. So yes, a positive view on ITC. Again, I think your holding period has to be long term.
Right, so that's with regards to ITC. Sharmila, one question I have for you is with regards to pharma and healthcare as the sector goes. A strong rally that we've seen this week itself. The outlook is strong. The quarterly numbers so far that have been reported kind of have been in line. Taking into consideration what's happening today, there is some amount of profit booking that's coming in, specifically with regards to Sun Pharma. How are you looking at the sector, and any topics that you have from the pharma space?
I think the thing that makes me most happy at this point in time is the fact that stocks are largely relating, sort of reacting to numbers. So if the numbers are good, we are seeing that uptick in stock prices, and if there is a disappointment for any reason, that is also getting captured. So of course, all these reactions in stock prices, if you are a longer term investor, you would like sort of examine those and see if they are really going to seriously impact your view in the long term. And I think in the case of Sun Pharma, again, I'm a long term investor, so I've been holding the stock for I don't know how many years. So I don't really see this as a sort of a very big concern. And overall, I think that where both healthcare as well as pharma are concerned, I think that in our current context, these are both good sectors to be invested in. And within that space, I do like slightly, the larger pharma names, Sun Pharma being one of them. I think Dr. Reddy's, Divi's gives decent numbers. So, stocks like that, which again, I think, the view has to be slightly long term. And as I'm saying, they've all reacted to numbers, and I think that's really a very good sign.
Right. Thank you so much, Sharmila, for that view. On that note, Mankind Pharma is actually in focus on the back of Q4 numbers that the company had reported. Overall, if you see, a good set of numbers, but EBITDA margins were kind of dragged, and the highlighting factor over here was export business, which grew almost 100%, good growth when it comes to domestic formulation as well. But to speak more on numbers and how was the quarter and what's the growth outlook ahead, we are here joined by Mr. Rajiv Juneja, who is Managing Director and Vice Chairman at the company. Hello Mr. Juneja, welcome to the show, and great, always pleasure to have you. Just starting with, how was the Q4 when it comes to your company? What were the misses and what were the expectations?
We always look everything in long term. Q4 is one part of that. Last couple of quarters, we have done plenty of corrective actions. See, in the journey of every organization, there comes a time when it realizes that there's certain corrections should be done. And if the management is very courageous, goes for it. Because in my career, I've seen that some of the best companies rose very fast, then plateau came, some kind of a downfall was there. And with every change, some kind of a corrective actions are required. In last 1 year time, we have taken a lot of corrective actions in terms of replacement of people, change of leadership, commercial excellence, processes, because Mankind has always been a company of having a bottom-up approach. So advantage basically is what? That we are absolutely aligned with the ground realities. Disadvantage is 28 divisions were not talking to each other properly and nicely. So top-down approach was supposed to be brought. So we brought a lot of leaders from outside. So whatever numbers are you seeing right now, they are basically as per the projection. 26% is our EBITDA margin annually. Even fourth quarter was good enough. And you must be seeing that we have given a guidance of 26%, for which market is asking why 25-26%, because what is better if we give 27% and do 26.5%, or vice versa, we give 25-26% and do more than that.
Right.
We look everything from that angle.
Okay. Rajiv, good afternoon. This is Hiral on this side. An interesting point that you made. But if I have to look at your 9 months of FY25, there has been moderation that's happened in the India business. Approximately 9% is excluding BSV as well, from a double-digit growth that you had seen in the past. I think if you have to look at the CAGR growth from FY20 to 24, it's been around 13 to 14%. Firstly, are you expecting to see a reversal on that front? Because there were regulatory barriers in key products like Codistar, which impacted growth this time around. There was unwanted price control. There has been competition in few of the products and markets as well. And there have been corrective action that you've taken from a field force efficiency perspective. So everything put together, how soon will you be going back to that double-digit growth in terms of your India business?
See, we decided to do all the corrective actions before March 25. That we have done. But naturally, once you basically hire new people, they replace older people, it takes, few months to really, get acquainted with the current situation. I feel, next quarter onwards, things will be all right. As far as this year guidelines is that we will be 1.2 to 1.3 times to the market, IPM market, that is there. And whatever corrective actions we have done, regulatory is one part, but major part basically is what? This basically has been done intentionally. Doing this commercial excellence, changing people, it's all because of that. And we are not worried about that. In this time, what basically we have done, we have made ourselves internally stronger. Foundations were given more importance than outside world results. That we have done last couple of quarters. We are very confident that we'll be doing much better than this. If you ask me 9%, we are never happy. We are very, very unhappy people when we see 9-10% kind of a growth. We expected more than that.
Got that view. Also, Mr. Juneja, on the BSV portfolio, just wanted to, which includes the restructuring in your prescription drugs as well. What was the growth when it comes to BSV portfolio, and what is the outlook for FY26?
In the month of October, we took BSV, and it has many parts. One part was their super specialty business, IVF, critical. The second was branded generic, which they acquired from TTK. That business has been taken in the fold of Mankind, and every sort of a corrective action has been done, and we expect good growth. And overall, we say that we'll be growing more than the market, 1.2 to 1.3 actual market. Growth of BSV products, we expect 18 to 20%.
Also, sticking to BSV only, so you earlier had mentioned that BSV margins were closer to the average EBITDA margins that the Mankind has, but going forward you also mentioned that you were expecting, or rather the BSV has a potential to take margins to 30%, given the high entry barrier portfolio that you have. So when can you achieve that 30% mark, and are you sticking to that guidance?
Absolutely stick to the same guidance. Next year projection is 27%, and hopefully each year 0.5 to 1% more EBITDA margins would be there. In the next 2-3 years time, this will reach to 30%. We absolutely stand with our own statement.
So Rajiv, while BSV will be EBITDA accretive from what you're saying right now, with regards to the way BSV has been funded, it will dilute your near-term EPS. If so, how are you? From when do you see it becoming EPS accretive once again?
See, our job basically is making sure that things are fundamentally right, and we hope so that by the end of 27, this will be EBITDA accretive. Okay. Because you just look at the statement made by the management. We said that by the starting of this year only, end of last year only, our EBITDA to debt ratio would be approximately less than 2 times. So it stands 1.8x right now. We said that we'll sell our Mahananda property. We sold it. We said we'll go for a QIP. We have done that. And one more thing I just want to mention here, after a lot of good number of years, for the first time, our new launches have really shown, have really come in top 3, top 4 kind of best launches of the year. This has happened after a long period. Why? Because we have taken corrective actions. We are working in that direction.
Got that view. Also, on the export side, Mr. Juneja, so good growth in exports since last few quarters, and this time around it was 100% growth. What is the outlook there going forward, maybe for FY26 and also for next 2 to 3 years?
We always said that when it comes to export, we are very, very choosy. If a product is complex, as most of the products of BSV are complex and difficult to make, we expect good growth from BSV side. As far as mankind is concerned, this will be having a okay kind of a growth. Because until and unless we have something which is difficult to make, complex in nature, we are not interested. Anything which can really add to our profits will be good. And if you just look at how much export mankind does as a whole, 15% to total sales.
Okay, but any plans, Rajiv, in terms of increasing exports from here on? And secondly, if so, what's the kind of exposure do you have to the US, and how are you viewing the entire tariff war right now? Any impact?
85% things of mankind happens in India. We are very, very India-focused company. 15% is export. And in export, we don't export just common vanilla products. They're all difficult to make. We really don't know what kind of a tariff would be there, but we know that our products are in a great demand and would be in great demand because not many competitors are there in US side. And in US, BSV has no exposure. BSV is very strong in the rest of the world.
Okay, and so Rajiv, because you said that you export products which are kind of specialty products, I would say. The recent Trump's executive order of most preferred nations, or the executive order where he wants to decrease the prescription drug prices, any impact that you can have on your specialty portfolio?
It is very minuscule. How much we export, if you just look at the total universe of mankind, the export to US would be very, very less. Out of 15%, maybe not more than 50%. 5%, as a whole, 5% would be export to US. So you can really count yourself how much impact there would be on mankind.
All right. Well, thank you so much, Mr. Juneja, for answering the questions, and all the best.
Thank you so much.
In fact, we spoke to CS Muralidharan, who's a Group Chief Financial Officer at Sun Pharma, about their growth outlook as well. Listen in.
So that's why I mentioned that it's sometimes important to look at the full year numbers also, instead of one specific quarter. On a full year in FY25, the specialty business grew at 17.1%. All our key specialty products, Ilumya, Cequa, Odomzone, Winlevi, are well positioned to grow, and we expect the growth trajectory to be maintained in the future years.
Well, this is the outlook that Sun Pharma has when it comes to FY26 and going ahead. But viewers, time for a quick break. Don't go anywhere. Stay tuned to NDTV Profit.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people, or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use math to predict human behavior?
2007 split was a tough one, wasn't it?
I look back, maybe I wanted to take charge of it too quickly. My ego came in the way. Net, a year later, the three people who selected me as a CEO said, we don't want any CEO.
Do you really know the company you invest in? What is the real picture behind?
Benchmark gained close to 1% but trade off days high. All sectors except pharma trade in green. Small and mid-cap indices also trade higher. Sun Pharma falls close to 3% as its Q4 fell by 14%, was impacted by exceptional items, strong domestic growth offset by weakness in US generics. HUL is aiming at double-digit EPS growth in medium to long term. CFO Ritesh Tiwari tells NDTV Profit, adds that the ice cream business is a high-growth, low-margin business, the plans to demerge and list it. Honasa jumps over 16% after its Q4 EBITDA and profit beat estimates while revenue came in line. Company saw double-digit growth in key segments. Jindal Poly down over 2% as the fire continues to smolder at its plant in Maharashtra's Nasik. Fire brigade is using foam to control the fire. This impacts approximately 90% of its production. Welcome to Profit Buzzers. Let's see, how markets are doing. Let's see what Nifty 50 is. We have seen the recovery, or rather, market is actually doing very well when it comes to Nifty 50. Let's see, it's up almost. There you go. It's up almost 1%, over 1%, I would say. On the gainer side, you have Eternal, that is Zomato. You have ITC on the back of numbers. You have Power Grid, SBI Life buzzing in the trade today when it comes to Nifty 50. On the loser side, you have Sun Pharma on the back of weak Q4 earnings, I would say, and also the soft guidance that the company has given for FY26. Even Maruti Suzuki, Hindalco, Tata Motors are also losers when it comes to benchmark indices. Let's pull up the sectorial heat map. Let's see which all sectors are buzzing. I think barring healthcare and pharma, every sector is in green. You have Nifty FMCG, IT, Nifty IT, and Nifty Infra. Basically, except healthcare and pharma, everything is in green today. Well, on the broader markets, though, broader markets are actually mirroring when it comes to are mirroring with benchmark. On Nifty Midcap 150, if you see, you have gainers on the New India, you have Endurance Tech, you have Max Financials, Tata Chem. On the losers side, though, you have Concor, KPR Mill, GMR Airport, RVNL. Let's pull up Nifty Small Cap 250. On the gainer side, you have Honasa Consumer on the back of earnings, you have Clean Science, you have TVS Supply, you have Affle India. While on the loser side, though, you have Mahindra Life, you have Raymond, you have Deepak Fertilizers as well. Yesterday came out with the earnings. But on that note, let me invite our second guest, who is Akshay Bhagwat, Senior VP at JM Financial. Welcome, Akshay. And just wanted to have your view on the market. How are charts looking?
Good afternoon. Well, the charts are absolutely fine. Yesterday, you did see a strong recovery on the weekly expiry day for the Nifty coming from the levels of 24,500. So that just clears off the support base and cements the support of 24,500 for the May month. And with the momentum kicking back again, the market probably again is heading for its swing high of 25,100, from where we saw some minor correction in the last week. So 25,100 is the upside, and plus that you have further targets to go. So overall, a positive view on the market continues.
Thank you for that view. Well, moving on, Honasa is in focus after posting its Q4 numbers. The company has seen double-digit revenue growth in key categories on a year-on-year basis. Mahima joins it with more details.
It's been a great quarter for Honasa this particular quarter, and this is because there has been green shoots that have been observed in their stores. Now revenue was largely in line, EBITDA and net profit was a beat in terms of its estimates. There has been a double-digit YOY growth in its key categories, and modern trade has showed a 20% plus YOY offtake growth. Volume growth stood at 21% this particular quarter. In terms of numbers, revenue was up 13%, EBITDA down 17%, but better than expected. Margins at 5%, much better than that of expectations of around 3.4%. Net profit was down 17%, but better than what the street was expecting. Street was expecting a 16 crore net profit versus that of net profit that came in at 25 crores. EBITDA was down due to 20% uptick in other expenses as well. Now, in terms of what brokerages are expecting, well, Goldman Sachs has maintained a neutral but hiked the target price to 275. They're saying that there are encouraging green shoots overall. Sequential growth recovery in Q4 has been observed. Mamaearth's improving trends is driving the growth in terms of recovery. Offline channel revamp has shown results this particular quarter. Honasa's derma skincare brands continue to post strong performance. EBITDA margins to recover and will likely cross the FY24 levels only in FY27 according to them, which is why they've maintained a neutral. So this is the overall view as to what's happened with Honasa this particular quarter and how it is fair.
Right. Thank you, Mahima, for all the details. Well, Honasa stock is up almost 15% in trade today. Sharmila, what is your view on Honasa?
Well, it's a very interesting space if you ask me, and I think that this is one segment that all of us are very well qualified to comment on, because I think beauty and personal care, if you look at what Indian brands are trying and the kind of market that they have over there and the kind of products that they are putting out, I think they're absolutely killing it. I think what went wrong for Mamaearth was the fact that they had too many products and they were trying to do too many things together, and now we are seeing that their sort of focus has found the things that they were trying to do. They're sort of showing up in the bottom line, and hopefully they will continue from here. From a valuation perspective, it's still not a buy for me, but I think it is very heartening to see that they're finally sort of getting their act together in terms of what are the spaces, what space they need to be in, and how their marketing should be, etc. Because according to me, the market size in this segment is absolutely untapped, and it's huge.
Right. Thank you for that view, Akshay. Stock is up almost 15%. And now, what is your view? Should investors, book their profits and sell the stock?
Well, if you actually look at the intraday move, 15% has happened actually, I think, after almost 3-5 months, because if you recollect 6 months back, it was entirely a different story. So the stock is cemented a bottom or a support at 260, and the recovery today is pretty strong. And technically, right now, what I understand is 360 is the short to medium term target which the stock may head for. So if one is holding on to this, 360 is the point where you can consider taking some profits off the table.
Got that view. Sticking to that, if you see festive season boosts momentum for Metro Brands in Q4 also. Now, we spoke to Nissan Joseph, who is the CEO of Metro Brands, earlier today about the company's growth guidance going forward. Listen in.
Yeah, so you've seen us have 2 quarters worth of double-digit growth, right? And what we've guided to at a long-term basis is somewhere between a 12 and 15% CAGR, right? And we're not going to jump right back up to that overnight, but I think the indications are that we are headed that way. So that's a positive for us, that we should be getting back on that track. Overall, we feel good about the consumer sentiment that we're seeing out there, the way they've taken to some of our new ranges, our new collections. Overall, it's been an upbeat experience.
Right. So this is the growth prospects. When it comes to Metro Brands, interesting set of company. When it comes to if you compare this with Relaxo, the Metro Brands have a higher margin products than they. So I think Metro Brands is a platform when it comes to foreign brands also. But let me just ask this question to Sharmila. Sharmila, how are you seeing Metro Brands?
This space was a very promising space, not just Metro, but all the names that you can find over there, whether all the listed companies, Relaxo, etc. But the thing is that somewhere we've seen that volumes have not been that great, and that has impacted all their stock prices. But so I think the heartening thing here was that they're seeing that growth back, and they're expecting sales to recover slowly, and that growth momentum to be catching up. So I think that's a great sign, because I think in terms of a PE correction that has sort of happened now in that space, and they've gone from being very overvalued to sort of okayish levels. And if you see growth, then I think in their sales, then that will get reflected in the stock price as well.
That view. Akshay, how are charts looking when it comes to metro brands? You tracking?
Yeah. So monthly charts absolutely are pretty strong from a longer term perspective. Just the problem is that since January 2024, it's been stuck in the range, but the clarity is emerging that 1000 is a very strong support base. And the way this stock is shaping up, it's more of a buy and hold with a minimum time horizon of 1 year, where the target anticipated are around the all-time highs of 1400. This is just more of a stopover resistance, and technically further higher targets of around 1550 can be anticipated. So hold, have an investment perspective with minimum 1 year plus time horizon, and 1400 and 1550 are the two targets you can look forward to.
Right, got that view. Well, moving on, AI is the internet moment for entire world, says Pankaj Murarka, who's the CIO at Renaissance Investment Managers, listening to the conversation where he speaks about how AI will benefit the IT industry space in coming years.
There have been a lot of concerns that AI will cannibalize and negatively impact IT services company in India. But I don't think so that's going to be the case. I think there will be, a resetting of skill sets within the IT companies, and IT companies are pretty agile. They've navigated multiple technology shifts and trends over the last 20 years as the world moved, from ERP or cloud to ERP to cloud to digital and so on and so forth. And I think this is going to be the internet moment of the world, which effectively, I mean, the tech spends that we over the next 10 years, the surge that we'll see will be very significant. And as you rightly said, IT services company have a very important role to play because now that AI is here, or Chat GPT or whatever other fundamental foundation models are in place, those need to be implemented, and that can only be done and integrated into businesses, and that will mean huge amount of workflow for IT services companies.
Now, next stock which is actually in focus is KNR Construction. Let's see what that stock is doing in trade today. It's because company has been, NHI has actually blacklisted KNI Construction from bidding for 1 month. It's down almost 2.7%. But my colleague Anushi actually tracks this space very well. Anushi, just tell our viewers what is the update, because NHAI has blacklisted KNR Construction.
Right, Varsha, I'll give you the full update. What is happening now? They've blacklisted over NH66 collapse in Malappuram is what we are seeing, and they issued a show cause notice to the company. NHAI is suspending it from participating in future bidding for a period of 1 month. Now, do note that it's a period of 1 month only that we are looking at in terms of where the order bids are concerned. So, how this is expected to create an impact on the business is something yet to be ascertained. While company is still in process of ascertaining a financial impact on the operations given. Do note that the company already has a pretty large sizable of an order book. They have an order book of about 38,884 crore. This is as of the March figure that we are seeing, of which 54% is the total contribution that we are seeing from road segment. While it has a particularly big chunk of contribution coming from this area in particular, it's the tenure of this order bid that we are looking at from which they suspended is particularly smaller. So any sort of impact and time kind of on this financial side of it is something that we'll still have to wait for.
Right. Thank you, Anushi, for all the details. Sharmila, just wanted to have your view on KNR Construction. You've been tracking?
Not really, and I think you need to wait it out to see what this blacklisting means for them.
Got it. And Akshay, how are charts looking when it comes to KNR Construction? Stock is down almost 2.6%.
Yeah, for KNR Construction, what I understand is the stock is down and it's trading very near to a very key important support on the weekly charts. That's the level of 200. So technically, yes, right now from the short-term perspective, it's down. There is a minor resistance at the levels of 240, but the key point to watch in the stock would be 200. So till it is about 200, rest assured that these dips which we are seeing are minor dips, and eventually another reattempt for a bounce back can be made. So those holding the stock should have strict stop losses below 200, and any recovery attempts can see an upside till 275 or 280, where one may consider an exit in this counter.
Right, thank you for that view. Next stock which is in focus is Jindal Poly. Let's see what that counter is doing in trade today. Because the fire that began 58 hours ago at Jindal Poly Films in Igatpuri, Maharashtra, it's still smoldering. NDRF and teams of chemical, biological, radiological and nuclear risk assessment continue their attempts to control the fire. The difficulty with the fire is that the crude petroleum product can only be doused with foam. Using water in flames, the fire further, the precautions basically are being taken to prevent the fire from reaching a propane gas tank located within the company premises. Now the tank has been covered with silt from the nearby dam as the experiment in the fire prevention. But let's Anushi standing by here. Let's see what is the financial impact when it comes to Jindal Poly. So Anushi, what details do you have, and how the financials will be impacted when it comes to Jindal Poly?
Varsha, as you've addressed what has happened over there now, administration has failed to control the fire even after a period of 54 hours. Now, cause of fire will be assessed in due course. This is what the company had to say by the subsidiary entity. While on the sad part of it is that 3 employees were injured in the incident. This is according to what NDTV had to report. Now, the company did come out with its update yesterday, wherein the Nasik plant, wherein there was this fire happening, production operations had been temporarily be disturbed by it, and which continues to be the case scenario today also. But loss will be assessed in due course of time. So that is something that we have to keep an eye out for.
Thank you so much, Anushi, for all the details. Let me go to first Akshay. Akshay, how are you seeing charts when it comes to Jindal Poly?
Yeah. For Jindal Poly Films Limited, see, the chart structure is negative if you were to go by the short-term readings. And even from a slightly medium-term perspective, at a horizon of 3 months, it is trading in a weak territory, considering the fact that I think a couple of months back, it broke the key support of 700. So it's a negative development. And right now, the prices, the charts are suggesting that the stock may head down for levels of 500. So in view of the weak technical price structure, currently it's an avoid. Those holding can consider an exit if it is a short to medium term trade which they have invested in.
Thank you for that view. Sharmila, you're tracking this company. What are your views when it comes to Jindal Films?
Well, I have been tracking this company, but the thing is that you need to assess the damage of this fire, because as you mentioned a little while earlier, this is a significant manufacturing hub for them, and what this all once the fire is put out, both literally and metaphorically, then we will be in a better position to address whether you can buy the stock at this point in time. But I think we need to wait to get further news.
Got that view. Well, other 2 stocks which are in focus is Pharma. If you see, came out with its Q4 FY25 results. Let's see what that stock is doing, because the revenue source 42.4%. There you go. The stock is up almost 7%. While if you see revenue source to 42%, while EBITDA jumps 44%. And if you see margins were at 11.6% versus 11.4% last year. The other stock which is in focus is Centrum Electronics. With if you see the numbers, the revenue was up 28%. EBITDA was at 38 crore versus 5 crore last year. Good jump when it comes to EBITDA. Margins were at 10.5% versus 1.8% last year. And there was a net profit of almost 22 crore versus loss of 7 crore last year. There was an exceptional gain though of 4.4 crore versus exceptional loss in last year of 4.8 crore. And there was a deferred tax credit of 7.4 crore as well. So Sharmila, both of the stocks, Pharma and Centrum Electronics, any view on that basis Q4 numbers?
Power Mech would be the stock for me because I think the kind of numbers they've given as well as the valuations they're at, great set of numbers, and I think there seem to be indications that they'll build on these gains. So I think that's the stock to watch.
Right. And Akshay, your view, rather, how are charts when it comes to both of these stocks, Power Mech and Centrum?
Well, for Power Mech, today I believe it's gap up, opening 7% up, and majority of the gains are on gap up. Post gap up, we have seen some bit of profit taking, but eventually, what I understand is the positive breakout above the levels of 3,000 that puts the strong on a firm footing. So more of a momentum based trade where you can expect targets till 3,600 from a short term trading scenario. And as far as is it Centrum Capital you're referring to?
Electronics.
Centrum Electric. So for Centrum Electric, it's more of a neutral price structure, although it's moved up by 10% today. So really the risk reward does not augur well for a fresh entry here. So 22.35 is currently a short-term support zone. I believe around 2,300 is the point where you can consider taking some profits off the table from a short-term trading perspective.
Right, got that view. Also, two other stocks which are actually buzzing is Premier Explosive and Container Corp, which are actually trading lower, I would say. Now this is on the back of Q4 earnings that the company has seen. Let me just read out numbers. So now when it comes to Premier Explosive, now revenue was down 15%, EBITDA was down almost 40%, margins were at 12.9% versus 18%, a huge downtick when it comes to margins, and net profit was down 44% rather. And even if you see Container Corp, let's see what that stock is doing in trade today, because a muted set of numbers that the Container Corp has also shown is down almost 3.4%. Now the key highlights when it comes to Container Corp is margins slip below 20% for the first time over 15 quarters, and the top line degross profitability has also slipped. They're going to pay dividend at 2 per share, and they've also approved bonus issue of 1 share for every 4 shares held. But Sharmila, again, let me come to you. Two set of stocks, Premier Explosives and Container Corp, both the companies have given weak set of numbers. How are you seeing this, both the companies, when it comes to fundamental wise?
So, I think for Premier Explosive, there are other concerns as well. They had, I think, a factory in Telangana, which was because of which the stock price was lower, etc. So, I think just looking at the numbers and the valuation they are at, as well as the business going forward, I think for me, Concor is a little better place because the valuations look quite attractive, and I think that there hopefully, the logistics space, the freight place, that is where I'm more positive on. So, I think here you could see a sort of a faster recovery. That said, I think, again, when I mean by what I mean by faster is a couple of quarters sort of a thing. So, but between the two, if I had to pick one, it would be gone.
Akshay, your view, how charts are looking when it comes to Premier Explosive and Container Corp as well, both the companies?
Premier Explosives tested its key short-term resistance levels at 600, and if you look at the stock performance in last couple of months, it's been more of a very strong one-way rally from 350 to 600. So almost you can say the stock has doubled up. So near their key resistance areas, there is it's but obvious that some profits are taken off the table. It's a short-term resistance. Some dip can be expected till around 475 to 500 in the short-term space. So right now it's more of an avoid. And for Container Corp, it's more of a neutral or a range bound price structure. Short term, yes, there is a slight support zone building up at 700 where we saw a momentum uptick 3-4 trading sessions back. So you can expect another round of short term recovery till 750, but these are more of trading upsides which you can anticipate. From a medium term perspective. It's more of a neutral setup.
Right, got that view. Thank you so much for that view. So just shifting our focus to Sun Pharma. Now, why I'm speaking about Sun Pharma is because the stock is down. Stock is down almost 3%. Now, it has still recovered, but stock is down almost 3%. Now, if you see, this is on the back of Q4 numbers that the company has given and also the guidance that the company has given. So, So just on the key highlights of Q4, if you see, there was a strong domestic growth, but this was offset by weakness in US generics. And the global specialty sales were up 8.6%, but this was below expectations. Because for Sun Pharma, specialty business is the next leg of growth. And there if you see, over the last few quarters, company has been growing in the double digit, but now suddenly you see 8.6% of growth in specialty business. That was below expectations. Net profit impact was led by, of course, exceptional items, and the soft guidance of mid to high single digit top line growth was below estimations, and these are basically the reasons why the stock is down. Now on the con call highlights, if I were to tell you, so the generic business decline that you're seeing is due to additional competition in certain products, and the FY26 R&D spend is expected to be 6 to 8% of sales in FY26. They're also expecting mid to high single digit top line growth for FY26, which analysts are actually considering it as a soft. New products are planned for future launch in diabetes and weight management space, and they've launched 10 new products in India for FY25, and they are also open to acquisition that can create value. Now continues to see pressure in pricing as it's a product specific issue. On the brokerage's view though, Citi has maintained buy, but they are also saying that soft guidance reflects regulatory uncertainty rather than business reality, and FY26 margin may remain flat, and they expect sharp expansion in FY27. Now I know Sharmila has already given her view when it comes to Sun Pharma, but Akshay, let me come to you and please help us how charts are looking when it comes to Sun Pharma. Is it a right time to enter into the stock?
Yeah, so I believe after a strong gap down start to the day, the positive development is it recovers from the lows from 1640. So the recovery comes on back of the technical support around the levels of 1640, where in the prior instance on 8th of April, the same levels were tested. You saw a recovery rally all the way till 1820. So yes, from a risk reward perspective, it's trading and recovering from a support. You can consider it as a trading buy at the current level. If recovers back 1800 is where it heads for. So more of a neutral price structure, but from a short-term trading perspective, it's a lucrative buy trade developing at the current rates.
So got that view, and thank you Sharmila and Akshay for joining this conversation. Great to have you. But viewers, that's all the time that we have on the show. Stay tuned to NDTV Profit.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people, or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use math to predict human behavior?
The 2007 split was a tough one, wasn't it?
I look back, maybe I wanted to take charge of it too quickly. My ego came in the way. Net, a year later, the 3 people who selected me as a CEO said, we don't want any CEO.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this sector.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to
You're watching NDTV Profit. I am Mahima Vajrajani, and with me today in an exclusive conversation is Ritesh Tiwari, who is the CFO of Hindustan Unilever. Ritesh, thank you so much for speaking with
My
us.
Pleasure,
My understanding right now, if through this conversation, is we want to try and understand as to what's happening in the entire sector, and of course how HUL, being the bellwether of FMCG, can convey to people as to what's happening in the space. My first question to you is that FMCG as a sector has been under pressure in the past 1.5, 2 years because there is demand which is weak, there is volumes which are elusive right now. There is also inflationary pressure playing its role, competition playing its role. I want to understand as to what is the kind of strategy in place for you right now in terms of what could be the next line of growth for HUL, and what are the discounting strategies especially in place when it comes to competition?
Yeah. So two things are changing, Mahima, overall. First of all, the overall macro conditions in FMCG are improving. So when you look at good agriculture outcome we had both for Kharif and Rabi crop with a good monsoon, overall food inflation, which has been very stubborn for some time, has come down in the country. The monetary easing that government has done, the amount of tax relief that people have got as per the budget latest. If I add all those elements put together and then I look at headline commodities, large commodities like crude oil, crude palm oil, they also have come off from their peaks. So all put together, overall macro conditions which supports demand is improving. There has been in the past year a purge in overall disposable income and the real inflation which has happened. So all put together, the consumption, as you mentioned, has been not as good. But the way we see going forward, the conditions are improving. Equally, what we have done as Hindustan Unilever, we have done a lot of work on our portfolio, especially in categories like beauty and well-being. And so that is one reason why we do believe that going forward, the trading atmosphere will be better than what we had in the past. Second, channels are changing and getting disrupted at a very high pace. Organized trade is growing much faster than general trade. We have also pivoted our portfolio and our investments towards organized trade. So put together, when I look at both internal factors and external factors, we do see overall trading conditions improving, demand outlook improving, and hence also our own performance we expect. Let me say the first half of financial year 25-26 should be better than second half of financial year 24-25 which just went by.
Right. You mentioned that, right now your modern trade is doing better than your general trade, and quick commerce has been a disruptor when it comes to, how trade happens right now. It's a structural change that we're observing. Just wanted to get your sense there because now quick commerce is really picking up. You might have to change your inventory model. How has that impacted your working capital? Has that, already taken place, or is it still impacting your working capital? And do you think that overall your distribution strategy that is there right now in place will change going forward as well?
Yeah. See, overall, if I take a step back, the construct of the business from channel perspective is still 70% general trade, 20% modern trade, roughly 7% e-commerce, and then 2-3% other channels. Quick commerce within that for our business is roughly 2%. It's small this point in time, but growing very rapidly. And hence we are also growing very rapidly in quick commerce. Portfolio, we are expanding. So as consumers are adopting quick commerce as a channel, we are also increasing our assortment in quick commerce. We are increasing and improving our customer service. The way number of times you end up serving a place has also further increased. Investments in channels of the future, be it modern trade, be it e-commerce, overall across all the ports has also got dialed up. So ultimately for us, we are in the business for selling soaps, shampoos, our various products, and hence we are very consumer focused. Now, wherever consumer journey of shopping is changing, we have to respond to that and ensure that we are fully present wherever consumer journey takes them to shop. And hence today, organized trade is doing much better than general trade in terms of consumer shopping experience and journey. We are doubling down on this point in time on organized trade. So investments are going up, customer collaborations are increasing to ensure that we are present with full-on portfolio in organized trade.
Right. And in terms of price points there then, because right now, both in e-commerce as well as quick commerce, what I'm seeing is that there are a lot of players in the unorganized space, especially startups, which have really come out and done well in terms of your ice cream business or your beauty and wellness products. How are you viewing that as competition, one thing, and then how are you, placing discounts and prices in place to compete with them?
Yeah. See, India, when you look at overall competition, there's every kind of competition in the country. We have large multinationals in the country, almost all of them operating in India. We have large Indian conglomerates into FMCG. We have amazing listed companies doing business in FMCG. We have very good regional and local brands across the country which does business. And then exactly to your point, the entire D2C industry, which is also playing. It is pretty comprehensive, competitive landscape. Working with this competitive landscape, in last 4 years, we've added more than 200 BPS corporate market share. As HUL, we have a portfolio which straddles across all the price pyramid, from premium to mass. And that portfolio completeness helps us to compete across channels and across all the competition.
Okay. So then in your premium portfolio, what you're also doing is you're making smaller packs of those premium portfolios and selling in the rural markets, because rural markets are right now doing better than urban markets, right? So just wanted to understand as to how sustainable demand is for those premium products in the rural markets, considering this rise. I mean, are they willing to pay at this price point? And secondly, in terms of your volume and value growth, do you think that the next leg for FMCG will be more of a value-led growth rather than a volume-led growth because of the kind of structural change that we are seeing in terms of demand?
Yeah. So the rural consumption habits are dramatically changing. No longer, let me say, take an example of beauty. No longer a moisturizer like Glow & Lovely and talcum powder is the beauty quotient for women in rural area.
Correct.
Even a rural consumer who wants to use beauty products ends up using 3 to 4 different products on the face to complete the beauty regime. And which is why it is very important for us that we are able to make all formats of beauty products accessible. And for that matter, many more premium products accessible to rural consumers. It typically happens by making small pack of a premium product. And this is how we end up penetrating into rural areas. And we have seen that success across. So Dove Bar, for example, it's a premium soap bar. It gets sold in cities. It gets equally sold in a smaller pack size in rural areas. And we have developed such access packs for all premium products for multiple categories to cater to rural consumers as well.
Right. And beauty and wellness is one of those segments that's doing well for you. So just wanted to get a sense there as to, in terms of growing this particular segment, what's the plan in place? Do you think it will be done via acquisitions, or there are new products that you'll be launching? What's the next course of action there?
So there are 2 big actions that we're doing for our own portfolio within beauty well-being. First of all, massive amount of portfolio transformation. And we deploy all the 4 strategies for portfolio transformation. We take our large brands and then we enter into more demand spaces. So for example, take Vaseline. Vaseline has entered into sun care space. So that's one strategy that we do. We've taken Pond's. Pond's has entered into multiple demand spaces of sun care, light moisturizers, serum as a format. So you take large brands and get into more demand spaces. That is strategy number 1, to expand the portfolio. Strategy number 2 is to see if at all there's a demand space you don't have a brand, then we want to launch a brand in that space. So Novology is a classic example where we saw space in masstige premium skincare. We wanted to have a product and range. We used our global technology and we launched Novology as a brand in that space. So that's the second strategy to improve portfolio in beauty well-being. Third then is to look at the brands that we have in stable of Unilever and what is relevant for us to bring in the country. So for hair, for example, we just recently brought Nexus from the global portfolio. We launched in hydration space liquid IV. Sometime back we bought Simple Love Beauty Planet from stable of Unilever. So we do bring brands from the stable of Unilever which are relevant in the country to expand the portfolio. And where we can't do the job from these three strategies, then the fourth strategy always is then to go for bolt-on acquisition. So we acquired, for example, Oziva a couple of years back in health and well-being space. Recently we acquired Minimalist in Mastige, actives, science-led space. So all these four strategies will keep deploying because beauty market in India, it is fragmenting. And typically when you have a per capita consumption which is low, which is where India is today at $50 per capita, as market keeps improving with overall rising income levels in the country, we have always experienced in multiple countries in the world, skin care takes off. The market fragments, penetration improves, consumption levels also increase.
Understood. And since you mentioned that you will be making investments, in growing your segments, just wanted to get a sense. As of FY25, when I was seeing your balance sheet, cash and cash equivalents was roughly 7,500 crores, right? And HUL is known for its dividend payout ratio as well. Just wanted to get your sense as to what is going to be the cash distribution policy like, because right now shareholders might be expecting something from you in terms of returns. What is there in place in terms of dividend payout, as well as is there a buyback on cards? How do you plan to pay back to your shareholders?
So the way we look at overall capital allocation a little more broadly, and there are three components to that. Component number one, when we generate cash, first port of call is to deploy cash to grow the business. So in terms of investing for capital, investing behind brands, innovation and capability. So that's where we do our first deployment of capital. Second, we deploy capital to drive bolt-on acquisitions. So Oziva, Minimalist, a classic example where we have a need to deploy capital to further improve the overall portfolio that we have. And third, we always believe in maintaining high dividend payout. We always have more than 90% dividend payout ratio. We have done for the last several years. Once in a while, when we do believe there's a little more cash that we want to give back to shareholders, we then go and do special dividend, which is what we did last financial year. So those are the strategies that we end up using to ensure that we end up giving healthy dividend back to shareholders. Ultimately, we have to ensure that shareholders get a very healthy return on capital, be it ROCE, which we always have maintained more than 100%, or for that matter, a very healthy ROE, return on equity. In last 4 years, we have done almost 400 BPS improvement in our ROE.
So that brings me to my next question. What are the ROC and ROE targets that you have for the next, let's say, 2 years down the line? What is the internal targets that you're aiming at right now?
So the ROC, we want to maintain above 100%. And when it comes to ROE, return on equity, as I mentioned today, we are at roughly 21.2%. We've improved last financial year by 120 BPS. We will want to keep making progress by improving 100 to 200 BPS going forward as well.
Okay, and in terms of acquisitions that you mentioned, will that be only in beauty and personal care segment? Because foods is something that's a segment that's remained under pressure. Do you think that segment plus your home care segment, will you be going ahead and making acquisitions there, or will you be adopting a strategy of introducing new categories or introducing new products there?
Yeah. As I mentioned a little while ago, for us to improve portfolio, we will do all four strategies across all the categories. Be it expanding our big branch into more demand spaces, even home care, for example. We've taken Vim, our very large brand, which is in dishwash, and we launched Vim Floor. We have now, second item I mentioned to you earlier, that the second strategy always is to launch new brands where we don't have in a demand space a brand. So we now launched Sun within home care as a dishwash brand for tier 2. And equally, let me say example of foods, where we brought helmets from the stable of Unilever. And coming to bolt-on acquisitions, both beauty and foods are our two priorities for bolt-on acquisitions. We do believe that our portfolio today in home care is complete, and where we had space, we have launched Rin Liquid. As far as tier 2 liquid is concerned for laundry, we launched Sun in dishwash. So we do believe we have a complete portfolio in home care which straddles across the entire price pyramid. That is similar case in personal care as well. But foods and beauty are the two places where we have to continue to do more work in terms of transforming portfolio.
So
beauty, if I just probably capture overall one thought, Mahima, out here. As HUL, we are over-indexed on premium. There's one place where we are not over-indexed, which is beauty. And so hence beauty and well-being, you will see in next few years' time, we will make 900 BPS improvement in terms of contribution of premium products within the beauty business. And which is why the job of transforming portfolio, using all the four strategies of portfolio transformation, we will continue doing that job for business in beauty.
Okay, interesting. So then that means that the next leg of growth or lever will be from beauty and segment. Is that the right reading?
All our businesses, if you look at, there are 4 different segments we have. Home care, beauty well-being, personal care, and foods and refreshment, which we call foods now. All 4 segments we see growth potential, and we'll grow all the 4 segments. The strategies that will be deployed to grow different segments will be different.
Okay.
Beauty well-being definitely has a job of being accretive to overall HUL growth, just because the sheer amount of low penetration and high consumption opportunities for us to keep dialing up, and which is why our investment decision of dialing up more investments behind beauty and well-being.
Right. Okay, understood. And in terms of having a competitive advantage, supply chain is something that one needs to have a control on, and HUL has been bang on when it comes to supply chain control. Just wanted to get a sense as to what's the next plan for capacity expansions. Will you be doubling down in terms of adding manufacturing capacities, or will you be outsourcing them and adopt a capital asset light model?
Overall, we believe that now is the right time. The conversation I had earlier, both looking at internal factors of the work that we are doing with our brands, our portfolio, and external macro, now is the time to dial up further investment across all lines of the P&L and balance sheet. Coming to capital, CapEx, we have typically done 2% of CapEx expenditure to a turnover as a ratio, as a percentage. We will increase that now more closer to 3%.
Okay.
And the incremental investment will go behind multiple things. It will go behind capacity for growth. It will go behind capacity for innovation. Equally, to drive more productivity, we continuously look at our infrastructure in the country, how we can optimize to make our products produce more closer to consumers and in a more cost efficient way, and it travels less number of kilometers. So hence there will be investment done for doing that as well. And last but not least, to dial up customer service. The point we spoke earlier about organized trade. As organized trade is becoming larger, it's a different way you end up servicing organized trade. So there will be investment needed for that. Even our general trade investment levels, we are increasing to increase our service levels there as well. So launching Shikhar, going to a go-to-market model like in Chennai, like in Mumbai, more direct to a Kirana store with the support of our distributors. So those are also spaces we are making investments.
Okay, and all this will be done through internal accruals, if I'm not wrong.
Sorry?
All this will be done through internal accruals, if I'm not wrong.
We have a pretty healthy balance sheet, so we'll be able to invest. So when we bought Minimalist, it was bought through internal accruals, and all the capital expenditure that we want to do, as I mentioned, we want to increase from 2% to 3%. We will do that with internal accruals.
Right. And in terms of growing your top line, because your sales CAGR in the last 3 odd years has been around 7 to 8 odd %. Just wanted to get a sense as to what's the target like, not for FY26, but from a longer term perspective, 3 years down the line, what's the kind of CAGR growth in terms of top line as well as bottom line that you're expecting? Because considering the investments that you're also doing, bottom line might see some kind of impact, but overall top line should be boosted because of those investments. So what's the CAGR growth that you're penciling in?
Yeah. So a medium to long term intention is to ensure we are able to drive double-digit EPS growth. If you look at the last decade, our double-digit EPS growth was driven by top line and bottom line improvement. Going forward, the way we see, it will be a double-digit EPS growth, but driven by top-line growth and modest margin improvement. The latest guidance that we gave of our EBITDA, which will be more now trading into a 22 to 23% zone, that's for next few quarters.
Yeah.
But if I look at medium to long term, we will keep making modest margin improvement. But growth of EPS will be top-line driven. India has seen 7 to 8% in the past. Typically market growth, and this 7 to 8% market growth has come roughly half from volumes and half has come from price. As we speak today, overall climate and overall where commodity levels are, we don't see high levels of pricing. We see more modest pricing, and our own outlook is low single-digit pricing outlook. But we do believe, compared to last decade, FMCG industry will grow faster compared to what it has grown in the last decade. The sheer amount of consumption headroom that we have in the country, the entire India growth story, the demographic dividend of the country, we do expect all of that will augur well for FMCG. So I do expect FMCG industry to grow faster in the next decade compared to the previous decade. And our stated ambition always is to grow ahead of the market. And so we called out at least 100 BPS will grow ahead of the market. So this is where we do believe that a combination of growing ahead of the market growth improving, and over a long-term basis, we have seen 3 to 5% pricing coming in, which is not there now, but it will come back sooner or later as commodities do stabilize. And hence a combination of volume-led growth and price-led growth with modest margin expansion should help us to drive basically EPS growth, which will be in double digit.
Okay. In terms of, there was an interesting EY report that I was reading, which said that 52% of sales right now is happening in private label goods, right? So I wanted to understand as to what's happening there in terms of your organized versus unorganized market, and in terms of HUL being a bellwether, how do you plan to, convert that unorganized market also into an organized market? What are the strategies in place?
So this is overall Mahima secular trend. Overall in FMCG, portfolio is getting more premium. So getting entire across all categories, portfolio becoming more premium, that's a secular trend in the industry. Conversion of, let me say, loose tea to packaged tea, unorganized to organized, unpackaged to package, that is a trend which also is secular. It will keep happening. Places where this is more relevant, the shift is, I would say, is in skin cleansing. It is in, let me say, mass laundry, and it is in tea. Apart from that, bulk of the categories already is by and large organized. So, and at any point in time, there will always be players in all the segments. The point I mentioned that with HUL, we have a portfolio which straddles all the price pyramid. So today our portfolio is complete across all the categories. So we are able to compete with all kind of competition.
Okay, and one last question is that a lot of concentration right now is from D2C brands, and they're moving more towards personalization when it comes to their marketing strategy as well. So just wanted to get a sense there as to what is the marketing strategy in place right now, and how are you adopting to those changes?
Yeah, so a key focus now is to have a very renewed way of looking at our portfolio and growing in the future. We call it as core, future core, and market maker. Roughly half of our business sits in core. These are our large brands like Lifebuoy, or our businesses which like sits in shampoo sachets. Then you have future core business, and think of shampoo bottles which sits there, Lux brand which sits there. And then we have a market maker portfolio. That market maker portfolio today is almost a 7,000 crore business for us. And the way we see that 80% plus growth going forward for us will come from future core and market makers. And we'll keep doubling down our growth in market maker. This is the portfolio today which competes with D2C business by and large. This is where mass stage skincare sits in. This is where liquid sits in. This is where future formats of products like serum sits in. For us to compete across all the segment, it is not only important to have portfolio which is present. And as I mentioned, we are dialing up where we need to dial up, like in beauty, by 900 BPS, we will increase the contribution of premium products. But portfolio is only half of the story. The balance half of the story is, do we have capability end-to-end to drive a profitable, sustainable, long-term business model for driving growth in that segment? An answer to that is work that we do across supply chain, work that we do across channels of the future in trade. So let me give you an example, supply chain. We have now 7 factories which we call as nano factories. This is basically creating a supply chain for smalls. When you have that nano factory, which is housed within a large mother factory, it gets all the efficiencies of the large factory, but it has nimbleness and volume and agility of a small supply chain. So you have efficiency of a large supply chain with nimbleness and agility of a small supply chain. This is mission critical in case you want to then have a very sustainable business model for competing in niche segments as well. So our own business, which is today 7,000 crore business in market maker, if I click down into beauty, we have more than 2,000 crore business which sits in our 6 big bets in beauty, which sits in premium, which sits in, let me say, light moisturizer, sun care. These businesses are profitable. They make double-digit margin. So which is why it is very important to have a portfolio which caters to that consumer demand. Equally, there's end-to-end go-to-market structure of supply chain and distribution in customer development that supports this entire structure to make a profitable, sustainable, long-term business.
Okay, so Ritesh, one question that I had about your ice cream business was that now you've got the NSE and BSE approval also for the demerger of Quality Wall's business. Just wanted to get a sense as to what's happening there. How do you plan to grow that business once it's demerged, and what are the plans in place?
So overall, Mahima, the plan that we have for ice cream business, we want to demerge the business and we want to list it. And hopefully with all the regulatory approvals and internal separation job that we have to do, we should be able to complete the job by March quarter 26. The whole idea behind that, see, ice cream is a high growth, but equally high capital intensive business and low margin business.
Right.
It has its own distinctive business model where it runs on a cold chain both for manufacturing and for distribution. And hence we believe that having a business which a focus management, which is then able to deploy strategies which is suited to the distinctive business model of ice cream to ensure that we're able to create value differently, and hence the whole reason why we're doing what we're doing. And the business has today amazing amount of brands. It will continue to get support on portfolio, on brands from the global ice cream company, and we will continue investing in the business. Even in the current ice cream season, we have disproportionately increased our footprint of cabinets to serve more consumers across the country. And last quarter, we spoke about having a double-digit growth in the ice cream business. All the shareholders of HUL will be able to participate in the value creation of ice cream. The board, when it came up with the scheme which we announced and which is what is getting approved as we speak now at various forums, it will have a 1:1 share entitlement ratio, meaning every shareholder of HUL will get 1 share of the ice cream company, and hence all shareholders now will be able to create value with the ice cream opportunity.
Okay. And your sense in terms of competition in the ice cream space, because right now what I was observing in the quick commerce space, there are a lot of startup companies which have come up with their ice cream businesses. For example, there's Go Zero, which has made its mark in terms of the quick commerce space, not otherwise. What's the sense there, and then what will be your distribution strategy like in the ice cream business?
Yeah. Our ice cream business today has a footprint across channels very different than market. We are over-indexed on channels of the future, quick commerce, modern trade. So our overall business is more premium and it is more over-indexed to channels of the future. Ice cream as a category has overall low penetration, low consumption in the country, and hence massive headroom for it to grow, and hence multiple players can coexist and keep growing the market. So far as you have distribution which is wide, we are present across the country. We are present across the channel with over-index presence in channels of the future and great amount of brands and innovation. We do believe that with low penetration, low consumption in the country, there's enough headroom for us to grow the ice cream business. In last 1 decade, the business has grown at double digit, and we do believe that going forward as well, it's a business which we would expect to keep growing at double digit, and which is why having a business model which is suited to deploy the distinctive business model and strategies for ice cream will serve the business very well going forward as well.
Right. I think the key takeaway from this conversation is that although FY25, FY24 FMCG was under pressure, but the future definitely is promising for the entire FMCG industry. And the fact that HUL is strong in terms of growing in terms of double-digit EPS growth is the key takeaway for me in this conversation. So thank you so much. Ritesh, you want to add something to that?
I think I'll just probably add to what you mentioned, that where we are today, both macro factors for consumption for FMCG are improving. I mentioned multiple reasons for that, be it a good agriculture outcome or inflation, which is looking now much lower compared to earlier, especially food inflation. The amount of monetary easing which has happened in the economy, plus the tax relief. If I add all those elements put together, a good climate getting created externally. Internally, what we have done with our work on portfolio channels, we do believe that external internal factor put together, the outlook for FMCG consumption and our own growth outlook will be better going forward. As I mentioned, the first half of financial year 25-26 would be better than last half of financial year 24-25. We will invest in the business. For next few quarters, we do believe our margins might come down more to 22-23 band. It is still very healthy, but we want to ensure that we are unblinkingly going behind growth. And growth for short term will be volume led, to your question which you asked earlier, and pricing might be lower at low single digit, but it will be volume led growth.
All right, okay, got it. All right, thank you so much, Ritesh.
Thank you, Mahima.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this sector.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Over there,
we started Fractal and we said, what if we can use math to predict human behavior?
The 2007 split was a tough one, wasn't it?
I look back, maybe I wanted to take charge of it too quickly. My ego came in the way. Net, a year later, the 3 people who selected me as a CEO said, we don't want any CEO.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay.
Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Neeraj Shah. Let's quickly look at how the Nifty is shaping up. It's a good day of trade. We're touching now 24,900. That's the level we're really testing, 1.1% higher on the index. Let's look at the intraday chart as well. The Nifty Bank supportive today, around 400 odd points on the Nifty Bank as well. We're sitting very close to the day's high. The day's high was 24,909. So we're just about 30 points away from that, and we're well off the day's low. So that's the one big positive. Let's look at the breadth on the Nifty 50, and that's what's standing out today. It's a good day of trade, 1% higher. You want to see how that is playing out. That's the breadth on the Nifty 50, 49 gainers to just 1 loser. Let's look at the heat map, and that will give us a much better perspective. There you go. Sun Pharma, the sole loser on the back of numbers, so justifiably so. Outside of that, you've got all other stocks sitting in the green, and Eternal is up 5%. Some life insurance stocks also doing well. SBI Life, HDFC Life among them. Jio Finance is also there. ITC came out with numbers, a decent set in terms of the top line. And you've got the Adani twins also participating, up 2% each on a day like this. Trent is up 2% as well. So good strength, good resilience on the back of what was a slightly difficult day yesterday. And we saw that recovery in the last hour of trade. And that's been carried forward to today. And it's holding up fairly well. And I want to also look at the advanced decline intraday, if we can pull up that chart. And that will give us also some broader indication that while the Nifty 50 is doing extremely well, how are broader markets doing? Neeraj.
You can argue that they are doing well, maybe not as well as the large caps are. So much like last Thursday, wherein the large caps did much better than the mid caps and small caps, we're seeing an encore. And maybe that's because heavyweight indices are doing well, right? When Nifty IT and Nifty Bank do what they are doing today, you would anticipate that there is going to be that kind of a move by the large caps versus the small caps. Now, or the mid caps and the small caps, but non-Nifty, some standout movers today. I mean, you have to get Vari into the picture, and Vari Energies taking the hit and staying low today. It's been down 8%. It's been that way now. You could argue, yes, there was an attempt at an intraday uptick, and it's done that, but so it's no longer double-digit down, but still down about 8%. Doubt Premier Energies has had a similar downtick because it obviously doesn't have as large an exposure to the US, but Premier 2 is down about 2.5%. So bear that in mind. The couple of names in that bucket. There is Deepak Fertilizers, which on results is down about 5%. GMM Pfaudler continues to grind lower, 2 days on a trot now, another 3.5% lower. As is Concor, which is down about 3% as well. So those are the Nifty 500, some of the stocks which are sulking. Aegis Logistics is the other one, by the way, which is sulking a bit. What's done well? Honasa, 17%. Arguably the mid-cap, small-cap stock of the day. There is strength in TBO Tech despite the numbers looking very okay. Emcure Pharma has had a very good performance, was up in trade yesterday and is up in trade today. So it's something that we'll ask our technical experts about why. There is strength in Angel One, BSC, and I reckon maybe some of the other capital marketplace, because those stocks are doing well. Wonder if, actually let's try and probe that. Let's pull up Motilal Oswal, let's pull up Nuvama Wealth, let's pull up MK and see if it's across the board. No, it's not across the board. I think it's happening in specific pockets. But yeah, certainly BSC and Angel One doing very well for themselves. But a clutch of stocks flying around, as we said. Let's get in our experts to try and understand what to do in a scenario like this. In this conversation, I'll also ask Harsh to try and talk about why is it that life insurance stocks are doing what they are doing. But Ruchit Jain, first to you. How do you characterize the Nifty move today? It almost looked like we are going to be having a downward bias, and pop, the index has gone up on the last day of the week.
Yeah, hi, very good afternoon, Neeraj. Well, the broader trend for the markets, there's no doubt that looks quite positive only. A couple of things were that if you look at last few trading sessions, we witnessed such dip what we have seen in last 3-4 days, even at the start of the May. When markets dipped from the 24,500, 550 mark towards 24,000 mark. And at that time, index took support around its 20-day exponential moving average and resumed the uptrend to give a breakout about that 24,550. Now, what we have seen then in the last 3 or 4 trading sessions, again, similar dip has come of 4 or 5 trading sessions. Yesterday's low is at exactly around its 20-day exponential moving average, means that 20-day EMA, whenever market is correcting, is acting as a support on the Nifty. And secondly, that 24,500 to 600 zone, which was the earlier resistance, it is now acting as a support on dips. So this is an indication that until we see any kind of significant breakdown below this 24,500 or we can say 450, I think the dips would get bought into, and we should see an up move soon towards 25,250. Now another confidence is coming from the banking space. This banking and the NBFC space were had taken the leadership since the month of mid-March, I would say. Since the month of March, you had seen that the Bank Nifty and the Nifty Financial Services Index were the outperformers. Entire last 1 month, right from 21st April to today, 23rd of May, Bank Nifty and the Nifty Financial Services Index has consolidated within a range. Now, in this entire consolidation, they have not breached any of their important supports. So this indicates that this was more of a time-wise correction, and the sector which was the leader since the month of March, I think once this time-wise correction is over, we should see the leadership resuming from the banking and NBFC space. I think these are certain indications that the downside for the markets as of now seems to be limited. And unless we see market breaking that important supports of 24,500 or 450, this is a buy and dip market, and we should see highs towards 25,250 very soon.
Okay, so that's with regard to the Nifty and the Bank Nifty. Good afternoon, Ruchit. Ruchit, your picks for this afternoon, therefore.
Yeah, good afternoon, Harsh. So a couple of buy recommendations from a very short-term trading perspective. Life insurance companies are giving a breakout around the all-time highs. whether you take it HDFC Life, SBI Life, good price volume action is there. So SBI Life still has a good favorable risk reward ratio where a bullish flag pattern breakout has been seen. So at current levels, one can go long in SBI Life with stop loss below 1760 for potential targets around 1870. And one positional call that we are recommending is to go long on LT Foods. Now, if you notice the price volume action in both LT Foods as well as KRBL within the same sector, I think last 1 or 2 weeks, the volumes have been gradually improving along with the price up move. Now, LT Foods is on the verge of a breakout from its previous swing high resistance too, and considering its recent relative outperformance compared to KRBL, we have chosen to go long on LT Foods at current levels, but this is more from a bit positional perspective. If you take next 1 month's perspective, then one can expect target somewhere around 460. So one can go long with stop loss below 382.
Okay, and Ruchit, what's the take like with regard to an internal stock perked up 5%?
So overall, I think the broader trend seems positive. The stock has already gone through a good price-wise correction since the month of October along with the broader markets, and also time-wise correction where last 2 months the stock was trading within a range. Support base initial was formed around 200 levels. Then if you look at last 15-20 days, 220 is not getting breached. So the support base is shifting higher in this stock. So the momentum actually would increase once the stock gives a breakout about 250, which is this 220 to 250 has been the range of last 3 or 4 weeks. So momentum would pick up if we get a breakout about 250, but at least the support base has shifted higher. So till it is about 220, the overall biasness remains on the positive side.
Okay, and Ruchit, what about the life insurers? Because that's the other pack which has shown remarkable resilience, if I can call it that.
So the slow and gradual up move was there in last couple of months in both the stocks such as HDFC Life is there, even SBI Life is there. Today even ICICI Pru Life has given a breakout from its important resistance. So I think these would continue its positive momentum, especially both these names HDFC Life as SBI Life, which are trading around their respective all-time highs. I think the volumes are quite strong in both these stocks. So there are chances that we should see a continuation of uptrend in both these names.
Okay, so continuation of uptrend in some of those names likely. Ruchit, I wonder if there is a view with regard to something like a restaurant brands or Devyani, the QSR pack, because they've come out with numbers slowly and gradually. While there's not been a major reaction, but what's your sense like on some of these names?
So if I look at last 1.5, 2 months when the broader markets have done quite well, we look at the Midcap index, we look at the Smallcap index, but there have been certain pockets which have relatively not shown that kind of outperformance, or even the volumes are not very high. So in this QSR space, if you look at Devyani or restaurant brands, last 1.5 months the markets have rallied, but we have not seen any kind of volume-based buying seen in this stock. So it's not that the stocks are in a downtrend, but I think compared to market, we are not expecting any outperformance to come in this name. So there may be market performer, where if the mid caps continue their up move, then these stocks could show some positive momentum, but not the pack where outperformance is expected. So we would tend to avoid any kind of short-term recommendations on these names until we see any positive price volume action in the near future.
Okay, Ruchit, one question about Vari and solar companies per se, because there is a big run up that happened into most of these, right? And a cool off today in Vari, a little bit in Premier, but not so much in some of the others. What are the technical thoughts here?
It seems more of a time-wise correction, Neeraj, in these names. During numbers, I think post numbers, we did see a good up move in Vari, where the stock rallied from that 2400 to 3000, 3100 in just 2 or 3 trading sessions. But actually, whenever we see such up moves because of numbers or any particular event, the follow-up move is more important than that initial reaction. So until we see follow-up buying happening in the stock post the reaction to any event, I think the overall momentum does not sustain. So what we have seen that after numbers on 23rd of April, the stock made a high of 3100. And after that, if you see, we have not seen any kind of follow-up buying happening. So 3100, 2500 has been the broad range that the stock is consolidating in. So I think more of a time-wise correction can be said that could continue. So in absence of follow-up buying, I think this is not one of the sector where at least a short-term momentum should be expected.
And what about a Honasa? Do you have a view there? 16%?
So yes, I think today the stock has given a breakout after a long period of underperformance, which we had seen in the stock. The 200 DMA around 290, 300 was a very crucial resistance for the stock. The stock gave breakout above that too, supported by very good volumes. So indication of some positive move towards 370. So we witnessed a huge gap down opening. I think a 20% or more than 15% gap down was seen during mid-November in the stock. That entire gap gets filled around 360 to 370. So initially, today, looking at the volume action, I think this gap should be filled. So 360, 370 at least should be expected in the near term in Honasa.
Neeraj, just talking about how the life insurance stocks are faring today and have done over the last few sessions as well, in fact, over the last month or so. And the sense that I get is that you've got some amount of positivity with regard to the Q4 numbers, which is slowly getting built in. So you had margins which came in slightly better than expected in Q4. You are starting to also see a bit of growth come in, but you want to see a combination of those factors play out before you take large positions in life insurers. And I think that is likely what is at play at this point, because you could see those trends play out in Q4, that you could see margin uptick. There was commentary that some of the par products, there was lesser traction in some of the par products. Non-par, there was a shift towards non-par, which was slowly and gradually happening. In Q3, that was the one piece which was absolutely absent. There was still pessimism, and HDFC Life came out and said that we are still completely focused on growth. Any kind of tangible growth on value of new business is good for us. We don't have an issue with regard to margins at this point, and that's not going to be our focus area, which was very unlike them. But in Q4, that somewhere changed, and could that at all be contributing now, as late as now, to some of these to the kind of performance that they're demonstrating?
Yeah, I mean, your guess is as good as mine, I guess, but it's an interesting move today because it's a concerted move. So bear that in mind. Today, like HDFC Life, SBI Life, and everything related to maybe insurance, life insurance at least, has done rather well for itself. Okay, on to more news and updates. India plans to allow US private firms to bid for $50 billion in central government projects, covering roughly 40,000 tenders as part of the ongoing trade talks. Rishabh has more details on this. Rishabh, this is interesting. So tell us, what is the latest development? What is it a departure from? And is there more to come after this?
Right, Neeraj, what we're picking up from official sources is the fact that India is planning to open up a certain portion of its public procurement plan. So far, this has been reserved for domestic bidders only. But we've seen this sort of a departure over the past year or so with various trade deals coming in. And with these trade deals, the demand from various countries like the UAE, Australia, as well as UK has been to get to have their firms also be allowed to take part in these vast sort of public projects that the central government and various state governments and other municipalities also put out every sort of which it's vast basically. It's about $750 billion annually if you include states, if you include municipal bodies. But what we're hearing is a portion of it is opening up, mostly central government linked, for these companies as part of the bilateral trade agreement talks with respect to the US so far. What we're also seeing is the fact that this will be, of course, on a phased as well as reciprocal basis. So it's not just a loss for Indian firms that might face intense or intensified competition with regards to bidding for these tenders, but Indian firms will also get access to the US market, which is also a very, very large public procurement market, one of the largest in the world. So that is what we're picking up as part of the latest talks that are happening with regards to the bilateral trade agreement, and we'll keep tracking that as well.
Okay, critical. Thanks so much, Rishabh, for that. But this one's going to be really critical because pharma depends on it, IT depends on it, even textiles to a large extent within broader markets depends on it, and India consumption also to a certain extent depends on it, Neeraj.
Yep, it's going to be a very interesting one to follow.
Yeah, so Rishabh getting us that, but let's quickly switch focus. Another exclusive, India slams IMF bailout to Pakistan, eyes World Bank and FATF moves to curb $20 billion worth of funding. Is this a global security risk? We have Shimi joining us with more on this. Shimi.
Yeah, so two very critical information coming from policy corridors. According to top government sources, New Delhi will take up the matter with World Bank ahead of, the proposed $20 billion lending package to Pakistan, which is, expected to be approved in June, this June itself. And India is, in fact, separately going to approach FATF as well with a request to reconsider placing Pakistan on the grey list, citing continued concern over misuse of international funds. Now, also confirmed here that the government is disappointed over the recent IMF bailout. In fact, they are saying that they had expressed this disappointment over this recent approval on May 9th. Prior to the approval, India had already reached out directly to IMF MD conveying its objection. And in fact, now sources telling us that government is not against financial aid being given to any country. But the data suggests that such bailouts are being approved during a warlike situation in that region. So it's very concerning from that point of view. And it's also stemming from the, long-standing allegation that IMF keeps supporting Pakistan. It's often been diverted towards, arms and ammunition and other military-related expenditure rather than, economic reform or fiscal consolidation or any sort of relief to the common people there. And in fact, government sources here citing, 28 such financial support packages provided to Pakistan, a significant portion of which has allegedly been used for the military purposes. So what government stands here is what sources telling us, that this is not about just a fiscal issue. It has a direct implication on the regional security. And that is why they are urging all multilateral lenders to exercise caution and ensure accountability on how the funds are used. In fact, they are saying that they are going to have a diplomatic outreach to, World Bank, FATF, and they will have start a dialogue on it. But definitely at this point, they are very much disappointed with the bailout being given by the IMF. And at the same time, they are also kind of, raising concern and trying to push the case to put Pakistan again on the grey list. I also wanted you to, understand here that the sources, underline that this issue is a very important for the government. Through IMF, they have reached out to Germany, Italy, France, finance ministers, and India is left to defend itself despite an outrageous violation, which happened in Pahalgam. And government sources telling us that India will stand on its own. And somewhere it's also, highlighting that how the 11 new conditions which was imposed after the bailout and the next review meeting, which is coming in September, they are going to ensure that they should consider all these factors, on account, before giving out any such bailout package.
Well, they ought to, Shimi, they ought to. Thank you for getting us that. And thanks so much for keeping us updated on this front as well. I'm sure that we've done all we can with regard to at least this. But, again, switching focus to stocks and, a couple of interesting numbers trickling through. You had a BML's numbers, Neeraj. Stock is perked up 3%. You had an Interarch building. And Interarch building products, the stock is perked up 5% after the kind of move we've seen yesterday. Can we pull up the 5-day chart on Interarch? And that'll give us an indication as to how the stock has moved, especially post numbers. I believe at least a 20% move on the counter. There you go, 19.5% in the last week or so. Let me go straight across to Ruchit and ask him whether he has a view with regard to something like an Interarch, 20% higher in the last week.
So, the trend for the stock, considering this 20% up move, definitely seems positive. But certainly, if one has to build any fresh positions, then the stop losses technically would be too far from what the current market prices are. So I think best to hold on to existing positions if any. But for fresh buying, one should keep more of a buy and dip approach, that in case if we get any dip in the near future, maybe towards 1950 or 1950 to 1900 range, then the risk reward ratio would become favorable to go to do fresh buying there.
Okay. All right. So that's the other one. Ruchit, I wonder what the view with regard to the IT sector is. Let's pull up the IT stocks today. IT and FMCG, in fact, dominating at least the sectoral trend today. 1.3% higher on the Nifty IT. All the stocks sitting in the green. Do you have a view, Ruchit, at least fundamentally, as to what's the sense with regard to IT?
So the IT space looks interesting because somewhere the price-wise corrective phase is behind us. Because we have seen that a long underperformance was seen in the IT stocks when there were major concern about the trade war, and the time since that concerns have reduced, we have seen a gradual up move in many of the IT names. But I think what is interesting within the IT basket is then the mid-cap IT stocks are witnessing more buying interest rather than the large-cap names. So I believe on the index front, we could see some more time-wise correction, where the large cap stocks would consolidate within the range, but some of the mid cap stocks, if we look at FSL is there, Coforge is there, Persistent is there. These are certain stocks where the price volume action is very strong compared to the large cap stocks. So I think one need to be very stock specific within the IT basket, and a relative outperformance could be expected in the mid cap IT compared to large cap REITs.
What's the sense with regard to Varun Beverages, Richard? Do you have a view and an ITC? Because FMCG also perked up, and these two in specific contributing well to that FMCG basket.
So Varun Beverage, I think one can look for more from a mid to long term perspective, not from a trading perspective, because the stock has a support with around 420, 440. But relatively in the recent up move, we have not seen participation coming in from the stock. So because of the price-wise corrective phase has already been done, so I think this could be a case where one can look for adding it to their portfolio, but at least 2 to 3 quarters view if anyone has, not from a trading perspective. ITC also more or less has seen more of a consolidation over last few months. No price volume action has been seen. In fact, very selective FMCG stocks have seen any kind of trended up moves in recently. So I think here also it seems we would wait for a breakout above 442, which has been the recent swing high. So if the stock manages to go above 442, then one can expect some positivity to come in the near term. Otherwise, consolidation could continue in ITC as well.
View on HUL while we are at it, Ruchit?
So even HUL, I think the stock does not seem to be in a trended phase. If we look at last few trading sessions, the stock is consolidating below its 200-day exponential moving average, and 2400, 2450 as the stock is not able to surpass those levels. So until we see any kind of breakout accompanied by good volumes, in fact, if you look at the entire FMCG index as well, in this entire up move, we have seen a lot of sector-specific rotations happening. Initially, it started with the banking and the NBFCs. Then a lot of positive momentum was seen in some other sectors as well, where metals have started doing well, realty off it, auto, some sector rotations was clearly witnessed, have been seen in last 1.5 to 2 months. But FMCG has been one space where we have not seen any kind of such rotations happening, or the stocks have not still been forming higher top, higher bottom structure, except 1 or 2 names, such as Marico is there or Tata Consumer is there. So I think sector as a whole does not seem to be showing any kind of trended phase signs. So at the most, I think some time-wise correction or consolidation could still continue in FMCG stocks. HUL, as I said, 2400, 2450 remains a very stiff resistance, which is not getting crossed since last 2 or 3 weeks. So until we see any such breakout, I think there are much better opportunities available in the market in other segments which are doing well.
And thank you so much, Ruchit, for joining us. We'll let you go on that note, and also on that note, what we'll do is we'll focus in on HUL. They're looking to drive double-digit EPS growth. That's what the CFO Ritesh Tiwari told NDTV Profit in an exclusive chat. Listen in as he talks about the company's growth guidance going forward, and we'll also slip into a very short break thereafter. We'll be back with more. Stay tuned.
Medium to long-term intention is to ensure we are able to drive double-digit EPS growth. If you look at the last decade, our double-digit EPS growth was driven by top line and bottom line improvement. Going forward, the way we see, it will be a double-digit EPS growth, but driven by top line growth and modest margin improvement. the latest guidance that we gave of our EBITDA, which will be more now trading into 22 to 23% zone, that's for next few quarters.
Yeah.
But if I look at medium to long term, we will keep making modest margin improvement. But growth of EPS will be top line driven. India has seen 7 to 8% in the past, typically market growth, and this 7 to 8% market growth has come roughly half from volumes and half has come from price. As we speak today, overall climate and overall where commodity levels are, we don't see high levels of pricing. We see more modest pricing, and our own outlook is low single digit pricing outlook. But we do believe compared to last decade, FMCG industry will grow faster compared to what it has grown in the last decade. The sheer amount of consumption headroom that we have in the country, the entire India growth story, the demographic dividend of the country, we do expect all of that will augur well for FMCG. So I do expect FMCG industry to grow faster in the next decade compared to the previous decade.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use math to predict human behavior?
The 2007 split was a tough one, wasn't it?
I look back, maybe I wanted to take charge of it too quickly. My ego came in the way. Net, a year later, the 3 people who selected me as a CEO said, we don't want any CEO.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Welcome back. Thanks for staying with us on India Market Close. You know, that time of the show, it's 2:30, where we bring in Soumit Sarkar with all that's happening or that he's hearing on from dealing rooms rather. So, heard on the street. Soumit, what are you hearing?
Well, firstly, couple of stocks that are in focus is GMR Airports and TVS Motor. Now, dealers are indicating that there's buy flows on DI desk on both these counters at lower levels. In fact, a large HNI interest is also quite active when it comes to TVS Motor and GMR Airports. Both these stocks have been accumulated at lower levels on large HNI desk as well. Genus Power is another stock which large HNIs are accumulating on expectation of strong Q4 numbers. Now the company will be reporting its numbers on May 30th, so keep an eye out for Genus Power as well. And Eternal Zomato, that stock is up 5% in trade. Now what dealers are telling me is that NSDL actually updated or has gone live with the FPI limit of 49.5% for Zomato, but given the fact that there has been no update on the same that has come in from NSDL, it means that the limit has not touched the red flag so far, and hence there has been no update. So this is kind of a relief rally that we are seeing for Zomato in trade, and this also means that there might be some potential delay in the MSCI-led outflow also, which was expected given the fact that the company was limiting their FPIs at around 49.5%. Now, another positive factor which dealers have indicated actually on this is the fact that A&T and Financial, which is the Alibaba Group, this block deal can come in the next couple of days, and if this block deal happens, then some of this FI limit might also again be freed because they are looking to sell their entire stake, which is close to around 2%. It will be a cleanup trade, and what dealers are indicating is that there is a strong demand. So that FPI limit might not be touched very soon by Zomato is the most positive outcome that is coming in from this dealer check. And lastly, Whirlpool remains in focus. Dealers are indicating that there is a buzz on the street that Reliance Industries might be interested in picking up the promoter's stake in Whirlpool. Now do remember that the promoter for a very long time is looking to exit its a stake in the Indian unit. They own around 51% stake, and Reliance Industries might be a new bidder for this stake in Whirlpool.
Wow. Okay. Let's wait and watch how this one does. I mean, remember, it's a large chunk that Whirlpool aims to sell after having sold a very large chunk sometime in 2023, if I'm not wrong. And therefore, this could be very, very interesting. I think 51% is the current stake, which they plan to whittle down to 20%, if I'm not wrong.
They want to completely exit. Now, depends on how they plan the transaction. There are multiple private equity investors which are in free, but if Reliance Industries comes in, we don't know how the things might turn.
Interesting. Let's see how this goes. Thanks a lot for that, Sumit. So, those are a set of stocks that you want to keep an eye out for. Okay, let's welcome in our guests. Maybe first to try and understand what to do in a scenario like this, Amit Goel, founder of Amit Ventures, joins in on the show, and on the technicals and the derivatives side, as does Vineet Bolinjkar, head of research at Venture Securities. Gentlemen, both of you, thanks for joining in. Amit, big move today, and big by, I mean, it's just 1%. But I call it a big because it wasn't quite anticipated, at least to a lot of people's minds. Did you kind of pencil this in? And if not, what to do in a scenario like this now?
Hi, good afternoon, Neeraj, and thank you for having me on the show. It's good to be here. Yeah, we opened the trading book today, expecting that it will probably be a sideways with a slightly downward kind of a bias. However, if you notice the option chain development between 9:30 and 10:30, especially in Bank Nifty's next month chain, the 56,000 strike put option has seen a very large writing of about 1 lakh shares on Bank Nifty, which kind of, shifted the entire base for Nifty and Bank Nifty on the upside. There is some bit of unwinding at yesterday's ATM strike, which is 55,000, since Bank Nifty has moved up by 500 points. And I do believe that there is some shift in the view on the market from the market participants. And I would not be surprised if this last leg of the rally for the week would extend in the next week, and probably we will see 56,000 on Bank Nifty purely because of this very, very interesting and unusual activity on the options chain.
Interesting, Amit. Amit, your picks for this afternoon?
So I'm purely trying to play the momentum game here, and the top two picks for me would be Bosch Limited and ABB. If you look at the price action on both these, let's speak about ABB. The price action on ABB is on the daily chart making higher high and higher lows, leading me to believe that the bottom for this stock, the near-term bottom for this stock has kind of been made at around 55,000 and 5,200 levels. If somebody is looking to enter at the current level, purely on a momentum play, we could look at entering, keeping the 5,837.38 as stop loss, and aim for about 6,000, 6,200 as the targets. The other one is Bosch. If you would allow, I will take you through that as well.
Please, Amit, please go ahead.
Yeah, the momentum here also seems to be on the up, and these couple of stocks are actually showing the strongest in terms of momentum from a technical standpoint in the Nifty 100 space. And I'm betting on carrying on this momentum in these two counters. With Bosch also, I'm having a similar view in which we look to buy at the current levels, keeping 31,600 as a very tight stop loss, and we would aim for about 32,800 or 900 levels as eventual targets.
Okay. Well, watch out for these. Now, before we get into Vineet Bulinchkar, because I want to start the conversation. Okay, Vineet, let me just quickly get a market view from you, and then I want to talk about Vari with you, because that's ideally the stock of the day today. But Vineet Bulinchkar, one quick thought. Are you constructive on markets, or do you believe valuations are expensive? Would you invest money right now, or would you wait for a dip?
No, I would be investing money right now because I think we are getting into a momentum phase in the markets. And if you see the valuations vis-a-vis, that the interest rate parity which is being achieved with the US, it is suggestive that money could start flowing into India because, the risk in the US market is increasing vis-a-vis India. And that could lead to the rupee getting stronger. And I expect domestically the Indian markets to do pretty well. I think it is the only market showing growth and which is expected to sustain. So this should continue to do well, at least until we hit the decisive phase when RBI needs to declare whether they do the interest rate cut or not.
Okay. Well, what would the view on Vari be of our guest? Let's try and talk about that. But before that, let me get in my colleague Varsha to talk about why is it that Vari is in focus today. Varsha.
Thank you for that. So, US is actually changing the solar incentives. Now, the US government just passed a bill that will reduce the tax breaks called tax credits for clean energy projects, which includes your solar sooner than expected. This means that it will become less financially attractive to install big solar farms or even solar rooftop panels in the US. Now 45x manufacturing tax credit is still valid till 2031, which looks to tighten FEOC compliance, could meaningfully curtail utility scale and rooftop installation, which reduces competition from China and Russia. Now, impact on power companies, if I were to say, Vari Energy, 57% of order books come from US. 45x manufacturing tax credit validity is till 2031, which is a relief when it comes to Vari's US plant. But US export opportunity could narrow earlier than anticipated, and the companies like Renew Power, Azure Power may also face similar pressures. In fact, we also spoke to Amit Paithankar, who is the CEO and whole-time director at Vari Energies. Please do listen in.
If the bill in the current shape and form, in the worst possible outcome, takes shape, would you alter your US investment plans?
Again, phenomenal question. That's the question that obviously we will need to look at internally as well. However, I'll tell you a few things which are invariant in these conversations that we are having. Number one, USA is a very, very large market. USA is concentrating on artificial intelligence development, and a large portion of that is power, and power that needs to be deployed at scale and at speed. And solar energy is a form of power which can be deployed at scale and at the speed at which it is required. So the demand for solar energy, therefore, will continue to be unabated in the United States. And because of that, we continue to be bullish on that market. And in terms of investments, we already are at 1.6 gigawatt, Neeraj, as we were talking about. We will continue to, we are committed to double that to 3.2 gigawatts, which we will go ahead and do. Over and above that, we will keep watching how the market evolves. But long-term perspective, continue to be bullish on the US market.
Well, they continue to be bullish. The stock's taken a beating. Vineet Bulinchkar, any thoughts on this one? And after the bill that has been cleared in the US yesterday?
Yeah, so I believe that Vari Energies will face pressure because a large portion of the business is concentrated, or it's equal between domestic and the US. But I have got sufficient activity to take forward the business, in the sense that they have plans to get into batteries, they have plans to get into hydrogen, and so to that extent they can easily tweak their business model to take care of these unforeseen events that happen. But having said that, I believe that there is going to be substantial downside risk, and the intermediate bottom that was made a couple of months back looks to get challenged.
And Amit, would you have a technical view on this as well?
See, Vari Energies, especially because it is, news driven and there are these technically it was trying to head up and cross the 3000 levels, but of the last 2 days it has faced resistance over there with a pattern of shooting star on the daily time frame, and today there is a follow through on the downside. 2600 and 2000 would be good accumulation stages for this counter, with targets of about 3000 and 3400 200, which seems to be the previous top. So this is news driven. I would probably stay away from this at the current levels, not take a punt here. And if it comes to 2500 levels or even 2000, 2200 levels, I would definitely be a buyer at the lower levels.
Vineet, I wonder how you're playing consumption at this point. FMCG is one of those top gainers, but along with it, you also have some QSR numbers trickling through. It's frankly been a mixed bag of sorts. How would you look at it, and what are your key takeaways? How would you play it?
So, I would be playing the staples and a little bit of fashion. So when we talk of fashion, Nykaa looks very good to me. I see a lot of upside coming here. Staples may be like, the typical businesses that are there, they will do well. Apart from this, still consumption remains to be a mixed bag. So being very selective on the stock picking.
Okay. Amit, would you have a take, or would you have a preference within that FMCG basket? How are you viewing some of the counters?
I mean, I like Varun Beverages. It has, kind of taking support at the current levels at around 480, 460 levels. And from a technical standpoint, if it does close above 490, I would definitely be a buyer here, keeping 480, 475 as my stop loss for trading targets of about 520 on this counter.
Okay, all right. So that's with regard to some of those FMCG counters and consumption names. Neeraj, anything that stood out for you with regard to consumption?
I mean, Honasa. I mean, not strictly FMCG, but just the kind of move that Honasa has made today, despite numbers which look, I thought the numbers were okay, but clearly the street sees something else. Maybe I don't track it that closely as well, but an 18% up move.
At some point, we'll have Mahima come in and maybe talk about Honasa. That'll give us a better perspective as well.
Maybe. I don't know if Vineet Bolinchkar has a view here or no.
So maybe that.
Maybe. Vineet, do you look at Honasa? I mean, what explains this 18% up move?
So, to be very honest, we had looked at it after the IPO. We had built some modeling. And that time we were perplexed why the stock was at, 450, 500 bucks. Then we saw the tank and we saw the revenues also play off. And today it is up 20%. I think it's following the Nykaa thing that I suggested to you, that fashion is picking up again.
Yeah, but I mean, interesting that it's happening just a day after the results. So clearly something in the results. I mean, at least I couldn't get picked, but as Harsh said, so maybe it's a combination of two, right? What Vineet is saying, that maybe fashion is picking up, plus this much might have something that Mahima will be able to better throw light on. But what a move on this one today. Okay, there are other stocks which are on our radar, and Puneet Johnson with a list of some of those. Puneet, was it 3 key stocks?
Yes, definitely. And all three are up in trade today after really strong quarterly earnings. The first one's Pharma. This reacted very strongly on open as well. Was up about 10%. Currently trading at around 7 to 8%. 42% revenue growth. EBITDA was up almost 44%, with the overall margins being boosted at 11.6%. And the company's profits have also come in at 38% growth. And this company is largely involved into doing a lot of EPC projects also for the power sector. So we've seen a up move in power sector as well as the stocks. And this was another key beneficiary of that as well. The other one, Centum Electronics. Now this integrated EMS player again posted decent set of numbers, 28% growth in revenue. EBITDA was also up to 38 crores versus same time last year 5 crores. Margins are subsequently is up 10.5%, and profits again are up at 21 crores in this particular quarter. Now the company also recently did a QIP. They also saw participation from the 3P Ventures, which is a fund led by Mr. Prashant Jain, who was a veteran fund manager at HDFC previously. So the company is now integrating itself into into being one of the leading EMS players, and we're seeing that playing out in the numbers as well. And finally, TBO Tech, another very recent listing, very integrated with the travel as well as the hospitality space. Revenues up 20%. EBITDA also margins, a slight dip in absolute percentage margins, and that's largely because of higher revenue growth, and net profit as a whole is up 21%. What's interesting with TBO Tech is that the international business continues to do well. The revenues of the international business was up 32%, coming in at 344 crores, but the domestic business has started to slow down now, and that's showing in the numbers as well. Currently, India revenues were down 8% at roughly about 109 crores, and again, the international GTV was up 19%, while the India GTV was down actually 11%. So it is the pivot of the international business for the company that is doing well, and that's reflected in the stock price performance again today.
Okay, thank you for that, Puneet. So those are some stocks which are moving on the back of numbers. TBO Tech, what a move, 13% move on the back of those numbers. But time for a management conversation. We have with us Vishwanathan Venkatramani, who is the CFO at Green Panel Industries, to talk to us about Q4 numbers. Sir, talk to us, slightly weaker quarter.
Yeah, definitely a weak quarter. In fact, I would say it was the full year was a weak one, primarily led by increasing capacities in the MDF segment and a steep increase in wood prices, which saw it going up about 23% year on year.
Do you see some of those improving, including pricing for you? Do you see that improving? Do you see volumes improving? How does FY26 look, sir?
Okay, we definitely see volumes improving. So I think if you look at a business that's primarily led by MDF, which constitutes almost 90% of the top line. So here again, I would split it into domestic and exports. On the domestic side, we did about 367,000 cubic meters last year. So we would be targeting about 480,000, including about 72,000 cubic meters from the new plant. And on the export side, we did about 71,000 cubic meters last year, and we would be targeting about 84,000 cubic meters this year, including about 12,000 cubic meters from the new plant. So overall, so against volumes of about 440,000 cubic meters last year, we should be looking at volumes of around 550 to 560,000 cubic meters this year.
And sir, how should margins evolve? They've fallen now for full year below the 10% threshold. How quickly can those recover, and how are raw material prices treating you at this point?
Okay, it's dependent on a few factors. So at the moment, we are not building up any price improvement in the segment during the current year. We are primarily focused on volumes. So higher capacity utilization and some softening in wood prices should help us to keep MDF margins at around 12% this year.
And how quickly does that happen, sir? It happens straight off from Q1. Are you already seeing that?
Not really. It will happen over a period of time. Like it would depend on how quickly we ramp up capacity utilization at the new plant, because the additional fixed overheads would be very low at the new plant. So the sooner we ramp up capacity utilization, we'll see the improvement in margins. And also the softening in wood prices. So it would happen over a period of time. So we are looking at an average reduction of about anywhere in the range of 6 to 10% in wood prices for the full year. So, you can't really estimate how that will happen quarter on quarter. But yes, on an average, we think it should be in that range.
So, give us some perspective. Real estate seems to be doing extremely well, and it's holding up on the higher base as well. Why is demand softer for you? Give us some perspective, and what changes in FY26 that gives you that confidence that things will look better?
See, I would, divide real estate into two parts. So if you look at the, last 4 years post-COVID, the top listed players have been doing well. But, if you look at the mid-segment and the smaller players, they've not been doing great. In fact, a host of projects are lying either, incomplete or have been abandoned. So I think that's why the recovery is taking time. And, in our business segment, capacity is doubling over the last 2 years. Steep increase in import volumes from other Southeast Asian countries also had a significant impact on the business.
Got it. Mr. Venkatramani, Neeraj here, two questions. One macro really, and just a follow-up to what you just said. Is it that competition from unorganized players is heating up? Because I see this in a lot of companies in your sector, wherein the growth has been, for lack of a better word, a bit anemic over the last few years. It's difficult to predict a linear growth trend. So is it that regional players, small players, unorganized players are kind of challenging the biggies like yourself?
I wouldn't just attribute it to the unorganized or the small players, because they have not really been setting up very large capacities, though the major competition has come from large capacity additions by organized players and also a steep increase in imports last year. But post-implementation of BIS, we have seen a sharp fall in imports. And, I think post-February 26, when BIS is also expected to be implemented for the furniture segment, we will see a sharp increase in furniture manufacturing in India, which would contribute to, a significant increase in demand for furniture building materials.
Okay, fair call. Very interesting. Remember, viewers, green panel is a separate kettle of fish in that over the last 5 years, that one has had a really good move. So you have to bear that in mind. One question, Mr. Venkatramani, your entry into plywood, and is there a reason why you would make that move in a highly competitive space? Do you see a reason or a right to win there?
Okay. So if you look at, how we came into the plywood business. So when the demerger happened from Greenply, the Uttarakhand facility was manufacturing both MDF and plywood. And since it was an integrated unit, we could not physically separate the two units. So that part of the plywood business came to us. And most of our focus was on MDF, where we have been, building up large capacities over the years. So I think there was lower focus on plywood, but we always feel that the premium plywood business will continue to do well in future. Because there would be different customer groups, which would be using different raw materials. The mid segment using MDF and particle boards, and the premium segment using plywood. So we are approaching the plywood business with renewed focus, and will possibly look at expanding that business maybe in FY27.
Okay. Thank you so much, Mr. Venkatramani, for coming in, speaking with us, giving us that perspective and the outlook for FY26. Wishing you all the very best for that.
Thank you.
Right. Vineet, let me come to you. How best would you play this space? Building materials on the consumption side, would you play it at all, or would you avoid? And real estate as well, to a certain extent. Would you play that?
So, real estate, although interest rates are looking to ease out further, we are slightly skeptical on certain micro markets like Delhi, Bangalore, Hyderabad, Pune, etc. Purely from the perspective of that the entire demand is IT driven, which is going to face some headwinds in the US. So IT is very selective, and rationally, building materials also becomes a very select play. Will be more into your plumbing equipment, etc. Paints is a better play out here because it is got repeat usage. So paints is the way to go, and within that, avoiding Asian paints. Apart from that, looking at Berger and Kansai.
Okay. The other big one in trade today was a Sun Pharma on the back of numbers. Focus today obviously on the Q4 numbers, but what we're going to do is take a bit of a step back and we're going to look at the bull versus bear case, because stock is down 2.5% on the back of those numbers. Varsha here to present that bull versus bear case.
Thank you for that. So, two reasons why the stock is down. One is, of course, missed Q4 numbers and the soft guidance given by the company in the con call. Let's see what's working and what's not working for the company. Well, India formulation sales grew 14%, demonstrating strong, robust performance when it comes to home market. But, competition and pricing pressure did affect the US generics market, and the US market declined. So, US formulation sales actually declined almost 3% for the company, and this was led by competition and pricing pressure in US market. Now, global specialty business, which is the next leg of growth for the company, grew almost 17 to 18% in FY25. Now, this growth was led by the specialty products like Winlevi and Illumia. But the global specialty sales when it comes to Q4 grew only 8.6%, which was very below estimates. So normally if you see 10 to 12% is the growth rate which was expected by the industry, but the result came out with only 8.6% growth. Now they launched 10 new products in India, and they plan future launches in the high growth areas like diabetes and weight management. We all know that GLP-1, that is semaglutide, liraglutide, is the next hot topic when it comes to pharma, and Sun Pharma is also launching products when it comes to into these areas. Of course, the specialty products will be launched by the Sun Pharma, but the soft guidance for FY26 has been given by the company to mid to high single top digit growth for FY26, which is actually which is the street is not liking this. Now this guidance has been given considering the uncertainty in the global market as per the management. Now the most favored nation policy, wherein Trump had an executive order wherein he wants to decrease the prescription drug prices, will actually not affect the generic business, Sun Pharma's generic business. But on the bear case, if you see, this may have an impact on the specialty portfolio, which is the next growth driver. So overall, if you see, the pressure that we are seeing in Sun Pharma is because of the lower specialty business sales and soft guidance given by a company in FY26. In fact, we spoke to CS Muralidharan, who is the CFO, group CFO of the company, on the growth outlook ahead. Do listen in.
So that's why I mentioned that it's sometimes important to look at the full year numbers also instead of one specific quarter. On a full year in FY25, the specialty business grew at 17.1%. All our key specialty products, Illumia, Sequa, Odomzone, Winlevi, are well positioned to grow, and we expect the growth trajectory to be maintained in the future years.
Okay, so that's of course data information coming on Sun Pharma. Vineet, how do you look at the numbers as well as the commentary? How should one look at pharma as a whole? Seen a decent rally as well, right?
Yes. So there has been a reasonable recent rally, but the mixed bag of numbers is going to weigh on the price. I think Sun Pharma has played out its course, and we'll be looking at some other stocks more in the CDMO space than the pure pharma plays. I think they offer better value for money. Laurus Labs, 1 point. These stocks look very good when we look at the risk reward that is there in the market.
Amit, do you have a view with regard to Sun Pharma?
Yeah, I do. Let me just pull the chart up. So what I have noticed in Sun Pharma is it has tried a couple of times in the last few months, last few weeks to break out of the 1800 levels, but it has failed. And however, the good thing is that it has also found support at around 1600 levels. So what we are noticing is we are noticing a very tight range of about 200 points on Sun Pharma. And notwithstanding what is happening from the fundamental side, as long as the stock doesn't break out of the 1800 levels, I would not be a buyer in this counter. And if it does break out or out of 1800 levels, then I would look to play the momentum on the upside.
Okay. All right. So those are views coming in with regard to a Sun Pharma. What we're going to do is slip into a very short break. On the other side, we're going to give you BTST ideas and picks. And we talk about a few more counters in focus, especially on the back of earnings. Something like a BEML is up 2.5% as well on the back of numbers. We leave you with the Nifty up 1% or so. Of course, stay tuned on the other side.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where
So, welcome back. And Honasa has to be in focus. Maybe it is the underlying volume growth recovering strongly with that 21% YOY growth during the quarter. Or maybe it is that the valuations are factoring in some bit of a recovery, but not entirely. But it is a stock in focus. We spoke about it earlier. Mahima now joins in with the details of what happened in the quarter and the outlook ahead, maybe. Mahima.
It's been a great quarter for Honasa this particular quarter, and this is because there has been green shoots that have been observed in their stores. Now revenue was largely in line. EBITDA and net profit was a beat in terms of its estimates. There has been a double-digit YOY growth in its key categories, and modern trade has showed a 20% plus YOY offtake growth. Volume growth stood at 21% this particular quarter. In terms of numbers, revenue was up 13%, EBITDA down 17%, but better than expected. Margins at 5%, much better than that of expectations of around 3.4%. Net profit was down 17%, but better than what the street was expecting. Street was expecting a 16 crore net profit versus that of net profit that came in at 25 crores. EBITDA was down due to 20% uptick in other expenses as well. Now, in terms of what brokerages are expecting, well, Goldman Sachs has maintained a neutral but hiked the target price to 275. They're saying that there are encouraging green shoots overall. Sequential growth recovery in Q4 has been observed. Mamaearth's improving trends is driving the growth in terms of recovery. Offline channel revamp has shown results this particular quarter. Honasa's derma skincare brands continue to post strong performance. EBITDA margins to recover and will likely cross the FY24 levels only in FY27 according to them, which is where they've maintained a neutral. So this is the overall view as to what's happened with Honasa this particular quarter and how it is fair.
It's only moved from strength to strength. Thanks, Mahima. 18.5% higher now. Amit, well, not quite in the derivative space, but I'd still love for you to tell us how does it look on the charts. We got Vineet's view earlier. Clearly, it's the move is out of the blue, really. What does one do here?
One would stay out because this kind of a move is absolutely out of the blue. It has gone up by about 25% in this week. Astounding move. would have been a good pick at 240 levels where it did give a breakout, but not at these levels because it is nearing close to the gap down levels of 360, 340 levels. So I don't know how much of more steam is left in this or not. So in spite of after such a sharp move, I would rather stay back, have a look at it. Maybe if it dips a little down, then take a momentum bet here.
Okay, Ashok Leyland's numbers flashing at the bottom of your screen. Profit is up nearly 40% on a YOY basis. Revenue up just about 6%, largely EBITDA driven, it would seem, but those numbers trickling through. Largely in line is my sense, but of course we'll have Puneet come in. The spike on the stock suggesting, of course, some bit of enthusiasm there. Vineet, would you have an opinion on the frontline numbers if you've had a chance to look at them on the screen? Vineet, believe you're on mute. Yes, please.
Yeah. I just kind of miss looking at those numbers that appeared on the screen.
No worries.
But my sense is that, among the four-wheeler stocks, the CV especially, Ashok Leyland is the most insulated, and I believe that the company will continue to do well. They've got substantial levers to grow. Your small commercial vehicles do very well. Ashok Leyland's products are very well received in the market, and with the declining interest rates, I think this cycle can also start picking up going ahead. So positive on this. And definitely the numbers are reflecting that kind of sentiment.
Amit, do you have a view? Because what we are seeing is we're seeing that spike getting neutralized now. In fact, the stock is closing in on the flat line. Amit, do you have a view?
So from a technical standpoint, it has been moving up and giving a higher high, higher low formation for the last from the month of April onwards. However, if you notice the current move, everything is getting faded. So what I would do is, if I had to play this I would play it on the long side, but pick this up at around 220 to 225 levels, keeping a stop loss at around 215 levels.
All of those gains at this point, Neeraj, been given away, where and Ashok Leyland is concerned, was perked up 2%. All of the gains wiped at the moment, just about 0.5%, largely where we were prior to the numbers coming out. So that's currently how Ashok Leyland is playing. We'll quickly have Puneet as well, and he'll give us a view as to how the numbers are playing out. Vineet, while we're at it, within the two-wheeler basket, is that something that you would play, or would you prefer the CV segment? You clearly like CV, but would two-wheelers be better, or would you stay away?
So two-wheelers, I think Hero has shown some kind of early green shoots of better mix. So it is growing away from its traditional entry-level model and adding more value-added products. So I think that can build on the margins, and it will also bring a lot of growth in the numbers. So from that perspective, Hero Motor looks very cheap compared to the other two, and this stock could possibly move to 6,000 if the trend sustains month on month.
Okay. Let's go across to Puneet, standing by with Ashok Leyland's review. Puneet, how's it looking?
Well, these are very strong numbers for Ashok Leyland, Harsh. At a time where the company's sales for FY25 just grew by 0.2%, the numbers have come and actually beaten estimates across the four numbers. Revenue was expected to be 12,605. It's just been around that number, 11,900. In the margins, they were expected to come in roughly around 13.9 to 14%, but it's come in at 14.9 to 15% range. And this might be the highest EBITDA margins for the company in its history. So very, very strong numbers in terms of EBITDA as well. Profitability was expected to be around 1100 crore. It's come in much higher, above 1200 crores for the company as well. And the much awaited number of a bonus issue for the companies actually come through. 1:1 bonus is the first time in the last 14 years. I think the last bonus was in 2011, and now the company's bonus issue has come in 2025. It's coming at a very interesting time though for the promoter, because it's a similar promoter to IndusInd Bank as well, so definitely something there. But overall, I think the MHCV sales were up 4% in this particular quarter, and it's the first quarter where the MHCV sales showed a growth in FY25, and that's reflected in the strong numbers as well. So really strong numbers across those four, and I think we had the management conversation lined up today as well, and which will play on Monday. But the conference call at 6:30 will be key to know some of the commercial vehicle outlook going forward, because we've seen the both listed players of Ashok Leyland as well as Tata Motors lose some market share in small commercial vehicles, so something a little bit there. But both on the MHCV side, it's a strong number, and that's reflected in healthy margins for the company today.
Thanks for that, Puneet. And Vineet, okay, it's an interesting point being made here, right? That the last time that, I mean, for a dividend paying company, a bonus is a great thing. Otherwise, I mean, just about something, your shares double but your price is half in a 1:1 bonus. So technically it should make an issue. But if there is a dividend being paid, then it's important, because that could mean that a higher dividend coming in, because dividend is a percentage of face value of a share being given. No big reaction though on Ashok Leyland. A spike and then a trough and completely away. Amit, would you trade this one?
I've been my view on Ashok Leyland. I would stay away from participating on the long side at the current market price. But since it has given a breakout from a trend line, and I would be a buyer in this counter purely from a technical standpoint at around 220, 225 levels, not at the correct levels.
Okay, well, that's Leyland, and you will hear from the management, of course, on Monday. So bear that in mind. Just trying to figure out some breakout stocks and seeing what could be really zooming. So is Liberty, I believe, Liberty is at 462 or 463, a bit of a spike in that one. A very sharp move in Adani Enterprises for the day today. So it was anyways up. I think it's inched up a bit more, 1.96. No, not really, just about there, but it's been in the green for sure in the session today. There is a bit of a move in Max Financial too. So you might want to watch out for that stock as well in the session. The Adani Group stocks, Amit, and particularly Adani Enterprises, a lot of talk of maybe a possibility of strong moves, considering the fact that the unmanned aerial vehicle story has worked well for them, and there is the Navi Mumbai airport that will add some fuel to the fire for the sum of part for Adani Enterprises. Any thoughts here on this one?
This stock has faltered to deceive since last November or so. I mean, it's been 6 months that it has been in a tight trading range of 2,000 on the downside and 2,500, 600 on the upside, and it continues to be there. So there is no momentum as such in this. If I were to take part in this stock technically, I would definitely look at taking part once it breaks through 2,600 levels, keeping a positional stop loss of below 2,300 and 200 for targets of about let's say 3,000 levels. But technically speaking, if I were to look at the indicators, this is a fairly flat stock on the momentum front. So until and unless it proves that it has really broken out, there is no point in participating in this, because it probably would tire one out as a trader.
I want to also mark out an Apollo Micro. The stock is down 8% on the back of numbers. And I'll quickly also read out the numbers for your reference. It doesn't look like a bad set at all, Neeraj, frankly. Revenue is up around 19% on a YOY basis. EBITDA is up 25%. Profit up 8%. Probably there is some one-off which is sitting there, which is why profits are up 8%. I'll quickly have a look at those numbers. But while we are at it, let me go across to Puneet, who's standing by to talk to us about whether tech stocks could be the safe haven in this market. Puneet.
Well, definitely, Harsh. At least Bernstein is affirming a positive view on them. They actually have 6 outperform calls as well as 1 underperform. They have a outperform rating on Infosys, TCS, Tech Mahindra, at least in the large cap space, and Coforge, KPIT Tech in the mid cap space. They are maintaining an underperform rating on something like an L&T Tech, and the new target prices are reflective on the screen right now. Now they're making 3 key points in this particular report, and Indian IT services, they appear to be turning a corner according to Bernstein. They've also said that the demand outlook has largely remained stable, with the financial services vertical showing the growth for all these companies, and that is reflected in its positive view for the large cap peers, which have a lot of revenue coming in from the US as well as from the financial verticals as well. They are seeing some deal activity getting picked up on the ground, and see that Infosys as well as Coforge are one of the couple of top picks as well. I also just want to quickly highlight a Macquarie note as well from the morning. It was written on TCS specifically. They've maintained an outperform rating on the stock with slight target price cut to 4640 per share from 4770 earlier, and they've again mentioned that the margin improvement back to 26% could be likely by Q4 of FY26. They've also mentioned that TCS has generally good margin upsides when the utilization improves for the company, and TCS could be more competitive essentially in getting deals faster as well as when the margin pressure slightly eases. So they have this as one of the top marquee buys for Macquarie. They are saying that the downside is also protected from just a dividend yield of 4.1%. So a clutch of brokerage views today, and largely maintaining the positive view on the large cap IT players based on the growth in financial vertical as well as higher dividend yields for these stocks.
Okay, well, and then Puneet, thanks for that. And in fact, as the AI juggernaut picks up, Pankaj Murarka of Renaissance Investment Managers believes that AI is the internet moment for the entire world. He, of course, spoke at length about how AI will benefit the IT industry in the coming years. Listen in.
There have been a lot of concerns that AI will cannibalize and negatively impact IT services company in India. But I don't think so that's going to be the case. I think there will be, resetting of skill sets within the IT companies, and IT companies are pretty agile. They've navigated multiple technology shifts and trends over the last 20 years as the world moved, from ERP or cloud to ERP to cloud to digital and so on and so forth. And I think this is going to be the internet moment of the world, which effectively I mean the tech spends that we over the next 10 years, the surge that we'll see will be very significant. And as you rightly said, IT services company have a very important role to play because now that AI is here, or Chat GPT or whatever other fundamental foundation models are in place, those need to be implemented, and that can only be done and integrated into businesses, and that will mean huge amount of workflow for IT services companies.
Well, so that's some perspective coming with regard to an IT, but it's 3:20. I want to quickly take it across to Amit for the BTST STBT trade of the day. Amit.
Yeah, it's SBI Life. I like the chart pattern. There is a lot of momentum in the life insurance space, including HDFC Life as well as SBI. But there has been a fairly substantial move more in HDFC Life. So I'm betting that SBI Life would probably be a catch-up play. Probably look to enter at the current market levels, keeping 1750, 1740 as stop losses for targets of about 1900 levels. The momentum is very good. It is giving a higher low formation, and I'm expecting this momentum to follow through in the next week.
Interesting, Neeraj, the fact that both the technical analysts today on the closing show have recommended SBI Life. One, of course, as the BTST STBT, or rather BTST call of the day, and the other one also was one of the top picks for Ruchit as well. So that's one thing to keep in mind. The other one, Neeraj, is BSE, which is in focus. Tuesday expiry for NSE index derivatives will then likely push BSE to Thursday for BSE derivatives. And that switch in expiry day could reduce, in fact, BSE's market share in index options premium by 3 to 4 percentage points. This is as per Goldman Sachs. They'll continue to monitor details on the potential change of expiry days, but the stock completely brushing that off, up 6%. It goes ex-bonus today, and likely a reaction to that, it seems. Amit, do you have a view with regard to a BSE?
I'm afraid the stock has been running up quite sharply, and there is this range in which it is, currently stuck. The range happens to be between 2,300 to 2,500 on the top, and we are in the middle of it. So again, as a technical analyst, if I'm looking to play the breakout, I would play the breakout if it closes about 2,500. And if I'm confident that the trend will persist, I will probably do a value pick at around 2,300 as well. So there are two ways to play it, but not at the current levels.
Okay, not sure. We have Vineet joined us back. Okay, so we'll sit out of that one. Honasa now locked in upper circuit. So yeah, 20% higher on Honasa. And Amit, I wonder, and I want to take a couple of stocks here within that IT basket and quiz you on it. One is with regard to a TCS, the other with regard to an HCL Tech. Do you have views on either of those?
So from a technical standpoint, most of these stocks did form a bottom a few weeks back and have now started taking some bit of resistance at their weekly moving average levels. If you look at TCS, it has taken rejection last week at around 3,600 levels. And even the pattern that it has formed this week doesn't seem to be too encouraging. So until and unless, for a fresh leg of rally, until and unless 3,600 levels is conquered on a weekly basis, I would not really look to take a punt on TCS from a positional perspective.
And what about... Sure, please. Sorry. Please go ahead. HCL Tech. HCL Tech.
Yeah, HCL Tech seems to be a better candidate because it has closed above the moving average last week, and however the current week is not all that promising. Still, if I would want to play this stock, HCL Tech seems to be a technically better proposition. I would look to take a position here, keeping a tight stop loss below 1,600 levels for probable targets of about 1,800 levels.
So, Neeraj, while we were speaking about a BSE, some of the other AMC stocks also flying around. DAM Capital is up 10%. Angel One is up 6%. You have something like an Anand Rathi, which is also up roughly 2.5 odd. I wonder, Amit, if you have a view with regard to any of these.
So I'm a happy investor in Angel One, so I would, due to SEBI regulations, I would refrain from giving a view on Angel One. However, if I were to, I don't track DAM Capital as such, so I wouldn't have a...
Recently listed, so I'm sure that chart structure there is limited for you to pick up. But is that a space which you're liking? Any, maybe one or two other names if you're liking within that pocket?
I like the entire capital market space. Being from the capital market space all my life, this is a space that always excites me. I like most of them. As I said, Angel One has been I am an investor in Angel One. I cannot really give a buying call on this as such.
But yeah, big moves into the capital marketplace, and we spoke about it. Maybe, I mean, I tried to mark Motilal Oswal if that was moving. That wasn't. But DAM Capital certainly is 259 now, and maybe we should. I don't know if MK as the broker also, because the non-wealth guys are the ones which are maybe doing well. No, 361.2 is doing very well for itself, so 2.47% higher. And with capital markets being the way they are, no wonder, no reason why this should not. By the way, as we speak, the rupee is strengthening too. 90 paise uptick at 85.11 against the US dollar. So that is something interesting too. When talking about the yield differential, I mean, the move that the rupees made, or maybe a lot of other currencies have made vis-a-vis the dollar, is exemplary. Stocks which are making a move, Met Plus has had a big spike, so watch out for that one. Sharp up move in the last few minutes of trade. So that is a stock that you want to keep an eye out for. 8% higher for a Met Plus in trade as well. As we wind down, and I know we've taken your BTST, Amit, but if I were to urge you to give me a positional call on something which you would like to keep for maybe 2-3 weeks, that, and if not that, if you have any option strategy for us, Amit, be that, I mean, we are close to the end of the expiry, but still.
It's a little difficult to place an options bet in the last dying minutes of the trade. However, as I said, I've noticed something very interesting in Bank Nifty, as I alluded to earlier during our conversation, that the 56,000 strike, which happens to be the in-the-money strike for the Bank Nifty, has seen a lot of addition on the put writing side. In fact, the amount that I recall was about 1 lakh shares, which is unusual for an in-the-money put option to show this kind of behavior. So I'm expecting that the market will probably try and conquer 56,000 levels in this closing expiry of the month. So anybody looking to trade the Bank Nifty from an options perspective could probably look at setting up a bullish sort of a trade, which could benefit from this upmove.
Amit, before I bid you a goodbye for the weekend as well, Tata Steel is one stock that really stands out. 8 out of 10 sessions in the green. It's done very well for itself. Even during these kind of volatile times. What's the sense like? Can this kind of outperformance sustain?
So Tata Steel has been, from those low levels of 125, it has been a rank outperformer. However, the current level at around 162, 163 levels, there is some bit of prior resistance. I would, if you're already in the trade, you might want to be a little careful. If there is any reversal here, you might want to book some bit of profits and take it home. If not, if somebody is looking to, take fresh entries, it would be better advised that you enter this trade only once the 170, 165 levels is taken out on the closing basis. It's a really strong momentum, but it's close to a resistance point. So a little caution is advised here.
Okay, slight bit of caution, wait till 165. Thank you so much, Amit, for coming in, speaking with us, giving us all of those views. Let's look at how the Nifty is settling in at for the day as we close the week as well. But we've closed in the green today, or nearly there, 1% higher. 24,850 is the number that we've hit this week. Let's look at the intraday as well as thereafter look at the week gone by. Get us better perspective. 1% higher. It's been a decentish day. We've sustained the highs and we've been fairly range bound for a better part of the day after that spike that you can see. So we've largely sustained that. We've done well for ourselves. Let's look at the week gone by as well. Zoom out a little bit. It's been a slightly weak week. It's 0.5% lower on a weekly basis on the chart. Let's look at the Bank Nifty as well. For the day, we've done well on the Bank Nifty again. In fact, we've given up pretty much. Okay, that's the week. So it's a flat week for the Bank Nifty. So despite that 0.5% spike that we saw on the index today, we've kind of closed the week flat on the Bank Nifty. Nothing to complain about per se. That's how the day has gone by. Nearly 1% higher on the Nifty Bank Index as well. Chart structure largely similar to the Nifty 50 index. Let's now look at the heat map on the Nifty. Let's see whether the breadth has changed at all. It has a wee bit. A couple of other stocks entering the red, and we're also seeing a bit of a cool off, as has been the case on the index as well. But just a wee bit, not evident. The breadth still extremely strong on the Nifty 50. Let's see how the breadth on the broader market also has shaped up. Well, it's largely steady and roughly 3:2 in favor of the advances. So therefore, the Nifty Midcap and Smallcap indices slightly underperforming the Nifty 50 index is how I would play this. Around 0.6% higher on the Nifty Midcap and thereabouts on the Nifty Smallcap as well. Let's look at these two on a weekly basis as well, because it's interesting how the Nifty Midcap and Smallcap have outperformed the Nifty 50 index. That's the Nifty Smallcap for the week, 1/3% higher. Quite a bit of outperformance there, nearly 1%. And the Nifty Midcap index is down 0.7% for the week. So this one has actually underperformed the Nifty 50. It's a tale of two different cases, especially when it comes to the Nifty Midcap and Smallcap. So broader markets can't be painted with the same brush, at least for this week. That's what's standing out. Let's look at sectors for the day and let's look at the heat map as a whole. I'd be curious to know how the Nifty defense has fared for this week after the kind of rally that it saw last week. But the Nifty Pharma and the Nifty Healthcare are the two sectors trading slightly on, in a sense, slightly more muted than the larger market, where we've seen good traction within FMCG consumption. Those were the spaces that led the markets. Private banks also have done fairly well for themselves. The Nifty PSU Bank has underperformed slightly, but outside of that, the Nifty Bank has held fort, has done fairly well for itself. Let's look at how the Nifty Defense has done for the week, because that's the one other fascinating index. A muted kind of move, but I wouldn't complain too much, because last week's 14% move on the index met with just about a fifth of a percent lower for this week. Means that the index has still done phenomenally well for itself. An absolute flat day for the Nifty India Defense Index. Let's look at the BSE 500 top gainers, top losers. Of course, you will have some of these on the back of numbers, but there were plenty of pockets which were really moving around. Let's look at something like a Mahindra Life, a Raymond, where we've seen plenty of sharp moves this week. A KPR was down 4% as well on the basis of news, and Aegis Chemicals, a Kaplan Point are the other few pockets where there was some bit of traction. GMM Pfaudler, second straight day where the stock was down 4% plus. Let's also look at what to watch out for on Monday, because plenty to look out for through the weekend. You have India Forex reserves, which we'll have to look out for. But outside of that, nothing major on the macros. You'll have Pearl Global, interim dividend of 6.5 rupees a share. You will have, again, corporate action, interim or rather dividend from Archean Chemicals as well as Lloyds Metals. Very small numbers in that sense. You will have Aegis Vopak, fresh issue 2800, IPO opening on Monday, price band set for 223 235, and you'll have Schloss as well. Interesting that we've starting to see IPOs again trickle through. So that's the other theme that's likely playing out. Those are all the earnings that you want to look out for. NTPC is the big one within that pack, which we will be tracking. But for the moment, and those are more earnings, of course, you'll have an Akim's Drugs as well within the broader markets, a Gillette, and that will get us better perspective on how consumption is playing out. And you'll have an Aurobindo Pharma as well within that large cap basket, where you will have earnings coming through. But with that, completely out of time on this edition of India Market Close. From Neeraj, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. We'll have Himakshi on the other side take Market Express.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people, or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use math to predict human behavior?
The 2007 split was a tough one, wasn't it?
I look back, maybe I want to take charge of it too quickly. My ego came in the way. Net, a year later, the three people who selected me as a CEO said, we don't want any CEO.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome to Market Express, your fast-track source for the latest updates from the markets along with national and international news. I'm your host Himakshi Bahuguna, bringing you the key stories and breaking developments to keep you informed and ahead. So let's dive right in. Viewers, the benchmarks performed better than the broader markets in trade today. After a weak start, the markets rallied to close in the green. The Nifty was up 1% and the 30-pack Sensex ended over 700 points higher. While the broader markets underperformed the benchmarks, they ended with gains too. All sectors except defense and pharma concluded the week with losses. Eternal, HDFC Life and Jio Financial Services emerged as the top gainers in the Nifty basket. The Smallcap 250 index is up 9.7% and the Midcap 100 is up 6.5% since May 9th. Now, these stocks have been outperforming the benchmarks by over 3 times. Defense stocks are the heroes of the month. Defense stocks have rocketed by 24% in 1 month, thanks to the buzz around Operation Sindoor and the Make in India push by Prime Minister. FMCG stocks are on a high as the news of an early and above average monsoon cheered traders. Now, the Nifty FMCG index was up over 1.5%. IT sector makes a comeback due to bargain buying. Now, tech stocks had corrected sharply for 4 out of 5 sessions in the past week. Rupee rises sharply against US dollar, strengthens 90 paise to settle at 85.11 against US dollar, the highest level since May 14. In conversation with NDTV Profit, the Chief Financial Officer at Hindustan Unilever, Ritesh Tiwari, said that HUL will now focus on driving double-digit EPS growth, which is expected to be largely driven by top line. Now, the FMCG major posted a 3.7% year-on-year rise in net profit to 2,493 crore rupees, up from 2,406 crore rupees in the same quarter last year. Metro brand sees strong sales momentum driven by festive season, demand and a surge in e-commerce growth. Now, in-house brands continue to dominate revenue contribution while demand picks up in the second half. Margins improve thanks to better cost management and restructuring in the filler segment, leading to reduced losses. Despite some revenue softness, profitability remains on an upward trajectory. Metro Brands rides festive season momentum with consumer sentiment looking upbeat, says company CEO Nissan Joseph as he confirms company's strong long-term growth ambitions targeting sustainable expansion. The company remains optimistic about the demand trends, focusing on brand strength and operational efficiencies to fuel future growth. KNR Constructions faces setbacks as it gets backlashed over the NH66 collapse in Malappuram. The company receives a show cause notice with bidding suspended for a month by NHAI. Meanwhile, KNR maintains a strong order book with a significant chunk coming from road projects as it evaluates financial implications moving forward. Power mech projects made waves in trade as Q4 earnings impressed. Strong revenue growth and a sharp rise in EBITDA drive momentum, with margins holding steady. Investor sentiment stays upbeat, reflecting the company's solid financial performance and continued business strength. Centum Electronics delivers a strong Q4 performance, with revenue climbing and profitability turning around. EBITDA sees a sharp jump, while margins expand significantly. Exceptional gains and tax credits further boost the bottom line, reflecting the company's improved financial health and operational efficiency. Premier Explosives reported a revenue decline of 14.7% year-on-year in Q4, driven by a 33% drop in defense and space services revenue. EBITDA fell 39.8%, with margins contracting to 12.9% from 18.3%. Margins narrowed due to higher employee costs and other expenses. Net profit also decreased 44.7%. The company maintains a robust order book of 7,500 crore rupees, which is 1.8 times its FY25 revenue. Container Corp's Q4 revenue fell 1.6% versus last year to 2,288 crore rupees. EBITDA declined by 11.6% to 440.6 crore rupees. Margins slipped to 19.3% from 21.4% for the first time, below 20% in over 15 quarters. Now, other operating expenses rose by 20% year-on-year. Net profit also decreased 1.6% to 298.5 crore rupees, partially cushioned by a 50% year-on-year increase in the other income. Deepak Fertilizers reported a strong Q4 of FY25, with revenue surging 27.9% to 2,667 crore rupees. EBITDA grew 10% to 480 crore rupees, though margins dipped to 18% from 21%. Now, net profit also rose 23% to 277 crore rupees, up from 225 crore rupees. The company also announced a dividend of 10 rupees per share, signaling confidence in its financial health. The BSE Sensex is undergoing rebalancing effective June 23, with Nestle India and IndusInd Bank making way for Trent and Bharat Electronics. The BSE 100 index is welcoming Dixon Tech, Coforge and Indus Towers, while Bharat Forge, Siemens and Dabur India are exiting. In the Sensex 50, Interglobe Aviation and Shriram Finance are joining, replacing Britannia Industries and Hero MotoCorp. Meanwhile, IDFC First Bank is entering the BSE BankX as Canara Bank moves out. ITC delivered a remarkable surge in its consolidated net profit, reaching 19,727 crore rupees, largely driven by an exceptional item. Now, this marks a significant leap from 5,121 crore rupees in the previous year. Meanwhile, profit from continuing operations saw a modest 3% year-on-year increase to 5,155 crore rupees. Now, the board has declared a final dividend of 7.85 rupees for FY25. Grasim Industries Q4 standalone revenue grew 31.89% year-on-year to 8,925 crore rupees, driven by business expansion. However, EBITDA fell 58.17% to 220 crore, with margins contracting 530 basis points to 2.46%. Margins were impacted by weak profitability in viscose staple fiber and chemical segments. The net loss narrowed to 288 crore rupees from 441 crore rupees, supported by reduced exceptional loss of 114 crore rupees compared to 715 crore rupees. Honasa Consumer, the parent of Mamaearth, saw its shares surge 12% in early trade. Now, this jump followed a 13% year-on-year rise in revenue to 534 crore rupees in Q4 of FY25. However, the company reported an 18% year-on-year decline in consolidated net profit to 25 crore rupees, down from 30 crore rupees a year earlier. Now, despite strong revenue growth, profitability took a hit, impacting investor sentiment. Sun Pharmaceutical witnessed a nearly 5% decline in early trade as investors reacted to its quarterly results. The stock hit an intraday low of 4.77% from the previous close before settling lower post-market. Despite the slump, revenue rose 8.5% year-on-year to 12,816 crore rupees, with EBITDA margins improving to 28.7% from 25.3% last year. Now, the margin expansion was driven by reduced R&D and operational costs. Mankind Pharma's Q4 results showed consolidated revenue in line with estimates, but EBITDA margins fell short due to elevated cost, higher integration expenses from the acquisition of Bharat Serums and Vaccines, and increased selling expenses weighed on the profitability. The company's exports business doubled year-on-year, driven by new product launches and BSV consolidation. Jindal Polyfilms shares declined over 11% across 4 sessions as a fire at its Nasik subsidiary continued burning for 54 hours, impacting 90% of the production. The stock fell 4% today. Due to the nature of the crude petroleum products, firefighters had to use foam instead of water to control the blaze. The prolonged disruption has raised concerns over the operational recovery and financial impact. Trump's One Big Beautiful Bill is gaining traction after securing US House approval, shaping domestic policy with implications for India's power, auto and IT sectors. Now, the bill is accelerating clean energy tax credits while tightening FEOC compliance, affecting companies like Waaree Renewable Power and Azure Power. Auto firms including Tata Motors and Bharat Forge are benefiting from the tax relief on car loans, boosting US vehicle sales. Meanwhile, the IT sector is seeing an increased demand as corporate tax cuts and R&D deductions stimulate economic activity. Waaree Energies is facing potential challenges after the bill was passed in the House of Representatives. Now, the bill accelerates the phasing out of investment and production tax credits for the clean energy. The bill also tightens FEOC compliance, which could significantly impact the utility scale and rooftop installations. With 57% of Waaree's order book tied to the US, the company may see export opportunities shrink sooner than expected. However, the 45 times manufacturing tax credit remains valid until 2031, providing some relief for its US plant. Now on to an NDTV Profit exclusive. The government notes strong performance by consumption companies, buoyed by monsoon trends, with rating agencies aligned on India's economic outlook. America's Big Beautiful Bill has had an impact, though its effect on the remittance remains unassessed. Now, the JSW Bhushan Steel verdict authorities affirmed that the strength of IBC law but acknowledged the execution challenges, with no decision yet on a review petition. Upcoming GST Council meeting expected in Delhi will address rate rationalization and compensation. The Reserve Bank of India is set to transfer a record surplus of 2.5 to 3.5 lakh crore rupees for FY25, aiming to ease fiscal deficits and boost bond markets. Analysts expect that payout to enhance liquidity and investor sentiment driven by forex earnings and reserve valuations. The economic capital framework was recently reviewed with a split committee debating global concerns versus maintaining current policies. Now, the final surplus transfer awaits the government's approval, with expectations surpassing last year's record of 2.1 lakh crore rupees. In a major development, India is set to allow US private firms to bid for approximately $50 billion worth of central government projects, covering around 40,000 tenders as part of an ongoing trade talks. Now, this move follows India's recent free trade agreement with the UK, which opened up government procurements. Now, the plan offers phased reciprocal access, with Indian firms also eyeing opportunities in the US markets. Notably, the initiative is limited to central government projects, excluding state and municipal tenders. Rishabh joins us with more details on this significant, but we'll be catering that later on. With that, Zepto has temporarily paused Zepto Cafe operations in 80 stores across 6 cities. Sources told NDTV Profit that the operations have been paused in Agra, Chandigarh, Meerut, Mohali, Amritsar and parts of Delhi due to high demand. We understand that the company is evaluating a tech revamp and new vendor systems to enhance efficiency. Now, the operations are expected to resume by June. Gig workers affected by the pause were informed in April and offered the option to shift to dark store operations. No specific financial impact was detailed, but the move aims to address operational challenges. The Enforcement Directorate is conducting searches on Friday in connection with a 12,000 crore rupees fraud case involving JP Infratech, JP Associates Limited and others. Now, authorities are probing them under the Prevention of Money Laundering Act 2002 for alleged fund siphoning and fraud with home buyers and investors. According to ANI, searches are underway at 15 locations in Delhi, NCR and Mumbai, including JP Associates and its associated entities. Now, the investigation is intensifying as officials examine potential financial mismanagement. The DGCA has issued a statement on Indigo's Delhi-Srinagar flight turbulence incident. Now, the airline has submitted the incident report to the regulator. DGCA is currently probing the incident. This comes after the Indigo encountered severe weather near Pathankot. Crew attempted route deviations to avoid storm, but were denied by authorities. But no injury to any of the passenger on board the flight. Investigation is still ongoing. A severe storm accompanied by intense lightning has claimed at least 50 lives in the last 32 hours. Among the victims are 17 women and 33 men, as per official figures released by the administration. Authorities are on high alert, with the rescue and relief operations underway in the worst hit areas. Citizens are advised to stay indoors and follow safety guidelines as more thunderstorms are expected. India has issued a notice for the partial closure of airspace over the Andaman Sea on May 23 to 24. Now, the airspace closure is due to a planned missile test by India. India is gearing up to oppose the proposed $20 billion World Bank aid package for Pakistan, set for discussion in June 2025. According to sources cited by the NDTV Profit, New Delhi plans to push for Pakistan's re-inclusion on the FATF grey list and has already raised concerns with the foreign ministers of Germany, Italy and France. India-Oman deal nears the finish line as India and Oman are close to signing a comprehensive economic partnership agreement with final talks underway. The last sticking point is Oman's Omanization policy, which India wants eased to project jobs for Indian professionals. Now, the deal is expected to cover 98% of the Indian imports and boost trade in goods and services. Adani Group Chairman Gautam Adani at Rising Northeast Investors Summit on Friday announced to invest additional 50,000 crore rupees in Assam over next 10 years. The group has already invested 50,000 crore rupees in the northeastern state. Shares of most Adani Group companies were trading higher in Friday's session. The World Health Organization has warned that Gaza's health system is on the verge of collapse as Israeli hostilities intensify. Now, with hospitals overwhelmed and supplies dwindling, the WHO says urgent access is needed for medical aid and evacuations. The warning comes amid a sharp escalation in violence, placing unprecedented strain on already crippled healthcare infrastructure. The US Department of Homeland Security has released a statement citing pro-terrorist conduct at Harvard University, escalating its standoff with the institution. As part of the action, foreign students currently enrolled at Harvard will be required to transfer to other institutions. Now, this follows recent federal funding cuts and ongoing tensions between the university and the Trump administration. Tragedy in Australia. as record floods claim 4 lives and leave nearly 50,000 people stranded. A slow-moving, low-pressure system has triggered what's now declared as a natural disaster. Authorities are warning residents returning home to remain cautious of hidden dangers in flood-affected areas. And viewers, with that, it's a wrap on this edition of Market Express. Up next, my colleague Sanchana takes over with Profit 360, bringing you sharp insights on markets, national and international news. So stay with us right here on NDTV Profit.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this segment.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use math to predict human behavior?
The 2007 split was a tough one, wasn't it?
I look back, maybe I wanted to take charge of it too quickly. My ego came in the way. Net, a year later, the 3 people who selected me as a CEO said, we don't want any CEO.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this segment.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
All sectoral indices end higher except Nifty Pharma, which underperformed. Eternal Limited and HDFC Life Insurance emerged as the top gainers in the Nifty 50, with both stocks posting strong gains. Sources tell NDTV Profit that India will take up funding to Pakistan in June 2025 with the World Bank and will also urge the FATF to put Pakistan in the grey list. The Adani Group announces a significant additional investment of 50,000 crore across the Northeast over the next 10 years, spanning across many sectors, including green energy, roads and highways, and digital infrastructure. The RBI is expected to announce its dividend payout to the government for the fiscal year 24-25. Sources say India could offer opening up public procurement to private US bidders as part of trade talks. The market will be opened up in a phased reciprocal manner, meaning Indian firms could also get access to US public procurement markets. Ramping up the pressure on Harvard University, the Donald Trump administration blocks the university from enrolling international students. Existing foreign students at Harvard have been asked to transfer or lose their legal status. Good evening, you're watching Profit 360 on NDTV Profit and I'm Sanjana. Along the next half an hour, we're going to bring you the latest on markets as well as national and international news. So let's dive right into it. Benchmark indices ended higher today with both the Nifty and the Sensex gaining 1%. The Nifty closed near 24,850 while the Sensex added over 700 points, supported by strength in FMCG and IT stocks. Now, Eternal and HDFC Life Insurance were the top performers on the Nifty and the FMCG index was the top sectoral gainer for the day. My colleague Harsh now joining with a detailed market roundup of the day. Harsh, over to you.
Well, the Nifty closed the day and the week off with a gain of 1%. Of course, we're slightly off the highs of the day, but nonetheless, we gained 1% over yesterday. That's how I would rather look at this. Even for the week, we've not done too badly, and therefore the slight correction that we've seen in the week, even if I can call it that, less than 0.5% for this week, doesn't look as bad, at least on the index. What was impressive though today was the breadth on the Nifty 50 index. 46 stocks gain versus just 4 losers, and therefore, and within those losers as well, Sun Pharma was one of them on the back of numbers, and therefore technically the breadth was extremely strong on the index. Eternal was one of those stocks which were gaining, life insurers as well, and HDFC Life, SBI Life. You also had a Power Grid which was doing fairly well for itself. So some of those names did well for themselves in trade today. Now let me talk a little bit about the overall breadth, because that didn't match the breadth of the Nifty. The overall breadth was 3:2 in favor of the advances. So around 1300 odd advances to around 800 odd declines. But what again stood out is the fact that the Nifty Midcap as well as the Smallcap indices did well and closed largely in the green. The Midcap index underperformed, as has been the case this week. In fact, the Nifty Midcap index has underperformed by quite a bit this week versus the Nifty 50 and surely versus the Nifty Smallcap, which is actually closed in the green for the week gone by. Among sectors, consumption was the core theme which played out well today. The FMCG stocks were buzzing. You had the likes of an ITC which came out with numbers, adding a little bit of zing. Varun Beverages also was up around 4% thereabouts. What didn't do well in terms of sectors was frankly far and few. You had something like a Pharma which is down around 0.5% thereabouts, and a healthcare index which is absolutely flat, slight negative bias at close. So maybe those two sectors on the back of everything that's playing out within pharma earnings. But I want to talk a little bit about the Nifty Defense, because for the last week the Nifty Defense was up 14%. Now therefore this week you would expect some bit of correction, but that hasn't come at all. The Nifty Defense has been flat, slight negative bias for the week, 0.2% lower for the week, the Nifty Defense Index, and that's what the other piece is that stood out for me this week.
Right, thanks so much for that, Harsh. Indian markets are clearly on fire and the bulls are taking notice. This is also what economist and president of Yardeni Research, Edward Yardeni, had to say today. Now, speaking on the outlook for emerging markets, he says India stands out because of its entrepreneurial demography that outshines even China. While he also acknowledged valuation concerns, he believed that India's earnings growth will justify the current market levels in the long run. Let's listen into that excerpt.
India needs to file an application with the people who put together these stock market indexes and say, you know, we're different. India's stock market has been on fire. It's been very strong. There's a lot of optimism about the outlook for the Indian economy. The demography is much younger, more entrepreneurial as compared to other emerging markets, particularly compared to China. but also India, other emerging markets like Brazil, Indonesia, they require commodity prices to be strong. That's in India's case, an environment where commodity prices are stable and relatively low, as they are now, benefits India more than most other emerging market economies. So the only problem with India is it's been discovered, and valuation multiples are high, elevated. But I think over time the earnings will justify them.
Meanwhile, government sources have told NDTV Profit that India plans to scrutinize the World Bank's upcoming lending package to Pakistan while pushing for its relisting on the FATF grey list over money laundering and terrorism financing concerns. Now, this move follows the IMF's recent $1 billion bailout to Pakistan, which India has criticized for its timing, coinciding with Pakistan's military aggression after Operation Sindoor. Now, with another potential funding round in June, India is raising objections more assertively than before. For more details, let me quickly go across to my colleague Shrimi Chaudhary joining us on the phone line. But before that, let me just give you some context as to what has happened. Now, just what we were talking about, the IMF recently offered a bailout package to Pakistan amounting to $1 billion, which India has already criticized for its timing. This is coinciding with Pakistan's military aggression after Operation Sindoor. Now, we have also seen India sending delegations, and there is in fact a briefing that's going to be taking place earlier this evening, where Foreign Secretary Vikram Misri will in fact be delegating and will in fact be briefing the rest of the delegation. Let me quickly bring across Anil Trigunayat, Vivekananda International Foundation, joining me as a guest this evening. Thank you so much for your time, sir. I'm going to get right into it. How do India's objections, whether it is with regards to IMF or the World Bank, align with the broader foreign policy, especially in the context of counter-terrorism and financial accountability? We're seeing a new India and a new playbook.
Well, you're absolutely right. I mean, as you know, what is India's new normal now? I mean, and the whole world knows that Pakistan is the haven of terrorism. 4 times it has been listed by FATF. It has recently come out of that. And despite that, after the Pahalgam attacks, the clear Pakistani connection was evident. And India had only attacked the hideouts, terror hideouts in Pakistan. And everybody knew about it. And this was very clear that the Pakistani generals were there at the funeral of these terrorists who are designated by the United States and the West. And at that time, giving $1 billion package out of the already $7 billion then on May 9th was in itself an affront to the civilized world, in my view. And therefore, the countries who are on the board of IMF could have either postponed it for some time. At least the messaging could have gone to Pakistan. Now these kind of activities embolden Pakistan. So this is very clearly our policy, and that is one of the reasons that we have about 7 delegations of members of parliament from across party lines going to different countries, trying to convince those major countries that they need to take a principled view of what things. The money that is being given, where it is going, what is going to be used, whether the country is using for war or for what, for promoting terrorism, which it is doing. Now, for example, in Pakistan, the government there announced that they will be giving 1 crore rupee for each terrorist, 100 odd terrorists who died there. Now, from where is 100 or 150 crore rupees going to come? Now, would there not be an accountability? Fortunately, with the thing is that like the IMF has agreed and put additional conditionalities, about 11 or so, while they go in for a review in September for that. But I think they have missed the bus. They are emboldening Pakistan, like some of Pakistan's friends like China, Turkey and others, to continue on the path of terror. I mean, that is something that the country, India is not against Pakistani people, but it is against the deep state which is running the country. And that's precisely what is happening by the World Bank. And I'm quite sure that we will be conveying our concerns to all such organizations. They must have some conditions. They must have proper mechanisms to monitor these, and not just blindly go in because of the geopolitical reasons that some governments follow or continue to do so.
Absolutely, sir. Sir, as a former ambassador, if the World Bank does not act, if you could just take us through what are India's alternative strategies to curb Pakistan's access then to international funds?
Well, I think it is very difficult. The one thing is that every country is provided a certain voting rights in the World Bank, as you know. So India's voting rights per se are not very big, but there are others, our friends and partners. We can always prevail upon them, who are supposed to be our strategic partners. I mean, I would have been very happy if some of our friends, like in Europe, like France and others, would have abstained along with us at the IMF voting, because there's no negative voting there. So it goes through, but then it would have been better. That would have at least communicated a message to Pakistani government that business as usual cannot go. So we'll have to do a lot of public diplomacy. We'll have to speak to our partners how to contain it or put conditionalities so that the money does not flow into the hands of terrorists via their deep state.
And sir, my last question, how do you see this issue evolving? Do you think that it could set a precedent for similar moves against other nations that are accused of financing terrorism?
I think so. I mean, it'll all depend on how strongly you urge the international community and how important you are in the scheme of things. That's very clearly thing. If they feel that they have stakes in your stability, they have stakes in your security, in your growth, in your development, then obviously most of the countries will look at it with a little more concern. But if they think that certain countries are just not good enough for their equation, then they might not pay much attention to them. Basically, at the end of the day, this is the current international system is post-1945. The Bretton Woods institutions need tremendous reforms, bring about the changes that have happened in this 21st century and not reflect the 20th century realities. So that's what India is trying to do. The reforms in the IMF, reforms in the World Bank, reforms in the United Nations, those will come about when the large community of nations, the Committee of Nations, will be able to have the legitimate voices heard in that, and they could be part of the developmental process in the world and of course confront these global challenges. One should not think that terrorism against India will be contained in India. It is something that is going to impact the whole world, like the climate change does.
Anil Trigunayat, Distinguished Fellow, VIF and former Ambassador, sir, thank you so much for your time and that perspective. And we'll continue tracking the latest and bring you more details with diplomatic pressure mounting and India pushing for Pakistan's relisting on the FATF and the grey list. The next few weeks could prove decisive in shaping global responses to Islamabad's actions. Now, as the debate over Pakistan's funding intensifies, India's leadership remains firm on its stance against cross-border terrorism. Just this morning, Home Minister Amit Shah, delivering the Rustomji Memorial Lecture organized by the BSF, stated that Operation Sindoor has conclusively exposed Pakistan's direct role in sponsoring terrorism in India. He emphasized that while Indian forces targeted terror bases in Pakistan, it was the Pakistan army that retaliated with aggression against India.
पहलगांव में इंतहा ही कर दी, निर्दोष यात्रिकों को धर्म पूछकर अपने परिवार के सामने, परिवार के महिला सदस्य और बच्चों के सामने चुन चुन कर निर्ममता पूर्वक मारने का पाप पाक प्रेरित आतंकवादियों ने किया। और उस वक्त हमारे प्रधानमंत्री जी ने उनको कहा था, बिहार से कहा था कि इसका उचित जवाब दिया जाएगा, और ऑपरेशन सिंदूर ये उसका जवाब है। आज पूरी दुनिया हमारी सेना की वीरता और मारक क्षमता की भूरी भूरी प्रशंसा कर रही है। और मैं आज इस मंच पर से सेना के उन वीर जवानों को, तीनों सेनाओं ने मिलकर जो पराक्रम किया है, वो सभी को समग्र राष्ट्र की ओर से मैं उनको अभिनंदन भी करना चाहता हूं और धन्यवाद भी कहना चाहता हूं कि आपने देश के स्पिरिट को वहां तक पहुंचाने का काम किया है जहां पहुंचाने की जरूरत थी।
And ahead of key diplomatic missions, Foreign Secretary Vikram Misri will also be briefing multi-party MP delegations representing India's stance against terrorism under Operation Sindoor. Senior leaders from the BJP, the Congress and the NCP will travel across the US, Europe, the Middle East, Africa and Latin America, engaging global allies. With a unified message, India aims to reinforce its position. Terrorism has no place in the modern world. And to wrap all of this up, let me quickly go across to my colleague Shrimi Chaudhary, who has in fact brought us this latest news. Shrimi, we're looking at first the IMF bailout that was actually questioned, but now a very crucial update coming in with India likely to raise issue with World Bank funding as well to Pakistan in June 2025. Take us through all of the details.
Yeah, sure, Sanjana. Actually, 2-3 important points what we have been given to understand from top government sources here is one on the part of World Bank. So, the government of India is likely to take up the matter with World Bank very soon ahead of its funding, which is expected to be out in June itself, which is of course $20 billion. So, the government is likely to raise that matter up with World Bank of India and of course express its disappointment there and kind of, tell them that this is not the right strategy in terms of being a multilateral lender to give, Pakistan any such support at this point of time when they are involved in such activities. Second point I wanted to highlight here is with respect to the FATF. Now remember, FATF has certain compliance which every country has to follow, which includes money laundering, etc. So what they are trying to sort of tell FATF in the upcoming meeting that they have to put Pakistan into grey list, which they were there till 2022, and on certain conditions they were put out from that list. But India is going to raise that point that they have not met those compliance which is required under FATF. So they are kind of very much, have a criteria or kind of reasoning to put them again in the grey list. The third point which government sources, top sources are telling us on the IMF bailout package, which we have, seen on May 9th, it has come. So on that, they are in constant touch with the IMF. In fact, there is one, meeting also scheduled, next month itself. And in fact, the next funding is scheduled for September. And for that, they are, kind of India taking a stern stance there that, 28 times, Sanjana, is where the IMF has supported Pakistan, is what the sources in government telling us. And in more of such cases, it's about either the war or war-related situation. So that kind of scenario they are raising at this point of time with IMF. And in fact, the government is saying that we have raised already such points in the past as well. And there is a clear-cut point and a stern point that they are not eligible for such kind of lending. So they should definitely review it. In fact, they recognize the clear fact that IMF has, put a condition after the bailout package which they have been given. And they're saying that they, kind of appreciate that fact and they should continue, putting such kind of condition before, issuing such kind of bailout packages to the country.
Shrimi Chaudhary, thank you so much for that very crucial update. We'll continue tracking that story and bring you all of the latest. Let's remember, this is as repeated interventions and now India once again ramping up the pressure, not just with the IMF, but with the World Bank as well. Let's move on to what's happening between India and the United States. Sources say India is set to allow US private firms to bid for federal government projects worth over $50 billion, marking a major policy shift in its trade negotiations with Washington. Now, this move follows a similar agreement with the United Kingdom, where British firms gained access to select federal contracts. For more on this, let me quickly go across to my colleague Rishabh.
Right, what we're picking up from official sources is the fact that India might be looking at opening up its large public procurement market for the US firms as part of talks for this bilateral trade agreement that are underway. What we're hearing is the fact that India could open up this market of roughly about $50 billion, which is actually a small portion of the actual public procurement market that India has, which stands at around $700 billion. A small portion of it could be opened for the US firms, for US private bidders as well. This will, of course, be done in a phased as well as reciprocal manner, which means that Indian firms will also get access to the US market. And it's not just a loss for Indian firms that will be facing heightened competition back here on home turf. What we're also seeing is the fact that India has been following this sort of opening up of this government contract bidding scenario in the form of trade deals that it has been signing over the past year or so. We've seen that come in with UK. We've seen it come in with respect to the UAE as well as Australia. And a similar move could be made for the US, given that India is wanting to sweeten this deal and seal an interim trade deal as early as possible. And that is to avoid the reciprocal tariffs, of which the pause period ends at around July 8th. So we're seeing a sweetening of this deal as far as the US bilateral trade agreement is concerned.
Thanks so much for that, Rishabh. Let's move on to what's happening in the top court today. In an ongoing attempt to crack down on online and offline betting apps, the Supreme Court has agreed to examine a plea seeking a complete ban on illegal betting apps. The petition also sought strict regulations on online gaming and fantasy sports and the enactment of a comprehensive law. The bench, comprising of Justices Surya Kant and N.K. Singh, has also refrained from issuing notices to the state governments at present stage. Aishwarya joining in with more details.
Well, the Supreme Court has issued notice to the centre and this is on back of a PIL that has been filed in the Supreme Court asking for regulation or ban on online as well as offline betting applications. As far as this case is concerned, it was filed by Dr. K.A. Paul and the case was heard by Justices Surya Kant and Justice N. Koteshwar Singh. Now, what does the PIL exactly demand? It demands a uniform central law for governing betting as well as gambling activities in India. What it also says and urges removal of illegal betting apps from platforms like Google as well as Apple. The plea is also seeking blocking of foreign betting platforms by TRAI as well as the Ministry of IT as well as Electronics. What it will eventually do is for the ED and RBI, it will be their job to investigate money laundering linked to betting apps. Following this PIL, Justices Surya Kant noted during the arguments that the legal limitations in curbing voluntary acts like betting need to be looked at. The court also compared this to an addiction towards cigarette use, also highlighting the lack of awareness campaigns. Now, Justice Kant terms widespread online betting a social aberration in the digital age. Apart from that, all in all, the Supreme Court directed a soft copy of the PIL to be given to the Attorney General as well as the Solicitor General of India. So this case can be treated fairly even in the future. All in all, what it does, while the online gaming cases are ongoing for the last couple of weeks, it does set a precedent for stricter regulation on online gaming as well. So we'll keep you posted on the developments that happen further as far as online gaming and betting cases are concerned.
Thanks so much for that, Aishwarya. We'll continue tracking that case. Moving on, JSW Steel posted a twofold jump in net profit to 1,503 crore, up from 717 crore, but fell short of NDTV Profit's estimate of 1,608 crore. Now, the company remains in the spotlight over its failed Bhushan Power and Steel acquisition, rejected by the Supreme Court. In its filing, JSW, however, stated that it is exploring legal remedies, but does not foresee any adverse financial impact on its standalone results. At the Northeast Rising Summit in Delhi, Prime Minister Narendra Modi praised the region, referring to it as Ashta Lakshmi, a symbol of prosperity. He emphasized its rich diversity and immense economic potential, highlighting key sectors such as tea, petroleum, sports, skills, ecotourism and energy. At the same event, Adani Group Chairman Gautam Adani announced an additional investment of 50,000 crore in the northeastern states, further strengthening the region's economic prospects.
साथियों, भारत को दुनिया का सबसे डाइवर्स नेशन कहा जाता है और हमारा नॉर्थ ईस्ट इस डाइवर्स नेशन का सबसे डाइवर्स हिस्सा है। ट्रेड से ट्रेडिशन तक, टेक्सटाइल से टूरिज्म तक, नॉर्थ ईस्ट की डाइवर्सिटी ये उसकी बहुत बड़ी स्ट्रेंथ है। नॉर्थ ईस्ट यानी बायो इकोनॉमी और बाम्बू, नॉर्थ ईस्ट यानी टी प्रोडक्शन एंड पेट्रोलियम, नॉर्थ ईस्ट यानी स्पोर्ट्स एंड स्किल, नॉर्थ ईस्ट यानी इको टूरिज्म का इमर्जिंग हब, नॉर्थ ईस्ट यानी ऑर्गेनिक प्रोडक्ट की नई दुनिया, नॉर्थ ईस्ट यानी एनर्जी का पावर हाउस। इसलिए नॉर्थ ईस्ट हमारे लिए अष्टलक्ष्मी है।
3 months ago, in Assam, we pledged an investment of rupees 50,000 crores. Today, once again, humble and inspired by your leadership, I announce that Adani Group will invest additional 50,000 crores across the Northeast over the next 10 years.
And that's a wrap on Profit 360. Stay tuned to NDTV Profit for more news and updates.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use math to predict human behavior?
The 2007 split was a tough one, wasn't it?
I look back, maybe I wanted to take charge of it too quickly. My ego came in the way. Net, a year later, the 3 people who selected me as a CEO said, we don't want any CEO.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company?
welcome. You're watching NDTV Profit. I am Mahima Vajrajani, and with me today in an exclusive conversation is Ritesh Tiwari, who's the CFO of Hindustan Unilever. Ritesh, thank you so much for speaking with us. My understanding right now, if through this conversation is we want to try and understand as to what's happening in the entire sector, and of course how HUL, being the bellwether of FMCG, can convey to people as to what's happening in the space. My first question to you is that FMCG as a sector has been under pressure in the past 1.5, 2 years because there is demand which is weak. There is volumes which are elusive right now. There is also inflationary pressure playing its role, competition playing its role. I want to understand as to what is the kind of strategy in place for you right now in terms of what could be the next line of growth for HUL, and what are the discounting strategies especially in place when it comes to competition?
Yeah. So two things are changing, Mahima, overall. First of all, the overall macro conditions in FMCG are improving. So when you look at good agriculture outcome we had both for Kharif and Rabi crop with a good monsoon, overall food inflation, which has been very stubborn for some time, has come down in the country. The monetary easing that government has done, the amount of tax relief that people have got as per the budget latest. If I add all those elements put together and then I look at headline commodities, large commodities like crude oil, crude palm oil, they also have come off from their peaks. So all put together, overall macro conditions which supports demand is improving. There has been in the past year a purge in overall disposable income and the real inflation which has happened. So all put together, the consumption, as you mentioned, has been not as good. But the way we see going forward, the conditions are improving. Equally, what we have done as Hindustan Unilever, we have done a lot of work on our portfolio, especially in categories like beauty and well-being. And so that is one reason why we do believe that going forward, the trading atmosphere will be better than what we had in the past. Second, channels are changing and getting disrupted at a very high pace. Organized trade is growing much faster than general trade. We have also pivoted our portfolio and our investments towards organized trade. So put together, when I look at both internal factors and external factors, we do see overall trading conditions improving, demand outlook improving, and hence also our own performance we expect. Let me say the first half of financial year 25-26 should be better than second half of financial year 24-25 which just went by.
Right. You mentioned that, right now your modern trade is doing better than your general trade, and quick commerce has been a disruptor when it comes to, how trade happens right now. It's a structural change that we're observing. Just wanted to get your sense there because now quick commerce is really picking up, you might have to change your inventory model. How has that impacted your working capital? Has that, already taken place, or is it still impacting your working capital? And do you think that overall your distribution strategy that is there right now in place will change going forward as well?
Yeah. See, overall, if I take a step back, the construct of the business from channel perspective is still 70% general trade, 20% modern trade, roughly 7% e-commerce, and then 2-3% other channels. Quick commerce within that for our business is roughly 2%. It's small this point in time, but growing very rapidly. And hence we are also growing very rapidly in quick commerce. Portfolio, we are expanding. So as consumers are adopting quick commerce as a channel, we are also increasing our assortment in quick commerce. We are increasing and improving our customer service. The way number of times of serving a place has also further increased. Investments in channels of the future, be it modern trade, be it e-commerce, overall across all the ports has also got dialed up. So ultimately for us, we are in the business for selling soaps, shampoos, our various products, and hence we are very consumer focused. Now, wherever consumer journey of shopping is changing, we have to respond to that and ensure that we are fully present wherever consumer journey takes them to shop. And hence today, organized trade is doing much better than general trade in terms of consumer shopping experience and journey. We are doubling down on this point in time on organized trade. So investments are going up, customer collaborations are increasing to ensure that we are present with full-on portfolio in organized trade.
Right. And in terms of price points there then, because right now, both in e-commerce as well as quick commerce, what I'm seeing is that there are a lot of players in the unorganized space, especially startups, which have really come out and done well in terms of your ice cream business or your beauty and wellness products. How are you viewing that as competition, one thing, and then how are you, placing discounts and prices in place to compete with them?
Yeah. See, India, when you look at overall competition, there's every kind of competition in the country. We have large multinationals in the country. Almost all of them operating in India. We have large Indian conglomerates into FMCG. We have amazing listed companies doing business in FMCG. We have very good regional and local brands across the country which does business. And then exactly to your point, the entire D2C industry which is also playing. It is pretty comprehensive competitive landscape. Working with this competitive landscape in last 4 years, we've added more than 200 BPS corporate market share. As HUL, we have a portfolio which straddles across all the price pyramid, from premium to mass. And that portfolio completeness helps us to compete across channels and across all the competition.
Okay. So then in your premium portfolio, what you're also doing is you're making smaller packs of those premium portfolios and selling in the rural markets, because rural markets are right now doing better than urban markets, right? So just wanted to understand as to how sustainable demand is for those premium products in the rural markets considering this rise. I mean, are they willing to pay at this price point? And secondly, in terms of your volume and value growth, do you think that the next leg for FMCG will be more of a value-led growth rather than a volume-led growth because of the kind of structural change that we are seeing in terms of demand?
Yeah. So the rural consumption habits are dramatically changing. No longer, let me say, take an example of beauty. No longer a moisturizer like Glow & Lovely and talcum powder is the beauty quotient for a woman in rural area.
Correct.
Even a rural consumer who wants to use beauty products ends up using 3 to 4 different products on the face to complete the beauty regime. And which is why it is very important for us that we are able to make all formats of beauty products accessible. And for that matter, many more premium products accessible to rural consumers. It typically happens by making small pack of a premium product. And this is how we end up penetrating into rural areas. And we have seen that success across. So Dove Bar, for example, it's a premium soap bar. It gets sold in cities. It gets equally sold in a smaller pack size in rural areas. And we have developed such access packs for all premium products for multiple categories to cater to rural consumers as well.
Right. And beauty and wellness is one of those segments that's doing well for you. So just wanted to get a sense there as to, in terms of growing this particular segment, what's the plan in place? Do you think it will be done via acquisitions, or there are new products that you'll be launching? What's the next course of action there?
So there are 2 big actions that we're doing for our own portfolio within beauty well-being. First of all, massive amount of portfolio transformation. And we deploy all the 4 strategies for portfolio transformation. We take our large brands and then we enter into more demand spaces. So for example, take Vaseline. Vaseline has entered into sun care space. So that's one strategy that we do. We've taken Pond's. Pond's has entered into multiple demand spaces of sun care, light moisturizers, serum as a format. So you take large brands and get into more demand spaces. That is strategy number 1 to expand the portfolio. Strategy number 2 is to see if at all there's a demand space you don't have a brand, then we have to launch a brand in that space. So Novology is a classic example where we saw space in prestige premium skincare. We wanted to have a product and range. We used our global technology and we launched Novology as a brand in that space. So that's the second strategy to improve portfolio in beauty well-being. Third then is to look at the brands that we have in stable of Unilever and what is relevant for us to bring in the country. So for hair, for example, we just recently brought Nexus from the global portfolio. We launched in hydration space Liquid IV. Sometime back we bought Simple Love Beauty Planet from stable of Unilever. So we do bring brands from the stable of Unilever which are relevant in the country to expand the portfolio. And where we can't do the job from these 3 strategies, then the 4th strategy always is then to go for bolt-on acquisition. So we acquired, for example, Oziva a couple of years back in health and well-being space. Recently we acquired Minimalist in prestige, actives, science-led space. So all these 4 strategies will keep deploying because beauty market in India, it is fragmenting. And typically when you have a per capita consumption which is low, which is where India is today at $50 per capita, as market keeps improving with overall rising income levels in the country, we have always experienced in multiple countries in the world, skin care takes off. The market fragments, penetration improves, consumption levels also increase.
Understood. And since you mentioned that you will be making investments, in growing your segments, just wanted to get a sense. As of FY25, when I was seeing your balance sheet, cash and cash equivalents was roughly 7,500 crores, right? And HUL is known for its dividend payout ratio as well. Just wanted to get your sense as to what is going to be the cash distribution policy like, because right now shareholders might be expecting something from you in terms of returns. What is there in in place in terms of dividend payout, as well as is there a buyback on cards? How do you plan to pay back to your shareholders?
So the way we look at overall capital allocation a little more broadly, and there are three components to that. Component number one, when we generate cash, first port of call is to deploy cash to grow the business. So in terms of investing for capital, investing behind brands, innovation and capability. So that's where we do our first deployment of capital. Second, we deploy capital to drive bolt-on acquisitions. So Oziva, Minimalist are classic example where we have a need to deploy capital to further improve the overall portfolio that we have. And third, we always believe in maintaining high dividend payout. We always have more than 90% dividend payout ratio. We have done for the last several years. Once in a while, when we do believe there's a little more cash that we want to give back to shareholders, we then go and do special dividend, which is what we did last financial year. So those are the strategies that we end up using to ensure that we end up giving healthy dividend back to shareholders. Ultimately, we have to ensure that shareholders get a very healthy return on capital, be it ROCE, which we always have maintained more than 100%, or for that matter, a very healthy ROE, return on equity. In last 4 years, we have done almost 400 BPS improvement in our ROE.
So that brings me to my next question. What are the ROC and ROE targets that you have for the next, let's say, 2 years down the line? What is the internal targets that you're aiming at right now?
So the ROC, we want to maintain above 100%. And when it comes to ROE, return on equity, as I mentioned today, we are at roughly 21.2%. We've improved last financial year by 120 BPS. We will want to keep making progress by improving 100 to 200 BPS going forward as well.
Okay, and in terms of acquisitions that you mentioned, will that be only in beauty and personal care segment? Because foods is something that's a segment that's remained under pressure. Do you think that segment plus your home care segment, will you be going ahead and making acquisitions there, or will you be adopting a strategy of introducing new categories or introducing new products there?
Yeah, as I mentioned a little while ago, for us to improve portfolio, we will do all four strategies across all the categories. Be it expanding our big branch into more demand spaces, even home care, for example. We've taken Vim, our very large brand, which is in dishwash, and we launched Vim Floor. We have now, second item I mentioned to you earlier, that the second strategy always is to launch new brands where we don't have in a demand space a brand. So we now launched Sun within home care as a dishwash brand for tier 2. And equally, let me say example of foods, where we brought Hellmann's from the stable of Unilever. And coming to bolt-on acquisitions, both beauty and foods are our two priorities for bolt-on acquisitions. We do believe that our portfolio today in home care is complete, and where we had space, we have launched Rin Liquid. As far as tier 2 liquid is concerned for laundry, we launched Sun in dishwash. So we do believe we have a complete portfolio in home care which straddles across the entire price pyramid. That is similar case in personal care as well. But foods and beauty are the two places where we have to continue to do more work in terms of transforming portfolio.
So
beauty, if I just probably capture overall one thought, Mahima, out here. As HUL, we are over-indexed on premium. There's one place where we are not over-indexed, which is beauty. And so hence beauty and well-being, you will see in next few years' time, we will make 900 BPS improvement in terms of contribution of premium products within the beauty business. And which is why the job of transforming portfolio, using all the 4 strategies of portfolio transformation, we will continue doing that job for business in beauty.
Okay, interesting. So then that means that the next leg of growth or lever will be from beauty and segment. Is that the right reading?
All of our businesses, if you look at, there are 4 different segments we have. Home care, beauty well-being, personal care, and foods and refreshment, which we call foods now. All 4 segments we see growth potential, and we'll grow all the 4 segments. The strategies that will be deployed to grow different segments will be different. Beauty well-being definitely has a job of being accretive to overall HUL growth, just because the sheer amount of low penetration and high consumption opportunities for us to keep dialing up, and which is why our investment decision of dialing up more investments behind beauty and well-being.
Right, okay, understood. And in terms of, having a competitive advantage, supply chain is something that one needs to have a control on, and HUL has been bang on when it comes to supply chain control. Just wanted to get a sense as to what's the next plan for capacity expansions. Will you be doubling down in terms of adding manufacturing capacities, or will you be outsourcing them and, adopt a capital asset-light model?
Overall, we believe that now is the right time. The conversation I had earlier, both looking at internal factors of the work that we are doing with our brands, our portfolio, and external macro, now is the time to dial up further investment across all lines of the P&L and balance sheet. Coming to capital, CapEx, we have typically done 2%. of capex expenditure to a turnover as a ratio, as a percentage. We will increase that now more closer to 3%.
Okay.
And the incremental investment will go behind multiple things. It will go behind capacity for growth. It will go behind capacity for innovation. Equally, to drive more productivity. We continuously look at our infrastructure in the country, how we can optimize to make our products produce more closer to consumers and a more cost efficient way, and it travels less number of kilometers. So hence there will be investment done for doing that as well. And last but not least, to dial up customer service. The point we spoke earlier about organized trade. As organized trade is becoming larger, it's a different way you end up servicing organized trade. So there will be investment needed for that. Even our general trade investment levels, we are increasing to increase our service levels there as well. So launching Shikhar, going to a go-to-market model like in Chennai, like in Mumbai, more direct to a Kirana store with the support of our distributors. So those are also spaces we are making investments.
Okay, and all this will be done through internal accruals, if I'm not wrong.
Sorry?
All this will be done through internal accruals, if I'm not wrong.
We have a pretty healthy balance sheet, so we'll be able to invest. So when we bought Minimalist, it was bought through internal accruals, and all the capital expenditure that we want to do, as I mentioned, we want to increase from 2% to 3%. We will do that with internal accruals.
Right. And in terms of growing your top line, because your sales CAGR in the last 3 odd years has been around 7 to 8 odd %. Just wanted to get a sense as to what's the target like, not for FY26, but from a longer term perspective, 3 years down the line. What's the kind of CAGR growth in terms of top line as well as bottom line that you're expecting? Because considering the investments that you're also doing, bottom line might see some kind of impact, but overall top line should be boosted because of those investments. So what's the CAGR growth that you're penciling in?
Yeah. So a medium to long term intention is to ensure we are able to drive double-digit EPS growth. If you look at the last decade, our double-digit EPS growth was driven by top line and bottom line improvement. Going forward, the way we see, it will be a double-digit EPS growth, but driven by top line growth and modest margin improvement. The latest guidance that we gave of our EBITDA, which will be more now trading into 22 to 23% zone, that's for next few quarters. But if I look at medium to long term, we will keep making modest margin improvement. But growth of EPS will be top line driven. India has seen 7 to 8% in the past, typically market growth, and this 7 to 8% market growth has come roughly half from volumes and half has come from price. As we speak today, overall climate and overall where commodity levels are, we don't see high levels of pricing. We see more modest pricing, and our own outlook is low single-digit pricing outlook. But we do believe, compared to last decade, FMCG industry will grow faster compared to what it has grown in the last decade. The sheer amount of consumption headroom that we have in the country, the entire India growth story, the demographic dividend of the country, we do expect all of that will augur well for FMCG. So I do expect FMCG industry to grow faster in the next decade compared to the previous decade. And our stated ambition always is to grow ahead of the market. And so we called out at least 100 BPS will grow ahead of the market. So this is where we do believe that a combination of growing ahead of the market growth improving, and over a long-term basis, we have seen 3 to 5% pricing coming in, which is not there now, but it will come back sooner or later as commodities do stabilize. And hence a combination of volume-led growth and price-led growth with modest margin expansion should help us to drive basically EPS growth, which will be in double digit.
Okay. In terms of, there was an interesting EY report that I was reading, which said that 52% of sales right now is happening in private label goods, right? So I wanted to understand as to what's happening there in terms of your organized versus unorganized market, and in terms of HUL being a bellwether, how do you plan to, convert that unorganized market also into an organized market? What are the strategies in place?
So this is overall Mahima secular trend. Overall in FMCG, portfolio is getting more premium. So getting entire across all categories, portfolio becoming more premium, that's a secular trend in the industry. Conversion of, let me say, loose tea to packaged tea, unorganized to organized, unpackaged to package, that is a trend which also is secular. It will keep happening. Places where this is more relevant, the shift is, I would say, is in skin cleansing. It is in, let me say, mass laundry, and it is in tea. Apart from that, bulk of the categories already is by and large organized. So, and at any point in time, there will always be players in all the segments. The point I mentioned that with HUL, we have a portfolio which straddles all the price pyramid. So today our portfolio is complete across all the categories. So we are able to compete with all kind of competition.
Okay, and one last question is that a lot of concentration right now is from D2C brands, and they're moving more towards personalization when it comes to their marketing strategy as well. So just wanted to get a sense there as to what is the marketing strategy in place right now, and how are you adopting to those changes?
Yeah. So a key focus now is to have a very renewed way of looking at our portfolio and growing in the future. We call it as core, future core, and market maker. Roughly half of our business sits in core. These are our large brands like Lifebuoy, or our businesses which like sits in shampoo sachets. Then you have future core business, and think of shampoo bottles which sits there, Lux brand which sits there. And then we have a market maker portfolio. That market maker portfolio today is almost a 7,000 crore business for us. And the way we see that 80% plus growth going forward for us will come from future core and market makers. And we'll keep doubling down our growth in market maker. This is the portfolio today which competes with D2C business by and large. This is where mass stage skincare sits in, this is where liquid sits in, this is where future formats of products like serum sits in. For us to compete across all the segment, it is not only important to have portfolio which is present. And as I mentioned, we are dialing up where we need to dial up, like in beauty, by 900 BPS, we'll increase the contribution of premium products. But portfolio is only half of the story. The balance half of the story is, do we have capability end-to-end to drive a profitable, sustainable, long-term business model for driving growth in that segment? An answer to that is work that we do across supply chain, work that we do across channels of the future in trade. So let me give you an example, supply chain. We have now 7 factories, which we call as nano factories. This is basically creating a supply chain for smalls. When you have that nano factory, which is housed within a large mother factory, it gets all the efficiencies of the large factory, but it has nimbleness and volume and agility of a small supply chain. So you have efficiency of a large supply chain with nimbleness and agility of a small supply chain. This is mission critical in case you want to then have a very sustainable business model for competing in niche segments as well. So our own business, which is today 7,000 crore business in market maker, if I click down into beauty, we have more than 2,000 crore business which sits in our 6 big bets in beauty, which sits in premium, which sits in, let me say, light moisturizer, sun care. These businesses are profitable. They make double-digit margin. So which is why it is very important to have a portfolio which caters to that consumer demand. Equally, there's end-to-end go-to-market structure of supply chain and distribution in customer development that supports this entire structure to make a profitable, sustainable, long-term business.
Okay, so Ritesh, one question that I had about your ice cream business was that now you've got the NSE and BSE approval also for the demerger of Quality Wars business. Just wanted to get a sense as to what's happening there. How do you plan to grow that business once it's demerged, and what are the plans in place?
So overall, Mahima, the plan that we have for ice cream business, we want to demerge the business and we want to list it. And hopefully with all the regulatory approvals and internal separation job that we have to do, we should be able to complete the job by March quarter 26. The whole idea behind that, see, ice cream is a high growth, but equally high capital intensive business and low margin business. It has its own distinctive business model where it runs on a cold chain both for manufacturing and for distribution. And hence we believe that having a business which a focus management, which is then able to deploy strategies which is suited to the distinctive business model of ice cream to ensure that we're able to create value differently, and hence the whole reason why we're doing what we're doing. And the business has today amazing amount of brands. It will continue to get support on portfolio, on brands from the global ice cream company, and we will continue investing in the business. Even in the current ice cream season, we have disproportionately increased our footprint of cabinets to serve more consumers across the country. And last quarter, we spoke about having a double-digit growth in the ice cream business. All the shareholders of HUL will be able to participate in the value creation of ice cream. The board, when it came up with the scheme which we announced and which is what is getting approved as we speak now at various forums, it will have a 1:1 share entitlement ratio, meaning every shareholder of HUL will get 1 share of the ice cream company, and hence all shareholders now will be able to create value with the ice cream opportunity.
Okay, and your sense in terms of competition in the ice cream space, because right now what I was observing in the quick commerce space, there are a lot of startup companies which have come up with their ice cream businesses. For example, there's Go Zero, which has made its mark in terms of the quick commerce space, not otherwise. What's the sense there, and then what will be your distribution strategy like in the ice cream business?
Our ice cream business today has a footprint across channels very different than market. We are over-indexed on channels of the future. quick commerce, modern trade. So our overall business is more premium and it is more over-indexed to channels of the future. Ice cream as a category has overall low penetration, low consumption in the country, and hence massive headroom for it to grow, and hence multiple players can coexist and keep growing the market. So far as you have distribution, which is wide, we are present across the country. We are present across the channel with over-index presence in channels of the future and great amount of brands and innovation. We do believe that with low penetration, low consumption in the country, there's enough headroom for us to grow the ice cream business. Okay. In the last 1 decade, the business has grown at double digit, and we do believe that going forward as well, it's a business which we would expect to keep growing at double digit, and which is why having a business model which is suited to deploy the distinctive business model and strategies for ice cream will serve the business very well going forward as well.
Right. I think the key takeaway from this conversation is that although FY25, FY24 FMCG was under pressure, but the future definitely is promising for the entire FMCG industry, and the fact that HUL is strong in terms of growing in terms of double-digit EPS growth is the key takeaway for me in this conversation. So thank you so much, Ritesh. You want to add?
No, indeed, Mahima. I think I'll just probably add to what you mentioned, that where we are today, both macro factors for consumption for FMCG are improving. I mentioned multiple reasons for that, be it a good agriculture outcome or inflation, which is looking now much lower compared to earlier, especially food inflation, the amount of monetary easing which has happened in the economy, plus the tax relief. If I add all those elements put together, a good climate getting created externally. Internally, what we have done with our work on portfolio channels, we do believe that external internal factor put together, the outlook for FMCG consumption and our own growth outlook will be better going forward. As I mentioned, the first half of financial year 25-26 would be better than last half of financial year 24-25. We will invest in the business. For next few quarters, we do believe our margins might come down more to 22-23 band. It is still very healthy, but we want to ensure that we are unblinkingly going behind growth. And growth for short term will be volume led, to your question which you asked earlier, and pricing might be lower at low single digit, but it will be volume led growth.
All right, okay, got it. All right, thank you so much, Ritesh.
Thank you, Mahima.
I'm Srikanth, co-founder and executive vice chairman of Fractal. Actually, I am Srikanth's AI avatar, and the real Srikanth, who you can see behind me, wanted me to handle the start of this session.
We may be 3 to 5 years away from a place that AI is getting so good that it will beat human beings at everything.
Why is Fractal a big deal? Why is Fractal a disruptor in its space?
Fractal powers these algorithms that help companies become better at what they do, more effective at what they do.
What do you say to the doomsday conspiracy theories that there will be a point where artificial intelligence will gain superiority? In 5 years, would you need the same number of people?
For the same quantity of work, we need only half the people or maybe a third of the people.
Tell us about the journey and how you came into this space.
It all began with my interest in math. Getting 98 on a math test was considered poor performance.
Oh dear.
We started Fractal and we said, what if we can use math to predict human behavior?
The 2007 split was a tough one, wasn't it?
I look back, maybe I wanted to take charge of it too quickly. My ego came in the way. Net, a year later, the 3 people who selected me as a CEO said, we don't want any CEO.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
what is the value of your home, it's priceless for everyone because it's their home. We all know real estate can end up giving you supernormal return, but you will not get the liquidity when you want it. On an average, the biggest exposure to any asset is real estate.
Yes.
If it's an investment, you need to know the appreciation, you need to know the income it provides, and also the liquidity that it can bring. The luxury real estate, I mean, there's a huge demand-supply mismatch.
Should you buy real estate companies instead of real estate?
You and I can own maybe a fraction of a mall, a fraction of a business center. Like how you have units for mutual funds, you have units for REITs over here. I think the most important aspect of this, story that we are talking about is what is the yield you're going after? Are you happy with the returns? Are you happy with the risk profile? Question is, how much is enough?
What's the value of a house? That depends on whether it's a home or an investment. If it's a home, you're not worried about how much someone would pay for it. Unless, of course, you're thinking of moving somewhere better. If it is an investment, there are several factors that come to mind. What is the area that you've bought this flat in? Is there an infrastructure project that is coming up or has come up in the vicinity? And this also assumes that you've paid a significant amount of money to purchase the flat. If it's outside Mumbai, you're paying about 1 crore. If it's in Mumbai or Bengaluru, the NCR region, you're paying over 1 crore, maybe a few crores. And that comes with its share of problems. There's an interest cost involved if you've taken a loan, and in all probability you have to do that. But what if you want to take exposure to real estate as an investment without putting that much money down? There are, of course, real estate investment trusts. They offer fractional ownership without the hassles of illiquidity and the humongous cost. But are they good investments? How do they stack up against infrastructure investment trusts? This is MoneyWise on NDTV Profit, and we're going to talk about this today. Joining me in studio is Santosh Joseph, the founder of Germinate Investor Services. Santosh, thanks so much for taking the time.
Hi, Alex.
A bit of a long-winded introduction to that question, but the question that I want to start with is that there is this old world thinking, and it's proven true and good for a lot of big investors. They do it still today. If you've made money in the capital markets, particularly in the stock market, the thinking is you should take profit off the table and buy physical assets. A lot of people do that. Is that good? Is it bad? Is there merit to doing that? What do you think?
Largely what you said is routine for people, because if they made money in the capital markets, there's this tendency to feel that let me take some profits off the table and buy me something that's a lot more stable.
Yes.
On the other hand, there are some people who sell real estate and just get into a pot of money, and then they diversify by buying some digital assets, which is like equities. Now what this tell you is that there is a cycle of life. Physical getting into digital assets, which is equities, and equities then when you sell you buy physical assets. There is no right or wrong answer, but I think what is important is how you make the play work for you. The people who want to go in for stability is the one who have sold a lot of equities or profits from equities and consolidate by buying a physical asset, and they're happy because they know it won't at least materially collapse, and they know they're in possession of it, and there's a physicality attached to it. On the other hand, the people who have made money in real estate, when they go here, they're looking for simplicity, they're looking for diversification, and not to forget, yes, liquidity is a paramount factor, because we all know real estate can end up giving you supernormal return, but you will not get the liquidity when you want it, and it will not come easy.
Okay, so the reason I ask is that you keep hearing about luxury properties that are bought. Real estate companies, particularly those that are in the luxury space, are doing particularly well. And this is at a time when there has been a bit of a lull in certain pockets, right? We're still waiting for the interest rate cuts to pan out, for people to go out and say, okay, we want to take more home loans, we want to buy more houses. What do you think about that aspect, buying luxury real estate or real estate above a certain value as an investment?
Well, you can't take away from the fact that people, if they have that extra rupee, they will look at figuring out what they can consume, and therefore luxury real estate today is doing really well. And when you look at affordable real estate to luxury real estate today, you'll notice that the demand for luxury real estate is the one that's growing phenomenally, and it surprises most of us in the marketplaces. You take any large city, you talk about affordable housing to luxury housing.
There's a dichotomy.
Yes, the luxury real estate, I mean, there's a huge demand-supply mismatch. In fact, most will agree that many are short of supply. In fact, post-COVID, that has been the trend across the country in the large major cities. Now, when you look at that, there is just generally going to be an affinity to buy that. And you can't stop people from buying that. Question is, how much is enough?
Okay. So it's a good question to ask. The reason I'm setting this up, and I know that a lot of you tuning in will be like, why are you even asking about luxury real estate when it's unaffordable to begin with? To buy a small property in Mumbai, even if you go to the suburbs, it's going to cost you 2 crore if you go to Borivali. And I know this for a fact. So therefore, the reason I'm asking is to set up the next aspect of this conversation, which is that this might work for somebody who has a 1 crore portfolio, and for them to say, okay, I'll put 5 crore down, 6 crore down to buy a luxury property. Does it work for everybody else is a question.
It doesn't. See, it's about the position sizing. Like we say in equities or maybe even in investing, that you have to be mindful about the exposure that you take. It's not necessarily how the investment per se does. It's about your exposure and your risk measure. Even in terms of real estate, you can't be really overboard. Now, for someone having the need to buy a 5 crore where you put in some bit of your money yourself and then leverage the rest or borrow some, it may work, but not for everyone. And therefore, you have to pay attention to even the size, even when it comes to real estate.
Okay. In your opinion, what is too much of an exposure of real estate in an investment portfolio if you've decided that this real estate is an investment?
So let's put into context what we are experiencing right now in the country. Most people, on an average, the biggest exposure to any asset is real estate.
Yes.
And this is true for the country at large. But now with the emergence of non-physical assets like equity, you're seeing that slightly move the needle. For example, equities and mutual funds and financial savings products are increasing. I think if you're having 30-40% of your money in physical assets, in real estate, you're good. Slightly more than that, you're getting into the tough territory of managing liquidity or even managing how you manage the assets in itself. Because the people who do have a lot of real estate also have the challenge of, number one, maintenance, management, taxes, not to forget liquidity. While all this may be good, there's also a legal aspect to it that you have to be on top of the legal aspect of vetting all the documents, ensuring that you're on the right side of the law. Yeah,
right. When you're buying. So therefore, it comes down to what I wanted to talk about today, and it's a bit of a long setup to that. But fractional ownership of real estate, when they were launched, there was a lot of fanfare. They haven't taken off to the extent that I think some people had hoped, and I think policymakers are well aware of this. So you could have regulations that come through that bolster REITs. But as things stand, how can you describe the functioning of a REIT?
So what does REIT do for an investor is that it breaks down the process of putting your money into work in real estate with high liquidity, with simplicity and extremely low ticket sizes. Now, while I'm explaining this, let me also say that real estate is a fundamental predominant asset for most of us, and the definition of any asset naturally would be something that's a good store of value, something that appreciates well, something that gives you an income, and fourth, something that can also be easily liquefiable to buy something else.
Yes.
Now, when you look at this REITs, it actually solves all the four, because when you own a home, you don't get the rent and you're not going to worry about the appreciation, because you ask that question, what is the value of your home? It's priceless for everyone because it's their home.
Yeah.
But if it's an investment, you need to know the appreciation, you need to know the income it provides, and also the liquidity that it can bring. REITs do exactly that by creating this fractional ownership model that you and I can own maybe a fraction of a mall, a fraction of a business center, a fraction of a huge retail space, a fraction of a maybe IT says or something of that sort, maybe a 5-star hotel. Now, what does this do to an investor? You do not have to be worried about everything else to do with the asset, but all that you need to figure out is what you're buying at what price you're buying.
Okay, so does this work like that mutual fund ultimately it is fractional ownership of shares as well. If you're talking about an equity mutual fund, you buy units of the mutual fund, and the description of the value of that is the net asset value. And that mutual fund would invest in 500 stocks or 50 stocks. Similarly, a REIT would invest in properties in the commercial space or in a mall. Is that how it works?
Exactly. So that's a nice way of putting it across. So when you buy a mutual fund, you have a portfolio, you have a list of stocks, and each of these stocks have a certain weight. In similar fashion, when you buy a REIT, you have a developer who's got so many projects across various places, various cities, and mixed use development. Now those are actually yielding you returns in the way of rental yields and lease yields. Those are accrued back to the investor. So the investor sees appreciation, investor sees income, and investor sees dividend coming out of those assets. Mind you, here the ticket size is really small. Like how you have units for mutual funds, you have units for REITs over here, and like how you get dividends in mutual fund if you choose that option. Similarly, you will even get dividends here by the virtue of being an owner in REITs.
Okay, so. And you've listed this out beautifully. The question that arises is, what are the different types of REITs in India? Because if you look at the global picture, there are residential REITs available, there are commercial REITs available, there are REITs that invest in the retail space, which is in malls. What is the landscape currently in India?
So from a real estate based investment trust, there are two largely. One, you have REIT, right? The one that takes care of office space, a little bit of retail space, malls, and even hotels, and all those are bundled into REITs. There are also public infrastructure, like from a toll plaza to a bridge.
That's
InvITs, right? So now in the REITs, you do not have a specific residential only or office space only. You have a slightly mixed unit right now coming up over there. The advantage that you have is that there is scope for these to grow and mushroom into bigger things. Like you spoke about in developed markets, you have specific REITs, maybe for warehousing, maybe for housing, maybe for low cost housing, maybe for different housing projects specifically. They're all actually special purpose vehicles with a specific objective of what they're funding and what segment they're going after.
So right now, would it be fair to say that most REITs that are offered, and there are a handful of them currently, are commercial oriented?
The commercial, office space, retail, and lease oriented.
Okay. So you described that the way for an investor to make money in a REIT is twofold. Essentially, you're talking about capital appreciation, which happens when the value of the underlying, which is the value of the property that the REIT owns, goes up. And two, there is a distribution of the rental income that those properties generate, and there is a mandate to distribute most of it. So how does that work?
Generally, when you are an investor in a REIT, I think you get 2-3 incomes. Number one, you get the rental yield passed on to you. Number two, you also get a dividend income. Number three, there's also an interest income, because the money that you given towards the trust, which is the investment vehicle, also should pay you an interest for the capital that's given. So you have these three sources of income. Not to forget that the price that you buy could also appreciate, because the main vehicle that holds all this could also get a flip in their income up because of renegotiation or maybe more capacity being added in, and therefore that adds to the total net asset value.
Okay. So, and you've described three of these things, right? So you've talked about in that dividend, you've talked about rental, you've talked about interest income and
dividend income, rental income, and also capital appreciation.
Okay. So, and it's all housed in that dividend income that is paid every quarter?
Yes.
Okay. Now, how much are the REITs currently paying in India?
If you take a ballpark figure, that number is between 5.5% to 6.5%, and that number is paid out on a quarterly basis, then annualized. So therefore, the yield is, let's say, 6 as a ballpark figure. I also want to add that the capital gains happens between your buying price and selling price and the way the stock price moves. But the dividend income and the rental income, and even a certain portion of it, which is the returning of the distribution capital, happens on a quarterly basis. Understood. The payout is happening mandatorily on a quarterly basis.
So that's where it gets a little tricky to understand the tax implication as well, right? And the other thing, before we get to the tax aspect, is I want to talk about the price of these REITs, because they're all listed on the stock exchanges, and ultimately that's where it's available. Liquidity is something that is available because it's traded on the stock exchanges. The point that I want to ask is that a lot of these REITs have not done particularly well in terms of capital appreciation. Why do you think that is?
You see, there are a host of factors. The first things first is you cannot equate the price of real estate to the price of the REITs, because here largely it's based on rental yields. You're not going to every day take the value of the real estate under play. The benefit that you're actually playing for is the rental yields or the lease rentals that one is expecting out of it. Now that sometimes these are all on long-term contracts. You have to wait for the escalation to kick in, or to wait for some tenant leaving and another tenant coming, and sometimes you could also go through a small period where there is a tenancy issue over there. But largely this is not a proxy to real estate play only in terms of capital appreciation. Capital appreciation also happens, but it's not the primary reason. You get in here from a rental yield perspective. That's why the dividend distribution that happens on a quarterly is important, and largely you measure these for the dividend yields that they can give you.
So when you're saying that the dividend yield therefore currently is 6% or thereabouts, it's not very high, is it, Santosh?
It's not very high compared to what you would normally think that you should make in real estate. But think about it. But if you are looking for a stable income which you want to receive on a regular basis, compared to what you would get on rental yields across any residential real estate project across the country, it's still very good, and it gives you great amount of liquidity. Now, can you easily get a 6% kind of rental yield and not be worried about whether you will get it next month, not be worried about what is the liquidity factor, not be worried about how much money you have to put down, and not be worried about will your tenant leave you? That's the problem it tries to solve.
Okay. So when you're saying 6%, you're talking about pre-tax at this juncture. Is there a simple way to explain the tax aspect of this?
It is simple. So first things first is the capital gains. The difference between your buy price and sell price,
equity.
It's a capital gain taxation.
Yeah.
The other two,
and let's spell that out, because that's long-term capital gains for equity is more than 1 year.
Yes.
And you have the benefit of 1.25 lakhs,
Yes.
which would come into play
Yes,
here
yes,
as well.
yes.
And if it's beyond 1 year,